My goal and promise to you is within this free YouTube course, I'm gonna give you everything you need to be able to properly trade with confidence. So that way you're not taking trades and losing money consistently or just feeling lost when you open up a chart. So before you think about buying another trading course, all I ask is that you just give this free one a chance, okay? I don't want you to go spend another $1,000 or $2,500 or whatever price that they're charging you. I want you to get the information right now for free. And then all I ask is that if I do a good enough job and I do actually exceed your expectations, just check out the link that's down below in the description. Now, with all of that being said, it doesn't matter if you are a beginner who is just getting into trading or looking at getting into trading, or you're an intermediate individual who's been trading for a little bit, but you're still not finding consistency or you're just not really comprehending the market. This entire video is for you. So all I ask is that you watch this entire thing. You'll probably have to come back and watch this a few different times. So just make sure you leave a like, make sure you subscribe, and make sure you add this to your save for later. So that way you always have this entire video to go back to. Now, with all of that being said, my name is Dontez Akram. I've been in the stock market since 2020, so about 6 years. I've made over $400,000 in profit through a combination of swinging shares and options trading. And in today's video, I'm gonna give you everything I got to make sure that you actually have the right tools to be able to trade successfully. Let's get into it. So here's how you get the most out of this free course and the most out of your time. Step number one, you wanna make sure you watch this entire video without taking any notes, okay? The second time around is when you're gonna start taking notes. If you're trying to take notes and you're trying to listen at the same time, it's gonna be pretty difficult for you. If you just can't help it, then fine, do what works best for you if you already know what that is. However, for the majority of you, I highly recommend just watching it the first time without taking notes. And then the second time around, that's when you're gonna start taking notes. The second thing is, I know a lot of you are visual learners. I'm a visual learner myself. So I put together a really nice presentation to literally walk you through everything. However, I will still go and show you everything by sharing my screen and going to all the platforms, walking you through options chains, looking at the charts. Like, everything is literally going to be broken down to you in depth through both a visual presentation like I have in front of me, and on top of that, I will still walk you guys through everything as well. Now, the next thing as well is you definitely want to make sure that you hit the subscribe button if you haven't already. And with that all being said, I have this entire presentation and I'll just be going back and forth. You will see that I add other videos that I've recorded in the past that may give you more context and help with certain areas and certain chapters of this entire course. So just make sure you watch all of those as well, and you can constantly fast forward, rewind, and do all that good stuff. You know, whatever works best for you. So with all that being said, it's time to go ahead and stop yapping and jump straight into this course. If you like it, let me know down below in the comments. Let's go ahead and jump into it. So here's my beautiful TSA presentation. If you don't know what TSA is, it is a Discord community that I own of over 500 traders where we teach 9-to-5ers how to make more additional income on the side of their job. Now, this is going to be a full-on breakdown of how to go from zero to systematic as a trader. It's about 9 chapters in all of this. We have a ton of different diagrams. It's a full visual library. So again, if you are a visual learner, this is going to be amazing for you. So yeah, I hope you like it, and let's get into it. So here's some things you need to know before you start trading, okay? Number one, you need something called a brokerage account. Basically, what a brokerage account is it allows you to trade and take trades on their platform. So an example of a brokerage account would be something like a Webull or a Robinhood, or, you know, for most part, a lot of you guys have heard of a few of those, but there's other ones out there like TD Ameritrade, you got ThinkorSwim, you have Tasty Trades, you have Moomoo. I will give you recommendations on platforms that I personally like, and then I'll walk you through a couple of them as well. But that is one of the first things that you will need is a broker account. You can download this on your cell phone, or you can add it on an iPad or your computer, whatever works best for you, okay? Now, we will go over how to actually open it, you know, like I said, which brokers to use, and then down here as well, how much you should be starting with realistically, all that good stuff. We're gonna break that down as we go through this, all right? Now, this is, again, everything you need to have in place before you start trading, okay? Don't put any money into the market just yet until you know and understand these things. The second thing you need to understand is there is a rule called the PDT rule, okay? So basically, a lot of, you know, beginners are completely blindsided by this. But basically what this means is it tells you that you cannot take more than 3 day trades per week with an account under $25,000. So why is that important? When you are setting up your brokerage account, you want to set up a cash account, okay? A cash account is allowing you to trade with the money that you have accessible in your account. If you try to open up a margin account, is what it's called, this is using borrowed money. It's basically taking a loan and trading on that. That's a big no-no. You want to use that later down the line after a few years once you start having some consistency and you want to start leveraging other people's capital. However, when you are setting up that brokerage account, you need to make sure it is a cash account. The reason this is so important, again, you will get flagged as a day trader on most of these brokerage accounts if you're taking more than 3 day trades per week. So what is a day trade technically? It's when you take a trade in one day and you close that same trade the same exact day. So this is specifically for options traders, okay? Next thing is platform setups. We're gonna literally walk through, what integration tools you wanna be using, how to get your options account, obviously approved, and some of the best practices and things like that as well. So these are just a couple things you should know. If you feel like, okay, maybe we just started in the wrong foot, just keep watching. I promise I got you, all right? So beginner platform setup. So what exactly do you need to get into trading as a whole? Okay. So number one, you're going to need something called TradingView. So when you see people streaming or you see people breaking down charts and things like that, for the most part, they're going to be using TradingView. It is literally one of the prime platforms to use to check the charts. So think TradingView equals seeing the charts, seeing the candlesticks, seeing all the, different stuff going on in the market. Okay. So you can get a free account at tradingview.com. I'll walk you through that as well. And on your watch list, some of the things that we're going to talk about inside of this course as well is going to be things like indexes and ETFs. If you don't really know too much about those yet, just keep watching. I promise I'll break it down to you. But you want to start off a watch list, okay? You don't have to do it right when you open the account. You can maybe wait until you get through this course and then start adding your watch list, but I'll show you how to do that as well, okay? Next up is you want to set up the 30-minute and the daily charts. Now, these are going to already be on there. Again, I'm going to walk you through all of this, but these are things that are important. So if you're a little bit more savvy with the platform, definitely go ahead and just set that up. All right. And then next is you're going to want to learn how to switch through different time frames, which again, I will be teaching you inside of here. So the brokerage that I recommend, the ones that I personally like, okay, these are just going to be some breakdowns of it. So lowest fees for options is going to be something called Tasty Trades. Most powerful platform at scale is definitely going to be ThinkorSwim. And then the simplest for beginners, in my personal opinion, is going to be either Webull or Robinhood. I personally use Webull. I think it's really, really dope. If you want a link to either Webull or Robinhood, the links will be down below so you can easily, start your account up. Okay. Now, TradingView is the eye, right? So this is what you're looking at when it comes to the charts before making decisions in the market. Okay. The brokerage that you're using, whether it's Robinhood or Webull or all those other platforms we talk about, is your hand. That's where you're going to be taking action. So one is viewing, the other one is doing. Okay. You never want to confuse the two when you are going through this. Okay. So the next question you're probably asking or thinking to yourself is, how much money should I start with? Okay. So you want to kind of treat this learning section as a tuition, right? So what I like to say is, you can start with anywhere from $500 or even $250 all the way up to maybe $5,000. Now, here's the thing. How much you start with is solely based on what you're comfortable with risking. So here's how I kind of like to perceive it and teach my students. When you are going through this and you're going through this process of learning trading, insert an amount of money that you're okay with losing. And think of it as already being gone, right? So if you're okay with trading with $1,000 and starting with $1,000, put $1,000 in your brokerage account and just understand you're never gonna see that $1,000 again, right? So think of it as tuition. This is the pay to play, okay? So, most of the trades that you're gonna be taking is gonna be very, very small size trades. I'll show you guys which tickers and things like that you should be trading as a beginner. But yeah, about $1,000, I'll say $250 all the way up to about $5,000, depending on, your ability to, handle risk. You want to go ahead and rock out with those. Okay. Next up is the real learning begins. Okay. So this is when you're going to be starting to take a little bit more trades. This is after you pretty much go through this entire course. You pretty much have like an understanding of the market and you're ready to like start getting your feet wet. Okay. This is where you still ideally want to be trading with 1 to 2 contracts. If you don't know what a contract is, I will break it down too. Okay. Next up is you want to start building that proper foundation. Okay. You want to have more flexibility. You want to understand more of the things that you're doing when you're trading. And then this is when you really understand day trading. This is when you start having no PDT rules, restricting you, and you start actually being able to grow your money as a whole. So this is kind of like the journey that you're, pretty much signing up to when getting into the trading space. Okay. So here's an honest message. The goal in 1 year is not profit. I know a lot of people come in and they want to just be profitable. The goal in 1 year is to just build a system. Find a system that works for you. Okay. Inside of this entire course, I'm going to give you my entire system. I'm going to hopefully explain it in a way where you truly understand what's going on and how to actually do it on your own, with the hopes that, when you get to that point, you can click the link down below in the description and check out TSA. Okay. Now, you want to go ahead and start with what you can afford to lose completely and never need it back. Do not put your rent money in this. Don't put your kids, tuition into this. Like, you want to start with an amount of money you're okay with losing. I cannot stress this enough. Again, everything inside of here, none of this is financial advice, but again, please make sure you start with the amount of money that you're okay with losing. So let's talk about the PDT rule, okay? So this is the 25K rule every beginner must know. So if you don't have $25,000 in your brokerage account, if you're taking multiple day trades, which is, again, I get into a trade the same day and I close the trade the same day, okay? If you do that 3 times within a week, your account will get flagged. So what does PDT mean, okay? It means pattern day trader restriction. Okay, so what happens is when your account gets flagged, it gets flagged for 90 days. Okay, so you want to make sure you do not make this mistake. Again, if you have a cash account, you can just trade with the money that is in your account. So if you don't want to worry about this, okay, do not try to trade on a margin account. All right, so the first way to get around this, I'm going to say it again, use a cash account. I will walk you through those processes as well. Okay. The PDT rule does not apply when you are trading with a cash account. When you're also uploading money into this cash account, it takes about 1 to 2 business days, depending on the platform. All right. And then on top of this, it allows you to have unlimited trades. It's literally the best of, both worlds, essentially. All right. And then you just got to be mindful of the settlement. Again, it just takes a little bit of time of the money to just settle in your account. All right. So this is a lot simpler. And it's going to be great for beginners. So do not try to start with loaned money, okay? Start with what you're okay with losing. The second thing is be very selective, all right? Ideally, for me personally, as a beginner, I would say, try to start with 3 to 5 trades per week. Try not to go past that, okay? When you start taking a bunch of trades, you start trying to manage too much, you start looking at a bunch of different things. In my system, I'm going to show you how I go about things. So just please keep this in mind, all right? Quality over quantity is important when you're trading, but the most important thing I could possibly tell you is focus on discipline and focus. That's it. And then after that, you'll be on your way to growing to 25K. You can, again, leverage money later down that line, but for right now, a cash account is all you need. This rule has blindsided thousands of beginners. A lot of people don't really know this. Obviously people talk about it on YouTube, but it's important that you hear it right now in the beginning of your journey. Do not start with anything other than a cash account. Thanks. All right, so just need to know this before you start trading. Now, what is the options approval levels? Okay, so how does it work? And how do you go about this entire process? Okay, so number 1, all right, which options do you need to get, or which option level do you need to get approved on? Okay, it's going to be level 1. So how does this work? So basically, when you sign up for your brokerage account, you're going to want to start trading. You want to start seeing the options to be able to trade. Well, you need to do an application to be able to make sure that you're not an individual who's going to be over leveraging or anything like that. Like, you're a responsible, disciplined individual, right? And it's just going to basically ask you a few different questions. And you're going to basically go through those questions and answer them. When you answer those questions, answer them honestly, obviously, right? But you ideally just want to get access to level 1. And level 1 will allow you to buy calls and puts, which I'll be explaining a little bit later. This is what's going to allow you to take an options trade. Okay, so you have to have bare minimum level 1 to get access to options trading. Okay, this is, again, beginner friendly. All right, what are the brokers going to ask on that application? Number 1, years of trading experience. Next is going to ask for your annual income, your net worth, and then your investment objective. Okay, so just make sure you answer those and you should be able to get access to level 1. Level 2. All right, this is the step up. This is doing something called selling covered calls and cash secured puts. I don't do these as much. I'm not going to break it down inside of this course, but this is a more advanced way of being involved in options trading as well. This requires experience. The third level, okay, is spreads and complex strategies. This is for advanced traders when you're trying to dabble into a bunch of different ways to trade options. That is going to be that, for you. But for the most part, all of you who are watching this, we're only focused on calls and puts. So yeah, maybe later down the line, I'll explain all the other ones. But for time purposes, this is going to be a pretty long course. But for time purposes, I want to make sure I explain all the things that makes the most sense for you to understand this and to be able to confidently trade. Okay. So cash accounts versus margin accounts. Okay, so which one is going to be for beginners? I'm going to say it again. I know it sounds very repetitive. So you want to start with a cash account. Okay, you only use money that you deposited. There is no pattern day trader rule, okay? It's the safest for beginners. When you upload money, it settles within 1 to 2 days after closing a trade, okay? And on top of that, or when you're actually taking a trade, it settles within 1 to 2 days. So basically, let's say you take a trade with a certain amount of money in your account, you basically can trade with that same amount of capital, 1 to 2 days later, all right? And then there's no risk of owing the broker money, okay? No risk of owing the broker money. This allows you to have steady growth and peace of mind. A margin account allows you to borrow from the broker, okay? PDT rule does apply when you're doing this. This also amplifies both your gains and your losses. So again, when you start adding leverage, think about it, right? You can also owe the broker money if trades go very wrong or you're trying to, over leverage. And you must maintain a minimum amount of equity, okay? So again, this is high risk, high reward, or high debt. I like to play both ends, right? So again, my recommendation is just start with a cash account. Every beginner, no exceptions. Later down the line, when you're extremely profitable and you're consistent, then you can start looking at margin accounts. All right. So here's just a couple different differences between the brokers. Number one, my number one pick is going to be Webull. There's free commissions when you're taking the trades. These are going to be the cleanest and easiest interface outside of Robinhood. Robinhood does beat them on the interface side. It is great for options traders. There's a lot of different tools and ways to look at the market that'll allow you to say, hey, I can actually see the things that is actually going on and be a little bit more confident. They also have extended hours trading. Okay. There's paper trading built in. So if you want to start paper trading, which is a phenomenal option, I'll be breaking that down shortly as well. But if you want to start paper trading, Webull has a really easy, paper trading platform. It starts you out with $100,000 of fake money, which is great for beginners who want to start getting their feet wet. There is a desktop and a mobile app as well. And there is free level 2 quotes, which I'll explain a little bit later. All right. This is going to be the easiest to start in my personal opinion. Robinhood is really easy as well, but it's literally between these two. You can literally just choose whichever one works best for you. Next up is going to be Robinhood. Free commissions as well. Very clean mobile app. Options trading is available. There's instant deposit. So when you use your debit card, it'll instantly deposit the money into your account. It's limited on the advanced trading, or advanced charting side of things. They have basic options tools, and you can use this with TradingView. Now, another key thing is, I know you guys have probably watched other traders in the past. When you are trading options, you cannot connect your brokerage account to the TradingView or to your whatever user your software that you're using to watch the charts. You cannot connect those two. That is for futures or forex trading. Okay, so when you're taking your trades, you're going to be taking your trades on your phone, and you're going to be watching the charts on your computer. Number 3 is going to be a little bit more advanced. So you got Moomoo and you have ThinkorSwim. I would say Moomoo is really not that advanced, but I would just say it's just not my highest recommendation. Okay. Really ThinkorSwim is going to be that one where you start scaling a little bit more and you start getting a little bit better at trading. You're going to probably want to move over to ThinkorSwim. All right. It has advanced options tools. There's a deep chart analysis section that they have. They have level 2 data built in already, and then it's great for serious traders. All right. It's a little bit of a steeper learning curve when it comes to looking at the platforms a little bit, right? A little bit more complex interface, and you just pretty much want to graduate to this later. So this is kind of like a level up later down the line. All right. So pro recommendations, just use TradingView for all chart analysis. Start with either Webull or Robinhood, and then you can upgrade to Moomoo or ThinkorSwim a little bit later. All right. So why you must paper trade first. Now, again, some people like getting their feet wet with real money. If that's you, by all means, do what works best for you. If you want to start with fake money, that's also good. Do what works best for you. I'm not going to tell you either or. For me personally, I started getting my feet wet with real money. That's just me. If you don't want to do that, paper trading is also a good option. So what is paper trading? Okay, so it's basically fake money, but you can see real charts. There's no risk when you're taking these trades, okay? And on top of that, even though you're using fake money, you're taking real trades that are real setups that you would normally take with real money. And the really cool thing is this allows you to start building the habits of running the system that I'm going to teach you, which is also abbreviated CKSR. I'm going to break down each and every one of them. And then there's a 30-day minimum recommendation, okay? So I would say for about 30 days, if you really want to just get the platform down, if you want to start like understanding how contracts get filled or how to get in and out of contracts, certain buttons that are on there, all of that stuff, I highly recommend just taking a few days, even if it's not 30 days. Let's just say, you know, the first 3 to 5 days that you're getting into everything and using the platforms and trying to take trades and stuff like that, or just trying to test out this system to see if it works for you. I highly recommend just going ahead and just playing around with things in the platform and just kind of seeing. All right. The reality, okay, fake money, right? It sounds really good, right? There's no fear, no greed, no cortisol, right? But the reality is, you know, obviously, when you're using real money, you're going to have other emotions attached. So that's something important, is like when you're paper trading, there is no emotions. When you start using real money, that is when your emotions start getting involved, because it's actual money. Now, again, remember, humans are like, we're already emotional creatures, right? So with that being said, when there's money involved, when most people are emotional about money, it amplifies your emotions as a whole. So please keep this in mind. This is why I do recommend paper trading, starting off a little bit, getting a little bit of experience. You'll start having some jitters and stuff like that. Get some reps under your belt, get those jitters out, and then start using money. Now, if you want to start with money, again, completely up to you. So, you know, when you start using real money, this is normal in the beginning to feel a little bit like frozen or scared, or feel greed or feel fear. It's perfectly fine. It does not mean that paper trading was useless, okay? And on top of that, it means your system is solid, okay? That's really the biggest thing, all right? Now, the recommendation is, again, you can take 30 days to start paper trading. Again, if you don't want to do it that way, that's perfectly fine. The biggest thing within this course is I want to give you multiple options that I feel like could potentially work best for you, all right? So with this being said, I'm going to actually pause on chapter 1, and I'm going to literally walk you through all the other platforms, show you which accounts that you should be having, which subscriptions you need, pretty much the whole schwazoo. I'm going to walk you through all of that right now. So let's go ahead and get into that portion of the video right now. All right, guys, so let's go ahead and walk you through TradingView and specifically how it works, okay? So TradingView is going to be the platform that you can literally come in and you can start looking at the charts. So for example, I'm going to type in a ticker. Let's just look at, you know, the S&P 500, which is SPY, okay? So this is what TradingView looks like when you are first starting to use it, okay? There is a mobile app. I download the app on my phone, and I also downloaded the app on my computer as well. Now, the other option is you can also just go to tradingview.com and you can come in here, you can search your tickers, and you can build your watch list and all of that good stuff directly in here, okay? Over here is the watch list section. So remember, like I said, you want to make sure that you have a watch list together. Another really cool thing is when you first start your account, TradingView already uploads a few different tickers. So basically what a ticker is basically these abbreviated abbreviations for the stocks. So for Apple, AAPL, right, is going to be the ticker symbol. Tesla, I mean, I think that's pretty self-explanatory, right? TSLA. So these ticker symbols is what you're going to use and keep in mind when you are trading, okay? So if you ever wanted to search something up, when you click the search bar, you can type in SPY, right? Or let's say for Apple, for example, you can type in the word Apple, whoops, the ticker itself, Apple, or you can just type in Apple itself and it'll also pull this up, all right? So this is pretty self-explanatory here. Over here, again, this is going to be your watch list. Down here is going to be more information. I rarely use a lot of this stuff. I really only use this portion, right, of the, you know, this portion of the chart itself. All right. Now, the next thing you want to make sure you do, okay, I'm going to go back to the home page. All right. When you come over to TradingView, you want to click on Get Started. All right. Now, which plan do you need as a beginner? All right. Now, which plan do I have? Number one for me, I have the premium plan. Okay. For me personally, I need something that has more charts. I can have more indicators, which are just basically tools and resources you use on your chart. I just need more things because I am an individual who is, you know, obviously doing this full time. For someone who is a beginner, you can either do the essential or the plus plan. What I will tell you is at some point in time, you're going to want to upgrade to the plus plan. So if you're anything like me and you're just like, hey, I just want to start with the best right out the gate, start with the plus. If you're an individual and you're trying to start on a little bit more of a budget and a little bit more reserve, which is completely fine, start with the essential plan. It's about $15 a month. Okay. So these are the two things. The differences between these two is you're going to be able to keep more chart tabs open here. You get 10 indicators as opposed to 5. All right, and then those are really the only main ones outside of the price alerts, which is basically like setting alerts, which I'll teach you as we go through this entire thing. Okay, now when you are going through this, all right, let's see here. Let's go over to explore available markets. All right, so now that you subscribed, or you need that specific plan, the next plan that you're going to need is the US stock market bundle. Okay, you need the US stock market bundle. All right, so if you do not have this, okay, if you do not have this, your data, when I mean my data, is when you're looking at the chart, it's going to be behind. It's going to be 15 minutes behind. Okay, if you want real live data, you want to make sure that your charts and your indicators and everything is up to date when you are looking at it. So if the market is really moving, right, like if price is moving a certain way, you're catching it in real time. It's called real time data. Okay, this is $10 a month. So all in all, you're either going to be spending about $50 a month, depending on the plan you use, or you're going to be spending about 25 bucks a month to use TradingView. This plan right here is the most important thing you can possibly add to your account. Okay, the reason being is because, again, without this, you're going to be 15 minutes behind when looking at the charts. You don't want to take a trade and then price is 15 minutes ahead of you. Okay, I'm pretty sure we all understand why that would be important. All right, so I highly recommend doing the US stock market bundle. If you're an individual looking to get into more of the futures side of things, you can look at the CME group, which is also really good. But the US stock market bundle is the most important one. As an options trader, I would highly recommend getting both of them. This one down here is about $7 a month. And when you're looking at the futures market, like ES, right? For example, if you're a little bit newer, this probably isn't going to make sense. But if you're a little familiar with the market, you don't want to have any delays. This is about a 10-minute delay. So you want to go ahead and make sure that you grab this for about $7 a month as well. All right, so that's going to be it for the markets. That's going to be pretty much it for TradingView. Again, they do have the entire app. So you just come over here, go to downloads and click download the desktop app. Okay, download the desktop app. So let's get straight into it. This is going to be TradingView. For me personally, I like my settings like this. So first, let's go to the settings portion of things. When you open up TradingView, down here at the bottom right, you can go ahead and click the settings bar, and it'll literally pull up more settings. Okay, so these are going to be all of my settings. We'll start off with symbols. All right, these are going to be all of my settings personally that you can set up. All right, so let's walk you through all of the settings so your charts are set up the right way. Number one is going to be the body, borders, and wick. Okay, I keep the left side green and the right side red. Okay, now you can change these colors, which will change the colors of the candlestick. So whatever one works best for you, go ahead and rock out. All right, you want to keep this off. All right, next thing, data modification. You want extended trading hours. What is extended trading hours? There's something called pre-market, which is the time that the market has before it opens. So from 4 a.m., which you guys can see right here, from about 4 a.m. all the way up till 9:30 a.m. This is called pre-market. So I'm not sure if you guys can see it all the way, but there's like this yellow shade right here, right? This is the pre-market. This is before the market can open. Only institutions, and what do I mean by institutions? Smart money, or people on Wall Street. You'll hear me say these things a lot, right? Only these people can trade in between this time. So banks, investors, hedge funds, so on and so forth. Only they can trade through this time. Next up is going to be this blue portion, right? This blue portion is the post market. What is post market? Post market is essentially the time after the market closes, right? So the market closes on Eastern time at 4 p.m. Eastern, right? So from between 4 p.m. Eastern all the way up to 8 p.m. Eastern, this is also times that they can trade as well. So you will not be trading during these times. The reason I keep these on though is because I like to see what price action we have during these times before the market opens. It gives you a good indication of what could potentially happen and what had happened overnight or in the morning before the market actually opens. So I personally like to keep these on. Let's pull our settings back up. Let's go back to symbols. Okay, now you can change the colors of the pre-market and post-market. Obviously I keep mine just like this, so 8% on this like orange color, and then about 8% here on the bluish color, which is again just for the background, right? Time zones. Okay, I am on New York, right, or Eastern time, right? So you just go through and select your city or whatever time zone you're in, and you'll be able to go ahead and rock out with that. Status lines, here's my settings. I keep the logo, title, chart values, bar values, right? You can pretty much just screenshot this part as I'm going through this. That way you're not wasting too much time, or you can just rewatch it and go through the whole settings with me. But yeah, just screenshot all of this. These are your settings for TradingView on the status line. Scales and lines, okay? So these are my settings here. No overlapping labels, plus button is added, countdown to bar close, okay? All of these things I pretty much leave the same. Now the other thing that I really like doing is time scale. The date format, I personally like it just like this. I don't want it to show up in these other ways. For me personally, the third option right here works best for me. And then I like changing this because again, I'm not too big on using military, hours. So I just use the 12-hour time format. All right, so that'll give you 1 p.m., 2 p.m., 3 p.m., 4 p.m., all that good stuff. Now, if you personally like to keep this on 24, again, personal preferences is okay. Go ahead and rock out with that. As far as your canvas, okay, so this is how you're going to actually change the settings of your background of your canvas, which is your chart. So inside of here, right, for me personally, I keep it on gradient, and then I just have it set to black. Now, if I wanted to change this white, if I wanted it to be gradient and I wanted it to be white or something like that, obviously I can come in and do that. So, some people like, I know girls who like theirs pink, right? I think, I know a girl who has hers pink and white or something like that, or whatever she does. I think it's both pink or something. I don't know. I can't remember exactly how she has it. But yeah, I know girls who want theirs like that. I know some people who want theirs to be gray, right? So you come on and you click on gray, right? Or, you might just want to stick with the basic, just white, which is also clean, favorable. For me personally, my personal preference is just black. Okay. This is how I personally like to look at my charts. Grid lines, I turn these off, right? If you have them on, I just personally don't like to see the lines, right? Which is these little gray lines here. Personally, just don't like them, so I keep that off. Crosshair, I keep this gray, so when I'm using this, you can see it's gray. Replay mode, I keep that as a watermark. And then everything else, these are my settings. You can screenshot these. Now, trading. Since I do not trade futures as of right now, I do not need the buy and sell button. So if I keep this on, you'll see buy and sell up here. You do not need that on if you're trading futures. Everything else in here is pretty much default. So I left all of this stuff alone. For alerts, I left this alone as well. And then for events, I left this alone as well. Now, once you're done doing all the settings, you want to come down here to template, save as, and then you just want to go ahead and name the template itself. So if anything ever messed up in the future, you just go back to your template down here and you go ahead and check it. All right, boom. Now your charts is set up the right way with the proper settings, okay? So let's walk you through this entire chart first, all right? So let's go ahead and here's what we'll do. Actually, we'll do it just like this. All right. So first up is going to be back here, right? At the top left, this is where you can start searching symbols. Okay. So if you wanted to search, Apple, you can come in and you can look at Apple. All right. And I'll show you guys how to draw these lines and all that good stuff. But for right now, this is just a demo walkthrough of TradingView. All right. So this is how you type in tickers. If you want to just type in a ticker as well, so if I just type instead of typing anything, it'll also type it in for you as well. So you can do this easily. Now on the cell phone, you do have to click this and type it in or scroll through it. All right, so that is that. I'm going to explain this first and then we'll get into the time frames. So over here, these are just going to be basically different tools. So this is going to be your mouse right here. This is going to be your cursor. These are going to be different lines that you can have set up. So if you want to screenshot these, you can. For me, I just favorite the trend line, info line, extended line, horizontal line, or horizontal ray. So when you favorite it, where do they go? They go down here on this little toolbar, and you can pretty much drag this and put it anywhere on your charts. For me personally, I just keep it down here out the way and at the bottom. So whenever I need something, if I need a horizontal ray, I can literally just come in and do that. All right. Down here, these are a couple other tools that you can use. Actually, I skipped one. Or no, I didn't. This is the right one. Yep. So you got the Fibonacci, right? This is another indicator. We'll go through different indicators that I personally use. Down here, you got chart patterns. You really will never use this. Down here, long and short positions. I use these pretty often. So if I click long position, this is how people are marking this out, where this is your stop loss, right? Or the place where you get out the trade. Let me actually go back. This is the place you're getting out the trade. This is your target. This is your entry. You can, obviously modify these. Now, because I have my magnet on, It's literally attaching to the next candle, but I'll walk you through that too. Down here, these are some other ones I have checked off. So brushes, arrows, and rectangles. I use rectangles a lot when I'm teaching or when I'm trading or certain things. If the market is kind of stuck in a box, I'll write that out and I'll wait for a break of the box depending on, you know, the day and what trade it is. Down here is going to be the text. Okay, I keep this on. I don't really care for these unless I'm teaching. You know, if I'm teaching, I might, you know, do a price label or, you know, a note or something like that. But as of right now, I don't really need that. And then icons, I don't really use these either. All right. Now down here, if you wanted to zoom in, you can zoom in on something, right? If you want to zoom in. For me personally, I just use my mouse. So as I scroll like this, it literally just zooms in and whatnot. Next up is going to be the magnet. So this is how, if you click on magnet, it has a weak magnet and a strong magnet. Okay. What this does is whenever I am using the mouse or whenever I have an, let's say one of these tools right here, so like a horizontal line, it automatically connects to the candlestick. So instead of you having this off and trying to get it to the cent, you can just literally click on this and you can mark out the line exactly where you want it. You can do it at the top of the candle, like up here at the wick, or the body of the candle, which again, I will be breaking down candlesticks to you as well. All right. Down here, this is another one I keep on. This is basically allowing you to, you know, move your drawing. So when you draw on, like, let's say I have multiple monitors. When you draw on one monitor, it shows up globally across all the other drawings on your cell phone and things like that. So I keep that on. So this way, when you're marking your chart on your computer or your cell phone, it shows up on all of your other devices as well. All right. Now, next up, we're going to come down here. So how do you adjust this chart? Right? So first off, down here at the bottom, you can literally just drag this, and this is how you basically squeeze it in. And then if you wanted to zoom in like this, you can do it that way as well. So this is how you change the side to side view. If you want to change the vertical view, you literally grab the other side. So you literally just click and you drag up or down, and again, to your liking. And you can do this multiple times, however way you like. Really all, again, personal preference. Down at the bottom down here, this is going to show the dates and times. Okay, so as I hover over this candlestick right here, notice it says March 30th 2026 at 10 a.m. This is that candle. This is what price did during that time. Again, I will break down all of this stuff as we go. All right, and then it changes as you go over to the left or to the right or left. All right, so this is the dates. Over here is the price. So whatever you're looking at, this is where the price is at. This little label right here shows you exactly where price is of the stock or whatever asset you're looking at. It shows exactly where that price is right now. All right. So this is this. And then next up, we want to break down up here. All right. So these are called time frames. So yours probably won't look like mine when you first open yours up. So all you have to do is, number one, you can add other intervals. Interval is basically a different time frame that you want to add. So if you want to add like a 17-minute or something like that, by all means, you can add it. For me personally, these are the ones that I have set up. I have a 3-minute, the 5-minute. So these are favorites. When you favorite it, it adds it here. So for me, I have the 3-minute, the 5-minute, the 15, the 30, the 1 hour, 2 hour, 4 hour, 6 hour, 12 hour, day, week, you know, month, quarter, year. You can screenshot all of this right now. Okay, give you a couple seconds here. And if you're liking the video, might as well go ahead and just click the sub button, you know. But yeah, these are the time frames that I personally use. Now, are there other time frames that other people use? Absolutely, right? But these are the ones that in this course that I'm teaching you right now for free, this is the different ones I'm going to use. Different time frames, right? Why would I need to have multiple time frames? You have to learn something called top-down analysis. And I'll kind of just leave that open loop for your brain because we're going to come back to that a little bit later. But different time frames tell different stories. So if you never heard that too much before, or again, you're a beginner, I promise we will get into it and it will make sense. All right. So these are the time frames you want to have set up. Over here, this is how you change your candlesticks. Okay. I have friends who use Heikin-Ashi candles, right? And basically how it shows is it looks like this. So when it's green and buyers are in control, it just only shows green. When it's red, right? So if I were to change the color of this, I had it on white before, but you know, when sellers are in control, you just see the candles. Okay. and it's based off price action and the direction that it's going in. I personally don't use those. I personally just use regular candles. Okay, that's personal preference. It's completely up to you. The reason people use Heikin-Ashi sometimes is when you see a shift in the direction and who's in control in the market, it's pretty obvious. Okay, it's pretty obvious. But again, I would recommend sticking with just regular candles. Up here at the top, okay, this is going to be indicators. So indicators are tools that people build, like authors, or not authors, but like other traders or people who code and things like that. They build these tools so that you can use them. All right. Now, for me personally, I even built my own tool. It's called the TSA CKSR Trade Approval System. Now, unfortunately for you, only TSA members get access to this, which is why you should click the link down below in the description. If you do want access to something like this, then yeah, you should probably check it out, right? But only members of TSA have access to this indicator, and for us, it works perfectly with this system. As I go through the charts and as I break down indicators and things like that a little bit later, I will walk you through that. But as of right now, I just want to show you how to actually get to the indicators itself. Up here, you can type them in. So if you like the RSI, you can literally type in RSI and you can favorite it. When you favorite it, it shows up under your favorites, and when you click it, it shows up on your charts over here to the left. So as of right now, I have all of my indicators off right now. If I were to turn on like my personal indicator that I created, you can see my indicator is created. It has this, you know, it marks out levels and things like that. Again, you don't really know too much about it, but there's going to be some other indicators that are fairly important. I'll walk you through those when I do a breakdown on the chart, right? Next up over here, this is how you save your indicators. So if you want to save what your current indicator setup is, you can just save it here. When you save it, it shows up as a template. All right. Now, over here is going to be your alerts. So there's a concept called set and forget that I'll break down. This is basically if you work a 9 to 5 or you're constantly busy, this is setting alerts on TradingView. The really cool thing is when you have TradingView opened up on your iPad or your computer, if you have it downloaded on your cell phone, this will alert you on your phone. Okay. So basically if I have an alert set at 255.50, when Apple crosses that price, I will get an alert that says, hey, Apple is crossing 255.50. I use this every single day. It's one of the most important things. If I take a trade and I have a target on my trade, I just set an alert. So I don't have to sit there and watch the charts all day. Okay. And again, this is why for a lot of you who may be working 9 to 5s or have children or just are a little bit more busy, right? And you can't just sit there and watch the charts. This is why so many traders within TSA are becoming more profitable and more quicker or a little bit faster than the average individual, is because they don't have to take away time from their job or, you know, go do things that inconveniences them. When you take your trade, you just set an alert. The alert goes off. The trade either works or it doesn't, because there's only 2 outcomes of the trade. It either works or it doesn't work. And as I go through this course, you understand the mindset that I teach in. So that's how you set alerts. Also over here on the plus sign, let's say like if I'm hovering on my mouse, I can click this plus sign and I can add an alert right here as well. Or if I want to draw a horizontal line, right, I can draw a horizontal line right there too, which is pretty convenient. You can also type on this as well. So if you want to type whatever here, you can also type that there as well. Now, anytime you double click lines, right, that are on your chart, you can literally pull up the style. You can change the color, right? You can add text to it. You can change the size of the text. You can bold it, italicize it, right? Text alignment, you can add it to the middle, to the right. You can add it to the top right. You can add it to the, you know, bottom, you know, left, whatever way works best for you. Me personally, I just keep it middle right. It's just simpler and cleaner for me. Coordinates. If I want to change where this line shows up, if I want it to be like exact, let's say I wasn't able to do it before. Let's say I wanted to make this at 249.90. Look how it moves it to 249.90. So it's just a convenient way to put it exactly where you want it to go. And then visibility, you can pretty much always leave this the same. Always leave that the same. All right. So that is that. Bar replay. Okay. So whenever you want to back test, there's this thing called back testing where you want to go back in time, right? So basically if I click bar replay and I click start new, it allows me to rewind to the point where I don't see the future candles that are already printed. So a lot of times when you're back testing and you want to test out your strategy or see if something makes sense to you, right? You'll replay it and then say, hey, if I'm taking pre-market highs and lows, right? I know a lot of this sounds like trading-ese. That's what we call it in TSA. It's when you just really don't understand anything too much. I promise, just keep watching. It will make sense. But if, let's say you're taking the first 30-minute candle and you're looking for a break above here or below here, right? And you want to test out your strategy, you know, you can come in and then you can literally click these little forward buttons down here. So you can either click the play button, which will just play every candle, or you can click forward. And every time you click forward, you know, you can actually see it. So if you would have taken this initial entry, it would have probably got faked out. It broke the other side, kind of retested this side a couple times, and then it broke lower, hit your first target, hit your second target as well. Okay, so that's just an example of how bar replay actually works. You can change the speed at which the candles come out when you click play. You can also change the time, right, the intervals. And yeah, and if you want to, let's say you're already edited, like you already fast forwarded or rewinded it, you can literally click select bar and you can start rewind it again from where you are, as opposed to having to click X to take this down. Now, one thing I do recommend is make sure this is not always on when you're back testing. Sometimes people forget and then you're like wondering why the charts aren't moving. Very important that you are seeing the live stuff, right? Next up is undo. So this is basically an undo button. If you did something, you want to undo it, you just click here. Up here, this is your chart layout. So if you want to see the chart in multiple ways, right, you can see them. Now, obviously, this is where my indicators are, but you know, again, I'll walk through that later. So this is how you change your chart view. If you want to have 8 up, you can have 8 up. What do I recommend, right? In the beginning, I highly recommend just watching 2 to 3, right? So you can either have 3 just like this, you can have 2 just like this. If you want to have 2 like this, you can do it like that. Whatever way works best for you, or if you just want to start with 1. I don't recommend having a crowded chart just yet until you get a little bit more experience. All right. Now, if you want to take a snapshot of your screen, you can literally click here. If you wanted to go full screen mode, which will remove all of these, you can click here. And then your settings again is right here. All right. Now over here on the right, this is your watch list. This is going to be where you can build your watch list. At the top, you can go to the settings of your watch list and you can make a copy. You can rename something. You can add a section. You can clear your list, right? You can have multiple different, you know, what is it called? You can have multiple different watch lists with different things on them to stay organized. You can add things to your watch list by clicking that little plus symbol right there. And these other two, I really don't use them as much. So yeah. Again, like I said, down here, this is going to be all information that you can read up on. Again, the only thing that I use when I'm going through this is this part right here, which just shows price, and then maybe a little bit of the news that came out as well. Up here at the right, this shows you all of your alerts. So these are all the alerts that would have went off and the alerts that are still active. And then these last ones, I don't really use these at all, so don't have to worry about those. Okay, you can play around with them if you want to, but not really necessity. All right. Now, down here at the bottom right, ETH, this is extended trading hours. If you don't want pre-market and post-market showing, you just click regular trading hours and it'll disappear. Again, me personally, I keep them on at all times. All right. So, all right, another thing, right? When you're hovering over a candlestick, right? See how I'm hovering here? At the top left up here, this is important to see as well to just understand where the price is. Okay, now then I haven't gotten a chance to show you and break down candlesticks just yet, so keep that in mind. But if you wanted to see the high of the candlestick, which is up here, right? You just hover over it, and at the top over here, it'll say the high number. So the high of this candlestick is 253.35. The L, which is right after the H, is low. So down here, this is the lowest point of the candlestick. It's at 250.18. So if you just wanted to like know the exact low and high of a candle that was already printed, you just read that top part. The O means to open. So I still have to, you know, break down that stuff to you guys as far as candlesticks go. So I'll do that shortly. And then the C stands for close. And then all the way over here, it just shows the percentage gain and how much the stock actually moved. Now, why is this so important? Everything when it comes to trading is all about price and time. What is price doing and when is it doing it? Everything you're going to do when it comes to trading is basically picking a direction on what price could do and in what time it's going to do it in. All right. So this is basically a full overview of TradingView. Hopefully you like it. But again, now we need to just go ahead and switch back to chapter 1. I do recommend playing around with TradingView a little bit, getting a little bit more experience. Again, I will break down, you know, candlesticks and all that stuff shortly. So if you're liking it so far and you haven't left a like, go ahead and do that right now. And yeah, let's move on into chapter 1, which is the visual presentation that I have for you guys. Let's go ahead and knock that out right now. All right, so now that we've broken down TradingView, let's go ahead and jump into chapter 1, which is why most traders end up failing. These are going to be the real reasons, that people end up failing. So the real reason has nothing to do with intelligence or the market being rigged or scam or anything like that. There's actually a couple different things, right? So this is just kind of like a teaser's list. So there's 5 root causes of trading failure for the most part. And that's going to be fear, greed. They're trying to trade, but they don't have a plan. They're an impulsive person. They're just jumping into stuff just because they hear somebody tweeting about it or see the prices going up. So they're just going to click buy. And poor risk management, not really knowing, your risk to reward. How much am I risking to make a certain amount of money? Okay. On top of this, I will be breaking down a real story, how I went from a blown account to a 70% win rate. And again, this course is going to give you everything that you need as far as strategy, discipline, and tools. All right. The things that we don't give you in here is get rich quick schemes and magic formulas, and there's no risk associated, whatever it is, right? We teach everything step by step. All right. So let's talk about why 80% of traders lose money. Now, I know some of you probably are like, let me skip past this. No, you really actually need to watch this more than anything else. It's never the market, okay? It's never the market. The market is going to do what the market wants to do. That's something you need to understand about trading. You have no say-so as to what the market is going to do. You are going to use a system. You're going to look at a chart and have a system and take trades based off your system, okay? But now I'm going to break down why most people fail and how they blow accounts, so hopefully you don't make the same mistakes. It's always one of these 5 things. So the first cause is they have no system, which is why you're watching this specific free course right now. You either A, don't have a system, or you have a system that you don't believe in, okay? So what's going on when they have no system is they're just trading on gut feelings, right? Or a tip from somebody or random signals, which is one of the biggest things that you got to be careful of, right? You're like, even in TSA, like I break down the why behind everything. Like we do pre-market calls Monday through Friday. So I basically get on a Zoom call with everyone, which is normally around 90 to 150 traders. And I break down the charts with you. And then I send you the signals. If you're in a group where they just send you the signal and you're just supposed to take the trade, you're not really learning how to do for self. This is the reason that I created this entire course, is so that you can do things for yourself. The second cause is emotional decisions. They're emotional decision makers. You have to learn how to suppress your emotions. How do you get to that point where you can suppress your emotions? Because you are dealing with money. The first thing is you got to size down. What do I mean by size down? Trade with smaller capital. When you're taking a trade, trade with something that's so minuscule that you just do not care about the outcome. In order to grow your account to the point you really want to get to, you have to learn how to bring that emotion out, that I don't care emotion. Okay? When you're feeling too fearful, you'll make emotional decisions. When you're feeling greedy, you'll make emotional decisions. The goal is to follow your system and your plan. So what do I mean by your plan? Before the market opens, you're gonna already be up before, 1 hour, 2 hours before the market opens. You're gonna go through your charts, you're gonna do all your homework, and you're gonna make sure you have a plan. These are the things that I want to trade today, right? These are the things that I want to trade today. When you have too many emotional decisions that you're making, you're overriding that plan. You're not following that plan. Okay? Let's move on to the next one. Cause number 3 is there's no risk rules. What do I mean by risk rules? When you're trading, you're not risking the same amount of money on your account looking for, a certain return, right? That's what's wrong with a lot of people. They're not doing that. When you're trading, you need to do that. You have to know how much you're willing to lose and then what your potential return could be. If you're not doing this, you're gambling, okay? So they have no stop loss, which I'll be explaining a little bit later, right? They have no position sizing rules. So what does that mean? It's basically like when I enter a trade, these are the rules that I'm going to trade within. And then they're just gambling, okay? And then again, all 5 of these things lead to a blown account. Cause number 4, okay? Wrong position sizing. So they're sizing too big. They're taking trades with too much money. So now what's happening is they're having bigger losses and smaller wins. And you want that to be flipped around. This is why risk management is important. You don't want to have bigger losses than your wins. You want your wins to be bigger than your losses. And even if you lose, all right, so let me rephrase this. Let me say it again. You're losing trades to be smaller than your winning trades. So when you are losing, let's say you lose over and over and over, right? You can still be profitable because you have wins that are bigger than your losses. Hopefully that makes sense. All right. Cause number 5 is they're chasing the market. All right. They're just entering after the move already happened. They see the candle take off without them, or they hesitated on their trade and they're just trying to jump in. This is why most people end up trading. And one of the things I want you to understand is that learning the charts and all that stuff, I'm telling you, probably after going through this, you watch this video a couple times, you go through the charts yourself a couple times, you do some more homework, you'll learn that within the next couple weeks, even couple months. You'll be really understanding of how the market actually works and how the charts work. The hardest thing you need to know about becoming profitable when it comes to trading is this part. It's the emotional aspect. Learning all the technical stuff, learning the charts and stuff, that stuff is easy compared to controlling your emotions when trading with money. That's the hard part. Consistently showing up to your plan, consistently following your system. And even when the system doesn't work that day, not just giving up on it and switching to something else. That's probably number 6. You're bouncing from strategy to strategy to strategy. Stick with one. If you're watching this, stick with this one strategy that I'm going to teach. As long as you understand it and it makes sense to you, right? When I get to that portion of the course, as long as it makes sense to you, stick with it. So this is going to be basically a real journey that you're more than likely going to go through. So I highly recommend watching and listening to this, right? This is how you go from a blown account to an actual system, right? Around 18 to even more months, right? So 18 months is kind of like the bare minimum of when you could start seeing a little bit of profits, right? I'm not saying you're just going to lose the whole time throughout the 18 months. What I'm saying is to really grow that and scale that account, it could potentially take you that long. Now, in TSA, we do have people who are profitable right out the gate, and they're profitable more consistently. But this is why getting the right information is important. Now, am I guaranteeing any of that for you? No. But I am telling you that if you stick with the system, you show up consistently, and you learn how to manage your emotions, you can get there sooner. So you're going to have real losses. You're going to have turning points, right? So here's exactly what's going to happen, right? For most people, the first month, they don't know what they're doing. So they're just trading on tips and emotions. In month 1, they blow their first account. What do I mean by blown account? You literally lose all the money you put in there. Then you go back on month 4, right? And you double down on bad habits. You didn't go back and look at, you may have looked at what went wrong, but you didn't understand and comprehend what went wrong and try to build better habits. So then month 4, you blow your account again. And then in month 7, right, you still have no system. You're still guessing, and you're bouncing around from this YouTube person and this course and all that stuff. Not saying there's anything wrong with paying for courses or anything like that. I paid for quite a few myself. But you're bouncing around from too many. You're learning from too many people at the same time. I'm telling you, this is one of the most conflicting things that's going to happen to you when you're trading, is learning too many systems at the same time. I know you get it, like, oh, this person makes sense to me, but this person, I like this person too. Like, it's too much. The most successful people in the world did one thing. And then when they got so successful at that one thing, they used the money from that one thing to branch out and create other things. The turning point, which is in month 10, which I hope you learn right now, is that instead of taking 10 months to learn this, you can learn it from this one video, which is you need a system. You don't need more trades. You don't need to take more. You don't need to make money. You just need a system that you can consistently show up and follow and understand. Then this is where people end up going into building the system. So instead of you taking 12 months to learn this system, I'm going to teach it all to you. My personal system that I trade is something called the Strat, which I'll be breaking down. I did not create the Strat. It was created by someone called Rob Smith, or named Rob Smith. May God rest his soul. Right? And then CKSR, which is an abbreviation. Again, I will get into both of these shortly. Then this is when you start getting a little bit closer to profitability, right? This is how, I got 70% plus win rate, all right? It just takes months of repetition, being focused on discipline, and just constantly following your plan, all right? So the system is what changed everything, not intelligence, not luck, just repeating the same thing over and over and over and over and over again, all right? And this course teaches you that process from literally scratch. So this is the gap between knowing and executing, okay? This is the gap between knowing and executing. So what you know after this course, you're gonna learn a framework, the right setups, rules to follow, risk management, price action, which is what price is doing, and then how to actually look at options contracts, okay? So this course gives you the entire map. it's going to also show you consistent profitability. So executing under pressure, reading live charts in real time, managing your trades with money on the line, okay? And then building confidence through the reps that you take. So this is why TSA is so important and why I built it. It's live sessions. We have a scanner that we use as well within TSA that I'll kind of show you guys a little bit, maybe a little teaser a little bit later. It's a community of individuals, so we only do open and closed enrollment. So depending on if you click the link down below and if there's even spots open, we would love to have you. But if not, then this is why we do it the way that we do it. You get direct feedback from myself and from my team every single day. And these are real trades, real profits, real losses as well. All right. So this is the execution gap. So here are the top 10, okay, most common beginner mistakes. Okay. So I'm going to break down a lot of these things to you guys when it comes to looking at the options chain. And actually what I might end up doing is I might go ahead and break down the options chain right now. I think that'll be a good segment before we jump into this part. So let's go ahead and move on into breaking down the options contracts, how they work, the whole schwazoo. So let's go ahead and break that down right now before we move on in the presentation. Yo, what's going on YouTube? In today's video, we're going to be breaking down options trading for complete beginners in the simplest and the fastest way in 2025. So if you're a beginner, this is going to be the last video that you need to watch to be able to get into options trading efficiently and the right way. Within this video, we're going to cover 3 different things. 1, what is options trading? 2, how do most people blow their money when they get into this space? And 3, how to not be one of them. So with that being said, stick with me for the next few minutes because the difference between trading and gambling is right here in front of you. So let's get into it. So some of you have probably already heard a little bit about options trading, whether it's through an Instagram post or a TikTok video, but you don't know what it is. You see, options trading gives you the ability to be able to invest and trade in the stock market without having a bunch of capital on the sidelines to be able to play with. You see, options trading is kind of like that safe haven for the average individual who is looking to turn a small amount of capital into a bulk amount of capital. Most people are too frightened to get into the stock market because they think they need hundreds of thousands of dollars to get into the market. Well, if you think that, that's not actually the truth. You see, if you're trying to buy a ton of shares and you're trying to own a lot of a stock, then yeah, you're going to need some capital. But if you're trying to be able to make money intraday, what I mean by intraday is day to day, week to week, month to month, without having to wait a year to get 5 to 7% returns on your money, then options trading is definitely for you. So the first thing that you need to know before you get into options trading is what an options contract is. Well, basically what an options contract is basically an agreement between a buyer and a seller that gives you the right but not the obligation to be able to buy or sell a certain stock at a certain price by a certain date. However, another important thing to understand about this agreement is it now gives you the right to be able to manage 100 shares of that specific stock at a certain price. So for this example, let's just say we're talking about the company Celsius. Let's say Celsius stock is currently at $10. Well, this agreement now gives me the right to be able to manage 100 shares of Celsius. But the first thing you really need to understand about the options contract is these 3 fundamental things. So the first thing you need to know about the options contract is the strike price. Basically, the strike price is where you think the price of the stock is going to get to by the specific date. If Celsius stock price is currently $10, but you think it can go up to $11, then you would get an $11 strike price for Celsius. This means that you're basically betting that the stock will get to $11 by the expiration date. What exactly is an expiration date? Well, it's exactly what it sounds like. This is the date that the contract expires or the agreement expires. So basically the stock has to get to this price by this date or you're going to be losing money. And the third most important thing you need to know about an options contract is something called the premium. The premium is how much it costs to be able to buy this agreement or this contract to be able to manage 100 shares at that specific strike price by that specific date. And congratulations, you are now a professional options trader. You can go out there and make a gazillion dollars. Just kidding. The next thing you need to understand about options trading is something called calls and something called puts. So think of it like this. A call is when you bet on a stock to go up. So when you make a call, your hand is like this. So anytime you hear someone say, oh, I'm going to take calls, think of it like this. They're betting on the stock to go up. But it's the opposite for puts. Think of putting the phone down. You are betting that the stock is going to go down. So let's take the company Celsius again, for example. Let's say the stock price is $10 and I want to bet that it's going to go up to $12. Well, I would be taking a call. Exactly. Great job. You're going to be betting that the stock goes up. So you will look for call options. Well, let's say if you think it's going to go down, you're going to be looking for put options. Exactly. You're going to be betting that the stock goes down. And those are some easy examples to go along with it. So now you always know calls, betting on the stock to go up, puts, betting on the stock to go down. Now, the reason most people get into options trading is because, like I talked about earlier, you can leverage a smaller amount of capital to be able to buy these risky agreements in these contracts that you can go sell at any time, which is another important thing. You don't have to wait to sell your contract by that specific date. You can actually sell it at any moment. So let's say you're betting that the stock is going to go up to $12 like we talked about, and you grab $12 contracts. Well, if it starts to move closer to that $12 target before the expiration date, then your contract is going to be worth more, meaning that you can now go sell this same contract to somebody else at any time. Come here, I'm going to fill you in on a quick secret. Most people don't want you to trade because they themselves are doing the wrong thing. And what exactly are the wrong things? They're chasing trades from Discord groups. They're jumping into trading with a small or a big amount of money thinking they're going to turn it into millions within a few months, or they just don't have a real plan when they execute their trades. You see, these are all the things that you should not be doing, so take note of those so that way you get better than those people who are telling you not to trade. So now that we've covered some of the basics of an options contract, let's now talk about brokerages. You see, a brokerage is where you can actually open up your account with them and place your money inside of and take trades out of. And a few different brokerages that you guys can go through is going to be Robinhood or Webull or ThinkorSwim. So these are easy platforms. Robinhood is going to probably be the most beginner friendly. I personally really like Webull, and then ThinkorSwim is just one that is just absolutely phenomenal all around, but I do recommend you be a little bit more experienced before you jump into that one. Now is actually the perfect time for us to go ahead and open up a brokerage account and show you guys the options chain, which is basically a menu, as if you were going to Chick-fil-A, right? There's like a menu. It's going to be a menu of all of the strike prices, all of the options contracts, whether it's calls and puts, that you can buy with a few other things that we'll explain. So let's jump straight into a brokerage account right now. All right, guys. So now we are inside of a Robinhood account where I'll be showing you guys a beginner friendly brokerage that you guys can start using. And we're just going to basically walk you guys through how to find options contracts and a few of the things that you're going to see on the options chain. So let's jump straight into it. So when you come over to Robinhood, the first thing that you need to understand is that you have to have a level 2 options trading account. There's a ton of different YouTube videos out there. If you guys want me to make one, just let me know down below in the comments and I'll go ahead and make one for you on how to get approved. However, you're going to need that before you actually have the ability to be able to trade options. So let's just say you skip past that and you already did it. Perfect. Welcome back. Right. So the first thing that you're going to do is you're going to basically look up the particular ticker, which is basically the abbreviation or the nickname of the particular company and stock that you're trying to trade. So let's say for this example, Celsius, hello, right? So basically you're going to do is you're going to go over to the ticker itself. You're going to type it in and then you're going to come over to the right side over here and you're going to click on trade CELH options. Okay. Now, once you go ahead and click this, this is going to build you or show you the actual options chain. So the options chain is going to show you a variety of different things as far as information goes. So the very first thing I want to talk about is the up top portion of the options chain. So when you guys are buying options contracts, whether it's, calls or puts, you always want to make sure that you guys are on buy, calls, or puts. So whenever you want to, bet that the stock goes up, you want to keep it on buy, a call. Anytime you want to bet on the stock going down, you want to make sure you click puts so that way you can see all the put options, right? If you come over to sell, this is you selling calls and selling puts, which is a completely different thing. I wanted to make sure this was as simple as possible. So maybe in another video, if you guys want, I can break those down. But for right now, for time's sake and for your own purpose, like I don't want to just overload your brain, right? I want to give you guys the simplest explanations of all of this right now. So with that being said, let's go ahead and scroll to the bottom here. And right now we are on the call options chain. So the very first thing that you guys need to understand is that the share price is AKA the money, right? So what do I mean by the money? Okay. So over here on the right side, right, you're going to see the ask price. Okay. So these are your premiums. This is how much it's going to cost. So remember, you're going to be basically buying 100 shares, right? Or you're going to have the right to be able to manage 100 shares of this particular stock with this contract. So anytime you're looking at these premiums over here, what you have to do is move this decimal over to the right 2 times. So how do we know how much this contract is going to cost? Well, we have to move this over 2 spots, which is going to be $59 for 1 contract. Now up here on the left, this is going to be your strike price. This is basically where you're betting that the stock or the contract is going to get to by the specific expiration date, which you can find up here. So let's kind of go through it together. First off, you're going to have your expiration date. So on this, you're going to see 2 days out, 9 days out, 16 days out, 23 days out, so on and so forth. And the biggest thing about these different expiration dates is if you go further out on the expiration, it's going to be a little bit less risky, but it's going to cost you more money. So the less risky it is, the more money it's going to cost. The more risky it is, the cheaper it's going to cost because there's more risk associated. So that's something you need to understand about the expiration dates as well as the actual strike prices, okay? So like I said, we're going to come over here and look again. We have these premiums here. You're just going to basically move this over 2 times. Okay. Now, this is something that I feel like a lot of people get confused on. So I want to explain this right now. There's these things called at the money, in the money, and out of the money. Okay, so let's first talk about it. So in the money is basically when the stock price has already passed that particular price. So for example, Celsius is currently at $56.58 a share. Well, $56 call options are already in the money. So we know this because not only is the price higher than the actual strike price in this case scenario, but on top of that, the premiums cost more. So it's less risky because it has already happened, right? So it's a little bit more valuable. So when a contract is in the money, that basically means that it's more valuable. When something is at the money, right? A contract that is at the money is say $57. It's literally right there close to the money. So think of share price as the money, and then where this contract or where the strike is whether or not it's in the money or out of the money, right? So at the money is literally right at the same price, very close to it, but it's not all the way there yet. And then you have out of the money contracts. These are going to be contracts that price hasn't gotten to yet. So, Celsius is not at $60, which is why this is out of the money. But this is also why it costs less. So if you ever wanted to learn how to turn a small amount of money into a bigger amount of money, then you can look at something called out of the money contracts and actually trade those more frequently if you have a smaller amount of capital and you want to turn that small capital into bigger capital. Now, another thing you have to understand about options trading is with more risk comes more reward. So that's something else that a lot of people don't talk about, but if you go out of the money contracts, likely you're going to be able to see bigger returns. If you go at the money or in the money, usually see smaller returns, but they're going to be less risky. So this is something important for you guys to understand. Risk level is very, very important. So please mitigate your risk, or at least be mindful of how risky you are as an individual. It will all come down to your personality. So now, for example, let's say we're about to go buy an options contract because we see Celsius is running on the stock market and we want to buy some contracts, right? So let's go ahead and click on the premiums over here. And the first thing you guys need to see is that a contract is equivalent to 100 shares, okay? The next thing we need to talk about is the bid versus the ask. So basically there's 2 different people in the market. There's buyers and there's sellers, okay? So the bid is basically how much the buyers are trying to buy it for. This is the cheapest price that the contracts are currently selling at, okay? The ask is also the highest price that the contracts are selling at. These are where the sellers want to sell at. They want to sell it for the most, buyers want to buy it for the least, okay? Now the difference between these two, from $53 and $59, so again, just move the decimal over 2 spots, right? The difference between the two is called the spread. So this particular contract has a $6 spread, which means if you go and try to get filled at $55, there's going to be people selling it at that price. There's going to be people selling it at $57, $54, so on and so forth. But the spread is something very important that a lot of people ignore. When there is a stock that you're trading and it has a very wide spread, this is a lot of times going to cause a lot of friction with your trade, because let's say you try to jump in and then you get filled at a higher price. What does the word filled mean? That means when the contract actually goes through and you actually spend money on grabbing the contract. Well, if the spread is really large, you might get into the contract at a bad price and you might enter it, and then as soon as the stock moves, you might be down money, right? So this is something important to take a look at. Usually when you guys are trading, a very big tip is to trade stocks that are very liquid. Now, what do I mean by liquid? That means they have tight spreads. There's not really big margins between the spread, between the bid and the ask. So this is something worth noting to write down. Make sure you guys are trading stocks like AMD, Nvidia, Microsoft, Amazon, things like that. Things that a lot of people are trading, which means the more people are trading it, the more contracts that are going from person to person means a shorter spread or a smaller spread. So that's something worth noting as well, okay? Another thing worth noting is, again, this is how much you're going to pay for the contract, which is $59. The most that you can lose on this particular trade is $59 because that's how much it costed you to buy the contract. Now, another thing is you can sell this contract at any moment. So whether you're up $2 or down $5, you can sell it at any moment, okay? As long as it's before the expiration date. So please take that into consideration. Now, another thing is if you click on the actual options contract itself, it's going to bring you up some of these details, which I'll talk about in a later video. So if you guys want that, just let me know down below if you guys are liking it so far. However, the one thing I will talk about that dictates the spread is going to be the volume and the open interest. So basically the volume is how many contracts have been traded or how many of this particular contract has been traded. And then the open interest is how many people are currently in it, how many contracts are currently open at this $57 strike price. And depending on how much volume and how much open interest you have, this will dictate the spread. So if there is a lot of open interest and a lot of volume, then the spreads will be smaller. If there is a low amount of open interest and a small amount of volume, then the spreads are going to be wider. So these are things that you have to consider, and this is how you factor in the spread. And this is something very important that you have to know. So please make sure you guys don't skip this when you guys are into the trading journey and you're actually trading on a day-to-day basis. Now that we've covered a ton of the basics, you are now a lot better than you were before you watched this video. So congratulations to you for making it all the way to this point. But I still have a few other things to talk about. So a couple strategies and a couple things that I wish somebody would have told me before I got into options trading are these as follows. So one of the things I wish somebody would have told me before I jumped into options trading is learn how to master reading a chart. If you're just watching a stock price just fluctuate up and down and you're just taking calls and taking puts, this is why you're going to blow money. And if you don't take this seriously, you can lose a lot of money. So please make sure you guys are paying attention and you're being mindful of these things. But learn how to read a chart. Learn how to find support and resistance. Learn either a certain strategy, whether it's supply and demand or trend lines or the strat. Whatever strategy you decide, master it before you just jump into options trading, because this is the easiest way to lose money. The second thing I wish somebody would have told me before I got into options trading is understand how to have good risk management. If you're going to come into trading, you want to know when to get in and when to get out and how much you're expected to lose. I think the biggest thing is that you have to learn how to be a great loser before you can be a great winner. And the hard thing about that is that most people go throughout life and they fail and then they get upset about it and all these different things. But in trading, this is the complete opposite. Every time you lose a trade, it's teaching you a different lesson. So it's important to actually journal these things and write down why you lost and be okay with losing more often, because it's going to happen. There's no way that it's not going to happen for you. I know some of you watching this like, oh my God, I'm going to be the person that just goes 100% and have a complete win rate and da-da-da-da. That is not going to happen. I'm sorry, I wish it would, but it's just not the case scenario. You got to learn how to be a great loser before you can become a great winner, okay? Another thing is never chase your trades, right? If you look at a chart and you just see it trigger and you already missed your entry, don't just chase and jump into trades. And then the last thing is do not over leverage. Do not come into this when you're emotional and say, you know what, I'm ready to flip, all my money and, completely change my life around and things like that. Never go into trading like this. This is the easiest way to blow an account and go broke. So please do not do that. And then I would say the last thing is do not trade with money that you need. Okay, so if you have to pay your car note or your daughter needs food for lunch and things like that, do not use this money to trade. This is money that's very important. You should have a 9-to-5 or some sort of active income before you jump into trading, because it will make trading a ton easier for you and it'll make it a little bit faster for you to learn because you're not so worried about the money itself. So with that being said, there's things called paper trading out there, which I can talk about later in another video, where you can use fake money. But these are some of the most important things that I wish somebody would have told me before I got into options trading. All right, welcome back. So now that you understand what options contracts are, how they work, this is where we can get back into our presentation where we go over the 10 most common beginner mistakes that people are making, okay? So the first one is buying far out of the money, okay? So when they're buying their contracts, they're trying to get, super cheap contracts and they never end up working out, okay? So this is almost always why these contracts end up expiring worthless or losing a ton of money and are never able to be profitable, okay? The next one is ignoring the bid and the ask. So remember again, the bid is the price that you are trying to buy it for, the cheapest price. The ask is how much the seller is selling it for, which is the highest priced, okay? This spread is important. If you're not paying attention to this and you get a bad fill, if you get into your contract and you get a bad price on your options contract, that can mess up a lot of the trade for you, okay? So you're losing money before the stock even moves if you're buying with spreads that are too wide. Next is they're trading without a defined stop. So again, understanding where to get out of the trade. This is something we'll break down when we really start diving deeper into the charts themselves. Next up is, having small losses, become account killers if they're just not really mindful of the things that they're doing. The fourth one is holding through earnings. So if a company reports their earnings, a lot of times stocks will gap against you instantly. So we'll talk about that stuff a little bit later as well. A lot of traders, okay, if you're trading the first 5 minutes of the day, oh my God, the market is manipulated the most during the first 5 minutes. So you have to be crazy. Do not trade the first 5 minutes. Really, first 15 minutes is pretty dangerous to trade unless you really know what you're doing. The next one, which is number 6, revenge trading after a loss. So when you lose a trade, you got to learn how to close the computer. You got to learn how to walk away, right? So emotional decisions usually destroy entire accounts. The next one after that is sizing up to recover losses. So if you have a loss and then you're like, hold on, let me trade bigger and try to make that back. It turns a small hole into a complete canyon, which is now why you're sitting there like, oh my God, how do I dig myself out of this? Don't do that, okay? Next is going to be, again, not knowing the PDT rule, right? When your account gets flagged, it really kind of sets you back a little bit more. When you're trying to go full size with real money after paper trading, so like when you try to size up heavy and use a bunch of money just because you've been paper trading, okay, your emotional reality is actually different when you're trading with real money, so be careful with that. And then the next one is just quitting within month 1, just completely giving up. Everyone is going to have struggles in their very first month. You're going to have a lot of losses. But again, you just need to avoid all of these, and this will help you get to your end goal a little bit sooner with some less losses. Like, you're gonna take losses. Let's just keep that in mind, okay? So hopefully you guys are liking the whole breakdown of everything so far and all that good stuff. So chapter 2, how the stock market actually works. I don't feel like anyone explains it this simply as far as how far in depth I go into it. So let's go ahead and jump straight into chapter 2. So how price really works is what we're going to be talking about in chapter 2. We're going to talk about SPY, QQQ, and IWM, and the 3 compasses, which is what I use on a day-to-day basis. We're going to talk about market hours, so when it opens, when it closes, and when you should be trading or ideal times to be trading. And then we'll also break down how to read a candlestick, and also have another video where I'll upload in here that you can see a full explanation, a full breakdown again, so that way you can make sure you have full context and you understand everything that is within here. So here is how the market actually works. It's really not complicated. I want you to come into it with that mind frame like, hey, this isn't as complicated as I thought it was, all right? It's thousands of people arguing about the price at the same time. That is literally what the market is. There's hundreds of thousands and millions of people arguing about the price at the same exact time, which is why price, when you look at it, is constantly going up, down, up, down, up, down. It's just people, I think it's going to go up, I think it's going to go down. So they're betting on both directions depending on, their system. So everyone's taking a trade based off of a specific system. So you guys both see the same chart, but one person thinks it's going to go up and you may think it's going to go down. Whoever ends up right, obviously will make money. So let's talk about buyers, right? When the market is going up, right? The reason the market is going up is because you have more buyers than sellers at that time. The buyers are stronger than your sellers. So what I like to look at the market as is every candlestick, right? When we get to that part, I'll explain this. Every candlestick is a battle between buyers and sellers. And whoever wins is what the candle ends up turning out. And that's how you get to understand who is in control. But I'll break that down a little bit later. All right. So 5 buyers are competing for the same stock price, right? Or for the same stock. Price rises to match the demand. So everything that you are looking at when it comes to the market is all based off of supply and demand. Okay. Next up is going to be sellers. So when the market is going down, there is more sellers than buyers, or you also have buyers who are getting out of their trades, which is also selling. So it's adding to that momentum. So that is what is usually pushing the price down. On top of this, emotions and things that are happening in the world, not even just emotions, but things that are happening in the world affect the price, right? So if something really good is happening in the world, right, then the price will go up. If data or information comes out about where interest rates are going to go and things like that, price is going to go up. If we are at war, like how we are right now, depending on when you watch this, right, the Iran and Israel situation and, whatever else in the future is to come, when those things happen, people get uncertain. And when people get uncertain, they tighten up on their money, right? So there's a saying, buy when people are fearful, sell when people are greedy. That's a little bit more of a long-term investing saying, but it is important to understand. When you're looking at the market and the way that I'll break things down to you, it's all about understanding. It's all about comprehension, okay? So 5 sellers are competing to exit positions at the same time. Price falls to attract more buyers. So the market finds the price where buyers and sellers agree. So if there's more demand than supply, the price goes up. If there's more supply than demand, lower price. That's pretty much it, right? This is really the breakdown of the market and how it works. Now, when things are currently or are happening and things like that dictates how price is moving. And this is all called price discovery. So let's talk about SPY, QQQ, and IWM. These are something called ETFs, exchange traded funds, okay? There's also things called indexes, right? And these ETFs are representing the indexes with a couple other things added, right? So these are going to be acting as your compass, okay? So let's first talk about SPY, all right? So this is the broadest market picture when you're looking at SPY, right? It's the S&P 500. What is the S&P 500? The S&P 500 tracks the 500 largest US companies. So when I am trading, I am always looking at SPY, right? Always, okay? You can either look at SPY, which is the ETF, or you can look at SPX, right? Which is, the S&P 500, but also in an index form, right? Or you can look at ES, which is futures. all the same thing. But for options trader, you can either look at SPY or SPX, okay? The next part is QQQ. So what exactly is QQQ? It is also an ETF, okay? So basically think of an ETF as a basket full of different things included in it, right? So in an ETF, QQQ is going to have the top tech companies, right? So this is all about tech, right? So it tracks the top 100 tech and growth focused companies, okay? Now, when we have interest rates changing, these are very sensitive to it. Why? Because in tech, you rely a lot on other people's capital. And if, let's say you take a loan and interest rates are going up, that means you have to pay more for that loan over time. If interest rates are going down, then obviously you can have more loans and you can invest more into the company. And this is why, you see companies grow quicker, okay? Next up is IWM. Now, these are all tickers that you can trade and that I recommend trading and looking at when you are trading in TradingView and through Webull and all those things, right? So the Russell 2000, okay, this is what IWM, it is the Russell 2000. It tracks 2,000 small cap companies, okay? Small cap is the most sensitive to economic conditions. So when things are changing in the economy, small cap companies are getting affected the most. So here's a rule that I highly recommend. You want to check SPY and QQQ first before you take any trade. Why? Because this is a overall compass. So if you try to take a trade on, let's say, Microsoft, right? But you're not looking at what SPY and SPX are doing, or SPY and QQQ. So let's kind of make this make a little bit more sense. I know you still don't know too much just yet, but I want you to see how this makes sense. SPY is the overall market, it's the master compass, and QQQ is the tech sector. Microsoft, which is a tech-focused company, right? Let's say Microsoft is going up, but SPY and the tech sector, which is QQQ, let's say SPY and QQQ are going down. This can cause, what's the word I'm looking for? An incomplete trade or an incomplete analysis. Because what usually happens is when the rest of the market, when the rest of the compass is doing one thing, a lot of the rest of the other companies outside of those will start to follow. So what ends up happening is because you didn't watch SPY and QQQ before taking your trade on Microsoft, and you see those two selling off and you just weren't watching it, Microsoft ends up selling off. So you might have bet on Microsoft continuing to go up, but a lot of times it can sell off. And this will make a little bit more sense, okay? So your priority, you want to look at SPY and QQQ. If all three of them are pointing in the same direction, they have good setups, this gives you high conviction, meaning that, okay, this is a pretty decent trade that I can take. If they're doing multiple different things, right, or they're kind of diverging like this, just kind of be a little bit more cautious, okay? So let's talk about the market hours, when everything opens, or when everything happens, when the market opens, all that good stuff. So again, pre-market is between 4 a.m. to 9:30 a.m., okay? Low volume, wide spreads, right? You can't trade the pre-market hours when you're trading options. The market opens at 9:30 a.m. Eastern time. This is the most volatile range between 9:30 a.m. to 10 a.m. This is the most volatile range when trading. Prime time is around, well, real prime time, about 10 a.m. to about 12, okay, which is lunch. So remember, when you're trading, right, you're also going against other people. So people on Wall Street and things like that, people go on break at 12 at lunch, okay, which is why this midday part is when it starts to get choppy and slow. Prime time is the best time to trade. For me personally, I am trading between the hours of 9:45 all the way up to about 12. That's my cutoff. The only other time that I end up taking any trades is going to be power hour. Okay, power hour is when institutions, right? So what do I mean by institutions? I mean banks, hedge funds, people who are trading with real money. They're called smart money as well. So when I say smart money, it's people who trade with lump sums, hundreds of millions of dollars. So before I continue going on, I want to break this down to you. Me and you, we're called retail traders. And basically what a retail trader is an individual who's trading with less than, a couple $1 million. Institutions are hedge funds, banks, private lenders, or not private lenders, but private money, people who are trading with heavy money, top-notch investors that are private, right? They are called smart money. They're called smart money because they have more money and they tend to be a little bit more smarter than a retail trader. A retail trader tends to know less or have less insights on things, right? So this is when the institutions get active. Remember, this is something important. Whenever you see the market moving a lot, that is institutions. It is not retail traders. It is not us. Your $1,000 or $5,000 or even $100,000 that you're trading with is not making a dent in anything that's going on in the market because there's people trading with way more. And then after hours, you have 4 p.m. to 8 p.m. This is low liquidity. What do I mean by low liquidity? Less orders going in. And again, you can't trade those hours anyways. So a key rule within TSA is you want to trade between the windows of 9:30 a.m. all the way up to about 12 p.m. or even 11:30. That is where 80% of the best setups are going to happen at. Okay. So let's talk about how you read a candlestick, okay? Let's go ahead and play the video first, and then I'm gonna do a quick walkthrough back over this again after you understand how candlesticks work. So let's go ahead and play the how to read a candlestick video, and then that way I can go back over this once again to make sure that you understand everything, and then we'll move on to the next part. So let's go ahead and play that right now. Have you ever opened up a stock chart and asked yourself, what do all of these red and green candlesticks mean? Like, I just wanna trade, how do I do that? Well, in today's video, I'm going to be teaching you guys all of the basics in the most simplest way possible on how to read a candlestick and how to actually read a chart, even if you've never taken a trade or have zero experience when it comes to looking at charts. So you want to sit back and watch this video until the end, because by the end of this video, you will know how to read charts better, what a candlestick is, and how to take entries based off of the candlesticks that you see. So let's get into it. So one of the biggest challenges you're probably facing right now is how to read a chart and understand what's actually going on the chart, which is why we're going to jump into TradingView. You see, TradingView is going to be a platform you want to go ahead and download on your laptop, on your iPad, or on your cell phone, so that way you can actually view these charts in real time. So let's actually jump straight into my TradingView right now and explain everything you need to know about a candlestick, charting, and how to actually understand what's going on the charts. So welcome to TradingView. If you're serious about trading or investing in the stock market, this is going to be a place you're going to spend a ton of your time. So you want to make sure you take the time out to actually learn it. Now, right now, what we're currently looking at is the Apple stock. And right now we're seeing those green and red candlesticks again, right? But right now I want you to kind of think of it as a battle that's going on, a battle between buyers and sellers. And each one of these candlesticks is telling you a different story. So right now, when you guys see a green candlestick, I also want you guys to think of buyers are in control. Whenever you see red candlesticks, this means that sellers are in control. And each one of these candlesticks, like I said, are painting a different picture. So these candlesticks actually have names. This is a bullish candlestick. So think of a bull whose horns are pointing up, right? And then these are bearish candlesticks. Think of bears, they walk on their hands. This means sellers are in control. Bulls mean buyers are in control. So each one of these candlesticks, like I said, is painting a different story. But how do you actually read a candlestick? Well, let's actually zoom in on one right here. So this candlestick is a bullish candlestick. But the first thing you need to understand is what makes up a candlestick. So right here we have the body, and I'll go ahead and outline it by marking out the body. Okay, so let's first explain the body of a candlestick. So on a bullish candlestick, the candlestick opens at the bottom down here, and it closes at the top. So basically, it closes higher than where it opened at, which means buyers are in control, right? So this specific stock, which is Apple, opened at $238.29 on this candlestick, and then it ended up closing at $240.36, right? So buyers won that particular battle. The next thing you need to understand is the fact that a red candlestick, right, is the opposite, right? So we actually opened at the top and we closed at the bottom. So the price during this candlestick opened at $240.66, and then we closed at the bottom of the body, which is $239.53. So this portion that we marked out is called the body, okay? And this is where we opened, this is where we closed. On a bullish candlestick, we opened here, we closed here, okay? Now, the next thing you need to see is something called wicks or shadows, okay? And these are they're going to be those little things at the bottom. So there's different names: wicks, shadows, tails, right? Whatever way you want to explain it, but I'll call it wicks for right now, okay? And this is the highest point that price has went and the lowest point price has went. And this does not change on a bearish candlestick. This is still the highest point that price has went. And then down here, this little itty bitty wick down here, this is the lowest that price has went during this particular candle. So when you're reading candlesticks, I want you guys to remember that, hey, there's a battle going on, there's one party winning and the other one is losing. However, I also want you to understand this: a candlestick is representing price and time. So whenever you look at a chart, you're going to always see different prices over here on the right, and down here it's going to be different times. So the really cool thing about TradingView is that you can look at different candlesticks at different time frames because they're going to tell different stories. Now, I know I'm kind of getting a little ahead of myself, but I kind of want to show you this because it is very important. So up here, this is going to be the different time intervals you can choose from. So you have a 15-minute time frame, which means every single one of these candlesticks is representing 15 minutes of price moving. You have a 30-minute, which is going to be the same exact thing, but now every single candlestick represents 30 minutes of price moving and whether or not, you know, one party is winning or the other one is winning, okay? And then so on and so forth. You got an hour, 4 hour, day, week, month, so on and so forth. And every time frame is painting a different story. So depending on the type of trader that you are, you're going to be using certain time frames over others. So now you understand a bullish candlestick, which is when buyers are in control, and you also understand a bearish candlestick when sellers are in control. You also understand that a candlestick is representing two things: price and time. So when you're trying to read or understand a chart, one of the most important things is to look at the body of the candlestick and how it closes. So what do I mean by that? Let's actually look at an example. Let's take a look at this example here. So when you guys are reading a candlestick, if there is a long wick on one side, this is basically price rejecting that level, right? So think of it as like price really didn't like being down there. The buyers really didn't like when sellers were all the way down here, right? So this candle opens. At first it was red and it pushes and it pushes and it pushes. The sellers are winning right now. And then the buyers step back in and they say, absolutely not, we're going to win this battle. And the candlestick ends up closing green. So the reason this is important is because it shows you who is currently winning that battle. And if you can understand how to read the wicks of these candlesticks, it will tell you a ton of different things about the actual price action. So when I say price action, this is basically price moving, okay? So this candlestick right here, right, would have represented price not liking to be all the way down here, okay? When buyers step back in and it closes like this, this is telling you that buyers are more so in control. We rejected these lows, we pushed up higher, and then we ended up opening and pushing even higher towards the buyer's direction or towards the upside. So the reason this is so important, when you guys are reading wicks or reading these types of candlesticks, they will tell you who is in control, right? So a lot of the times, you know, one of the things that I like to do is I'll go up to a higher time frame, right? And I'll look at these different types of candles. You can also see the types of candles that you are going to get based off of certain levels. So what do I mean by certain levels? I mean support and resistance. Support is basically the floor. So if I took a tennis ball and I threw it at the floor as hot as I could, it's going to bounce off of the floor. If I took that same tennis ball and I threw it up at the ceiling, it's probably going to come back down and hit me in the face, right? So these are your ceilings and your floors. Think of it as when price gets to this ceiling, it is likely to reject or come back down. When price gets to this floor, then it is likely bounce from the floor and go back up. So now that you guys understand some of the basics of a candlestick, it's important to talk about candlestick patterns. So these are different types of candlesticks that actually present themselves during the day while you're trading. So remember, when you guys are looking at candlesticks, this is live battle or live action of buyers and sellers buying this particular stock. Now, with that being said, these candlesticks will look completely different when they close. So this is why I told you guys it is very, very important to pay attention to the close of the candlestick as opposed to only looking at the candlestick while it's live. So right here, this is a candlestick pattern that you guys can go check out on Google, or if you guys want, I can go ahead and send it over to you. So if you click the link down below in the description, there is a free 7-hour course that you guys can take, and this is included in it. And this is for complete beginners. It's 100% free. I have nothing to sell you in this video. So with that being said, you can pretty much just go click the link and grab this and download it straight to your phone if you want. All right. So inside of this candlestick reference sheet, this is going to tell you different types of candlesticks that present themselves, a few of which are hammers, inverted hammers, doji candles, spinning tops, Maribozus, hanging man, shooting stars, gravestones, so on and so forth. So the things that I really want you guys to take away from this video is not only do you understand the candlestick now, but I highly recommend choosing maybe 2 or 3 or 4 of these candlestick patterns and try to spot them when the market is live. And the reason that I say you should do this is because if you can learn how to spot these types of candlesticks, around a key level, whether it's support or resistance, if you can learn how to spot these particular candlesticks, it will make you a lot better trader because you can have a better idea of where price can go. Because at any point in time, when you guys are watching the charts, in order to understand how the chart is going to move or where price can go, you have to look left. You have to look at the past, because at the end of the day, price has memory. If you've never heard of that, well, there you go. Price has memory in a sense where price will likely go back to recent levels that it was at in the past, whether it's from last month, last year, last quarter, yesterday, so on and so forth. So seeing these candlesticks in certain levels will drastically help you understand where price can go. So with that being said, let's get into this reference sheet. So as you guys can see, some of my favorite candlestick patterns to really memorize is going to be hammers, inverted hammers, dojis, shooting stars, and hanging mans. So these are the ones that I personally believe that if you really master them, they're easy to spot, they're easy to recognize. So yeah. So how does a hammer work, right? So this is a bullish signal. So when price is selling off and we're starting to come into a level of resistance, you can tell by the wick. So price did not like being down at that level, and we started to see buyers step in and take back control, and eventually taking full control and pushing back up to the upside. So you are likely to see a hammer around a support level, okay? An inverted hammer, same exact thing, right? You see sellers that are in control, right? When you see this inverted hammer, it is showing you that buyers are taking back control and we swing back to the upside. A dragonfly doji is basically when you have a very, very, very small body at the top, showing you that sellers were in control and buyers took back control. So the reason I'm explaining these things in this way is because it's easier to remember it like this. Think of who's taking control, who's taking back control, or defending certain areas or reclaiming certain areas, so on and so forth, okay? Then we have some spinning tops. So neutral, okay? So a doji candle is going to be one of those ones you're going to see very often. However, when you guys see this candlestick that looks like a cross, it's a very, very small body close in somewhere in the middle. This is an indecision candle. It's basically telling you, hey, we don't know who's in control, so you want to wait until the next candle prints to kind of get a better idea of who is actually in control. So you kind of want to wait until you see the next candle to see who exactly is in control. So another candle that you guys will see very often is a Maribozu. And basically this is showing you like, hey, there's no wicks to the upside or the downside. So whoever is in control right now has extreme control. And the really cool thing that you need to understand about candlesticks is when you see a candlestick that closes like this means they are closing with strength. Like they have full power. The opposite party was not able to have any type of control, and likely after a candlestick like this, it is to continue in that direction. So none of this stuff is 100%. It's just good patterns to see. I wish something was out there that was like 100% right all the time, but that's just not the case, okay? So now let's talk about some bearish candlesticks, okay? So you got a hanging man. You're likely to see this around a resistance level, around the ceiling. This is when buyers are in control. You see this hanging man here, which is a candlestick pattern, and then sellers take back control, okay? There's also a shooting star where price is pushing up to the upside, right? You're likely to see this around a ceiling. When you see this type of candlestick, it reverses, right? Or setting up for a reversal. And then same thing for a gravestone doji. Price then like to be up there. We closed and have a very small body to the downside before we swing back to the downside. All right. So I highly recommend mastering just a few of these single candle patterns before moving on to double candle patterns. So a few of which are bullish kickers, I personally love. Bullish and bearish engulfings, I absolutely love. And then you also have to take into consideration. And then you also have tweezer bottoms, which I don't use as much. So the main ones from the double candle patterns that I personally like is bearish and bullish engulfings, bearish and bullish kickers. So what is the best way to kind of study and master these particular candlesticks? Well, first, I highly recommend maybe getting some note cards and maybe drawing them out and just having the names under it and then the definition of what's actually going on and whether or not it's bullish or bearish. Just keep it super simple, okay? The second way to really practice this and get the hang of this is by trying to spot them in the market. So there's this thing where you can back test, where you go over to TradingView and you just go back in time and you look for these candlestick patterns. So that way you can see how it actually moved after you've seen the particular candlestick pattern. Now, these particular candlestick patterns can happen on any time frame. So remember, when you're on TradingView and you're switching between different time frames, it is basically showing you what price has done between each one of those time frames. So if you're on a 30-minute chart, each one of those candlesticks is 30 minutes of price moving, okay? From the open to the close to the highest point to the lowest point, all right? So this is a very important reference sheet. I highly recommend that you guys check out. So click the link down below in the description if you want to access it. So now that you've made it to this portion of the video, you now know how to read a candlestick. You also comprehend what's going on the charts, and you know that it's just a battle between buyers and sellers, and you want to watch for certain candlestick patterns around resistance and support levels, which is your ceiling and your floor. All right, welcome back. I hope that you enjoyed the full breakdown on how to read a candlestick. I am just going to walk you through it again. One quick thing before I walk you through this again really quick is I did mention something called key levels. I will be breaking down how to find key levels and support and resistance and how it works. I'll be breaking that down shortly as well. So if you heard those words and anytime you hear words throughout this entire course, just understand I will break it down to you to make sure that you do understand. So if you're liking this so far, make sure you hit the subscribe button if you haven't already. Make sure you're sharing this video with friends who want to get into trading or even family members if you really care about them. And yeah, let's go ahead and just do a quick overview of this again on how to read a candlestick. So again, remember, every candle tells a story. So there's the open, there's the high, there's the low, and there's the close. Where these are is important. Here's what each one of these mean. Again, just another quick overview. So a bullish candle is when the price opens at the bottom and closes at the top. This is where price went to. So you went as low as right here and then as high as here in this candle, right? So you opened at this price went down, so sellers were pushing it down, and then buyers didn't like price down here, so they bought it all the way back up and it went as high as here. And then sellers didn't like that and they pushed it back down, or you have some buyers selling their trades or getting out of their trades, and it closes right here. So remember, the high of the candle, this is the wick, so these small little long parts at the bottom and top, it's called the wick. This is the highest price that this is the highest price that's reached. This is the top of this wick, is the highest price that price has gotten to. Down here is the low. This is the lowest price that's reached. On a bullish candlestick, just always remember it opens at the bottom and it closes at the top. So a good way to think of this is that buyers were in control. Think of buy as up, right? Buy is up. Let's talk about the bearish candle, okay? The highs and lows for the wicks stay the same. So this is still the high that the highest that the candle has went, and this is the lowest that the candle has went, okay? But this candle opened at the top and closed at the bottom. It closed lower than where it opened at. Let me say that again. It closed. So we opened here. Price went all the way down. Got bought up a little bit and it closed right here. It got cut off. Okay. This is the difference between a bullish candlestick and a bearish. It's all about where it opened and closed at. So key insights: a green candle, buyers won that period. A red candle, sellers won that period. The size of the body shows the conviction, right? So this is something I've taught about before, which is called the anatomy of a candlestick and truly understanding how to read a candle, which we're briefly talked about inside of that video as well. So a tiny body on a candlestick is indecision. A big body is one side is completely dominating. Long wicks means price is rejecting certain levels, rejecting certain prices. And then price tried to go there and it got pushed back to the opposite direction. Let's continue moving on into chapter 3, options trading explained simply. You will wonder why it, ever confused you. So this is the point of this chapter. So again, I already broke this down in the options trading video. This is just a quick overview and walkthrough again. So I just want to make sure that you understand it completely. So please just be mindful of this. You can maybe speed this part of the video up if you want, but this is just another explanation. Okay. So we're going to talk about calls versus puts. You're going to talk about strike prices and expirations and premiums, how options actually make money, theta decay, right? And why time works against you. And then delta, and then the 5 biggest beginner mistakes to avoid. Okay. So let's talk about calls versus puts. Remember, a call is when you're betting on the stock to go up. It gives you the right to buy 100 shares at a set price before the contract expires. So remember, you're just trading contracts, right? That's all you're doing, trading contracts, right? And whether or not that contract goes up in price or goes down in price is based off of what the price of the stock is doing. All right. So when the price is going in your direction, so remember, think of when you're taking calls, right? You're taking a bet that the price is going to go up. So think of it when you answer the phone, your hand is pointing up. So taking calls means you're betting on the price to go up. When the price does go up, you make money. There's profit. Amazing, right? So you make money when the stock is going up. Let's say you take calls, which is betting on the stock to go up, and the price is going down. You're losing money, okay? That's how it works. A put option, think of putting the phone down, right? You're betting on the stock to go down. It gives you still the same thing, the right to sell 100 shares at a set price before expiration. So a call option is to buy 100 shares. The sell option is to sell 100 shares at a set price before the expiration. So when you take puts, right, and the price is going down, you're profiting. You're betting on it to go down, which is why people love trading so much, is because you can make money on both sides. So when price is going down, it's in alignment with your trade or with your options contract, you're making money. When it's going against you, you're losing money. When you bet on it to go down and it's going up, you're losing money on your contract. Okay? So calls profit when price rises, puts profit when price falls. Pretty simple, right? I know you're probably thinking to yourself, oh my gosh, I can't believe I ever thought trading was just so difficult. This is why you hit the sub button, right? How to read an options chain, okay? So this is basically an options chain we pretty much built out for you guys. So we got calls, which is bullish. So think of a bull. Remember, a bull horn points up. So when you hear someone say bullish, that means there's buyers or they're thinking that it's going to go up. Think of bearish as bears walk on their hands, right? So it's pointing down, pushing down. So puts are bearish, okay? And this is the options chain for both of them. So let's break this down, right? Even though I already broke it down, but let's break it down again. The bid is what buyers will pay. It's usually the cheapest price, or it is the cheapest price. The ask is what the sellers want, which creates this spread. So the buyers want to buy it at this price, but the sellers want to buy it at this price. So where do you buy it at? You can buy it in the middle, right? Or you can choose a direction depending on how quickly you want to get in. So you either want to get in really quick, you can buy it at the ask. So you're going to pay more to get in right now. If you want to wait and pay a little bit less, you could do that as well by buying at the bid. Most of the time for me, I'm buying at the middle price. The last, when you look at an options, this is an actual options chain. So if I pulled up Webull, you will be able to see this exact options chain. So this is literally just like a perfect, breakdown of it. Again, even though I already broke it down, but this is just another, illustration. The last is the last price, right? This is the last price that this contract sold at. The volume is how many people are trading it. The open interest is the total contracts outstanding, meaning how many are currently in circulation. The delta is the sensitivity to price movement. So when price is going up, you're making $35. When it's going down, you're losing $35. All right. And then the other Greeks we broke down recently. So a key call out, only trade options with high volume. Please, I know I already talked about it, but I just want to re-say that again. When you have high volume, you have a tight spread, meaning that the bid and the ask aren't too far apart. When they're huge and you try to get into the trade, you can get smoked. Okay, so liquidity is king. So what that means is the more volume that the contracts have, the more people are trading it, the easier it is for you to get in and out of the trade. A lot of people don't think about that. It's easy to get into the trade, but what about when it comes time to sell for a profit? What if there's no one there to buy it from you? Okay, you want to watch out for low open interest. It means it's hard to exit when there's no one really out there buying them. Okay, you may end up getting trapped in the trade. And then you're like, oh, where do I exit at? And now you're selling it for lower than where you wanted to. The theta, again, this is when, again, the time is working against your contracts, right? So if you have something that has slow time decay or slow theta or lower theta, right, you have more time for the trade to work out. So you have little daily losses. Time is less of an enemy. When you have moderate decay, it's like getting faster. You need to actually watch the trade, decay, which is, again, the contracts losing money, starts to pick up, and you have to be aware of the calendar or the expiration date. And then you have rapid decay, which is like an alarm zone. Like, you got to be careful, right? Panic, time is in the crunch, and you must act fast. Okay. So when you have longer expirations, your options are worth more, right? When you have shorter expirations, your contracts could be worth less. Okay. So key insight, every day that passes, your options loses value when the price doesn't move. This is why we match the day, right? The date to actually get into the trade and the date it expires, right? To the setup time frame, which is, again, we'll talk about that when we break down the charts. So you want to make sure you're using the right tools for the job, right? And we'll talk about that shortly. So we also talked about the delta. This is just a quick walkthrough, right? So for every dollar it goes up or goes down, right? This is how much money you're going to make. The delta is different at different places. So out of the money, or deep in the money, the delta is going to be higher. At the money, the delta is going to be a little bit lower. And then you have out of the money, the delta is going to be different as well. Okay. Remember, out of the money is going to be riskier. In the money, it's safer. At the money is fair. All right. Now, in the money versus at the money versus out of the money. In the money is when your strike price is already profitable. So we already talked about that. The intrinsic value is higher than zero, and it's more expensive but less risky. At the money, strike price equals current price. All right, that means it's at the money. And then you got out of the money when the strike price is not yet profitable. It's not yet in the money. Now, here's the thing. Just because it is not the same, right? Let's say you go out of the money and the price is working towards that price, that strike price, right? It doesn't mean you can't make money taking out of the money trades. You're just looking for quicker moves. So the 5 options, mistakes that cost beginners literally everything, right? Buying far out of the money usually cooks you, right? So cheap contracts need massive moves to profit or quicker, fast moves. This almost always expire worthless depending on, when you're getting in and out. So remember, you can get in and out of trades multiple times. Next up is ignoring the expiration date. Okay, if you're ignoring expiration date and when you're getting into trades, you could really lose a lot of money. Okay, so options lose value daily. If you're not paying attention to the theta, your contracts can get cooked. All right. Next is no plan before they're entering the trade. You got to have a plan. You got to know where you're getting in. You got to know where to get out. You got to know where your targets are at. You got to understand your emotions. Next is going to be over leveraging. When you're playing with too much money, right? This is how you blow an account. So too many contracts turns a small loss into, an account blow up essentially. And then last is chasing the premium, chasing the trade after it already left you. You're buying after the move already happened. This usually becomes a lot of people, especially when they see something running and they're late to the party. So one contract with the right setup beats 10 contracts on a guess. So options contracts, everything inside one contract, right? So again, this is pretty much an overview of everything that comes into it. I don't want to break this down because I don't want to, give you guys more time to sit here and hear the same thing you've already been hearing. But this is an agreement again. So when you're taking options contracts, it's an agreement, which is a contract, right? And we already broke down a lot of these things already. All right. We talked about the bid and ask spread, hidden costs, which is again the spread. and then how options contracts expire worthless, the 100% loss explained, right? So this is just like a timeline of an out of the money call option. So day 30 is the initial purchase. Day 14, you're halfway there. You're losing money. Day 7 is approaching, you're losing even more money. Day 1, as long as the price is not moving towards that strike price, you're losing money every single day. So if it's just sitting stagnant, it's not moving in either direction, you're going to be losing money every day, no matter what. Comparison, right? Stocks versus options. So stocks is giving you ownership of what you're getting or what asset you're buying. Options mean you're holding it for a certain period of time. Okay, so this is why choosing the right expiration date is so important. This is also why you never want to hold contracts all the way to the expiration unless you really know what you're doing. You can always exit it early. And this is why learning the Greeks is so important. And this is why gambling is also a big no-no. Okay. At expiration, okay, scenario 1, you're out of the money. Your option expires worthless, meaning that you lose 100% of the money that you put in. The premium is how much you paid for it. So if it expires out of the money, you're going to lose 100% of what you put in. So as long as you get out before that, you can get out with whatever remains. Scenario 2, you're slightly in the money. You could result in being assigned 100 shares per contract, right? Now that's if you hold it. So remember, you always want to close out your trade earlier, right? Close out your trade before the contract expires, okay? Deep in the money, which in most cases you're going to be closing out for a profit anyway, so you don't have to worry too much about this part. I know it feels a little bit more like, I don't really understand, but I promise you, you'll get it as you're taking more trades, all right? Deep in the money, same scenario, right? Bigger position, 9 times out of 10 your trade is made more money depending on where you bought it at, okay? So again, never hold the options contracts to expiration date. Unless you close it early, so just make sure you close it before the market closes. All right. So why some options are untradeable? It's all based off of liquidity, which is the volume and the open interest, right? So high liquidity options means you have a tight spread on the options contract. It's easy to enter the trade, easy to exit at a fair price. Low liquidity options means that the spreads are wide, right? So notice these spreads, right? You got the spread and then the ask, or I'm sorry, the bid and the ask. It's actually mistyped here, right? But there's really no volume, right? So you only have 2 volume. So with this scenario, the last spread alone means you lose per contract before the stock moves at all, right? So this is a spread trap. You can't even get out of it because there's no one there to buy it. You may not be able to exit at any reasonable price. So this is another thing. So only trade options contracts that have volume. Again, this is why most people usually say trade the Mag 7. Now, inside of this portion, I will be breaking down all of the indicators that I use and what things that I use to trade as a whole. So in chapter 4, just forget about every other indicator you know. Here's what actually helps you predict price. So we're going to talk about why indicators are lagging and inside a candlestick itself, right? Time frame hierarchy. So while we do something called top-down analysis, so you start off on higher time frames and work your way down. We'll also talk about, again, the fact that indicators are lagging, support and resistance levels. I'm going to show you guys how to mark those, and we're going to talk about market structure as well in trading the trend. All right. So let's go ahead and talk about why indicators always lag behind price. So price action is raw data. It is real-time decision-making that's happening between buyers and sellers right then and there, okay? On an indicator, a lot of the indicators are lagging behind, right? So usually you're lagging 2 to 3 or even 4 candles behind, which is like the MACD, the RSI, moving averages. These are lagging indicators, okay? Lagging meaning they're late. Indicators are calculated from price. They tell you what already happened. When you're trading price action, which is why the strat is so important, this is what I'm going to teach you guys. When you're trading the strat, it teaches you what price is doing right now. What are the buyers and sellers doing right now, as opposed to what already happened. Okay, so the rule is you have to learn to read price directly. I'm not saying these other indicators don't work or that they're useless. I'm saying that you have to understand how price actually works. Okay. Indicators a lot of times can bring a lot of noise. You need to learn how price works now. And this is why I'm going to teach you this in this course. All right. So what is really happening inside of a candle? We pretty much already went over this, but again, I'm going to break it down again. The body size shows who won and by how much. So a big green body equals buyers dominated completely. A big red body means that, sellers dominated completely. A small body equals neither side really won. There's a lot of indecision. Okay. The upper wick is where buyers tried to push higher but got rejected by sellers. The long wicks anywhere equal rejection at a price level. And then on top of that, the sellers tried to push lower but got rejected. That's when you have a long wick to the downside. So every candle is a mini battle. Remember, I told y'all that. Learn how to read who won. So let's talk about time frame hierarchy. How do you read the charts and go through the different time frames? Again, I will have multiple sections where we go into the charts and we literally break down everything, right? But you need to understand all of these things first before you just start jumping into the chart. So the time frame hierarchy, right? So the monthly and weekly time frames. This is the big picture. This is where the major trend direction is going to be coming from. It's like the forest view if you were up in like a helicopter or a plane, right? The daily and the 4 hour are swing setups or sometimes intraday setups. What I mean by intraday, same day trades, okay? So you want to go from the monthly and the weekly and then down to the daily and the 4 hour, right? So these are where setups are forming, identifying potential moves. The 1 hour and the 30 minute, depending on who you are as a trader, is like kind of like the entry timing. So if you're taking trades throughout the day, right, you want to kind of be looking at that 1 hour and 30 minute. And then when it comes to entering the trades, I'm using either the 15, the 5, or the 3 minute. Now, when you're entering the trade, I personally enter on the 5 minute. So again, I will break these down as we continue going through this course. So the higher time frames are stronger signals. So always check for the higher time frames first. The lower time frames usually be liars. So if you're only sitting on one time frame, a lot of times you'll get cooked. So support and resistance and how to draw these levels. Okay, so I'm going to go ahead and play that video right now, and then I'm going to do a quick walkthrough of it again so it makes sense, just so you kind of hear it twice from a different angle as well. And then yeah, we'll jump back into this and continue going on. So if you're liking it so far and you haven't already, make sure you go ahead and leave a like and make sure you subscribe. So I'll be right back. What's going on, y'all? In today's video, I'm going to be breaking down how to mark out key levels. Essentially, what a key level is the next place that price can bounce from. So whether you're taking calls and it's, you know, obviously resistance, or you're taking puts and you have support, these are essentially key levels. I want to show you guys how to mark them out. I have nothing to sell you in this video. I just have the hopes that you actually learn something and you execute and you find it helpful. So sit back, watch, and ask questions under this post after I am done. All right. So we're going to start off with Apple. And there's a couple key things that I want to talk about first before we start drawing things out. The first thing is the levels that you're marking out depends on the type of trader that you are. So I day trade options. So I'm going to be mainly looking at the daily and the 4 hour as far as key levels. However, if you're a swing trader, you primarily want to be working out the, you know, weekly, the daily, maybe even the monthly. And obviously it's going to be different for scalpers and leap traders. So I will say that first, I do day trade options. So with that being said, keep that in mind. Okay. So right now we're going to start off on the daily time frame. And the first thing that you want to always identify is that support and resistance is across every strategy out there, relies on some form of support and resistance. So with that being said, what you're looking for is ceilings and floors. Another way to look at this is looking at deep V's. So what do I mean by deep V's? This right here is a deep V coming down, and you have a sharp point to the downside before rejecting higher. This is a deep V. This is a deep V. This is a deep V. And then you have it on the opposite end. This here is a deep V, okay? This here, not as big of a V, but it is there. So these are simple ways for you to just be able to like spot it on a chart. So when you come on here and you look at this chart, you should be able to easily identify levels. So there are also, you know, places where like this, where it comes back and it randomly bounces at a random point. This is also a level of support. So everything about a key level is just support and resistance, and it matters across every strategy that you guys are using. So let's just start marking it off, right? If we were to look at only the deep V's and mark out the most obvious, we start there. So this right here is a level, okay? If you come down here, this is also a level. Now, another key thing that I want to mark out or talk about is having multiple taps. What do I mean by multiple taps? You ideally want to have one or two, or, you know, more than 2 taps, right? So you want to have more than 2 taps. The more taps that a price level has, the stronger the level is. So if I were to come up here, this up here is resistance. This is a ceiling, okay? And then you can look for 2 taps. And then obviously you can mark out all-time highs and stuff like that. Now, what is another form of a key level, right? You got previous day highs and lows. Why are those key levels? Because they're great guidelines of what price has already done. So all trading is looking left. You're looking at what has price done in the past, and can it go back and do the same thing over and over again since price repeats itself. So if I were to come right here, you have another level right here, right? If I were to come here,
you have levels right here. And the biggest and most important thing is don't make this complicated. All you're doing is looking at places where you've topped out and have multiple taps. And then even when you broke higher, you retest it and you're marking out this level when you see stuff like that, right? Once you retest it here, it denied and went back higher. Once it broke through, it went to this next level. And then you're just basically marking these out. And the way that you're using these is targets, right? You're using these as targets. So if you're taking puts, if we break under this level, my target is going to be down here. And if you use the 4-hour time frame, you would obviously have probably some other targets in between here. So you have this level all the way over here that we can mark out. And then we have multiple taps on this target. So the way this will look is say, hey, you know, if Apple breaks under 265.50, it's likely to go to either 260 or 257.90. So where did I get 260 from? Round numbers and psychological numbers are very important. So numbers like 250, 300, 100, so on and so forth. These are all key levels and levels that you want to keep in mind. These are whole numbers. So a lot of institutions, a lot of whales are going to be watching these numbers as well, which is why when you guys are trading options, have you ever looked at the open interest and the volume of the contracts? You'll notice that the whole numbers or the more psychological numbers usually have more people in them. And that is why they're more liquid. It's because it's a key level, it's a round number, and it's easier for people to, you know, look at and say, hey, I want to grab those contracts. So always mark these levels off. You can mark this off. If we come down, right, you have this level down here. You can mark this, and then you're just using these as targets. So a lot of times, especially if you trade the strat, so this is what I personally do. This video is in no means about the strat. If you want to watch a strat video, feel free to go watch the video that's on my Twitter or on YouTube. But if you trade the strat, a lot of times what you'll get is actionable signals around these key levels. And why is that happening? It's because price reacts to key levels, right? So when price gets to a certain spot, you're likely to get either a reversal or a breakout. And when you're looking at the strat and you're trading the strat, there's certain candlesticks that will show you that, hey, this is either a breakout or this is a reversal. So, you know, if we were to look at a few different examples, right? Now, granted, your lines doesn't have to be, you know, this crazy, right? Price had pulled back pretty drastically and I needed to have targets for when price is falling. So, you know, if I were to come over here and look at this, right? 231 right here on IWM is a major level. And essentially, when you guys have these major levels, they give you actionable signals. So this is a 2-2 reversal, and then we went back higher. So let's mark out another chart, right? Let's look at Google, and let's go over it again. So you go up to the daily, right? And then you can do this on the 4-hour. So anytime I have a gap like this, I always mark out the gaps because these are very, very important. So I'm going to mark this out. This is a gap fill. And then how would I mark out the rest of this? So you start off at the obvious, the highest highs up here. And then you can come down and you can look at these, right? This is another deep V, right? So you have this level here where we pull back to. You have this level right here where you have multiple taps here. You just drag it down, right? It does not have to be perfect. That's one of the most important things, okay? This level, right? Let's say you have this deep V here, right? Do you mark off this or do you mark off this? You can mark off both, right? None of this has to be perfect, right? You're just looking for ideal places where price can go to and the next place that it can bounce. So if, you know, if you're looking for puts, this would be a target. Why is this a target? Because this was support at one point in time. So if you're taking puts, you're shorting the market. You're looking to make money on the market going down. If this is the place where we could bounce and go higher, then you want to have this as a target. This is a place where you want to get out. And it's the same thing to the upside. If, you know, this is resistance here, when price comes back up here, you want to take profits here because guess what? This is the same place that we sold off from in the past. So all you're doing is always looking left and then understanding, hey, if I understand how the market moves on the left, or if I understand how this ticker or this you know, commodity, whatever you're trading moves on the left, I have a better idea or a better chance at catching what can happen when it moves to the right, which is when the market is actually active. So you can mark out this, right? And these will be your key levels. So, you know, marking out key levels, very simple. However, they're very, very important. A lot of times, you know, if you guys are trading options, a lot of times people are getting out of trades and not knowing where trades can get to next. This is how I leave a lot of my runners. So, you know, if price breaks under here, my next target is 270. So what I'll do is I'll sell some of my position at this first target, and then I'll let my runners run. So when you guys see me posting, or any of my people in my group posting, you know, 500%, 300%, 1000% returns and stuff like that, it's always runners. It's not the entire position. That's not how I trade. I think it's irresponsible to kind of trade your whole entire position trying to catch these big wins, because when they don't work, it really messes with your risk management. So what I would say is, like, you know, have targets and then use these targets. So if I were to go look at IWM, right? There were multiple times and multiple examples that I can go over the last few weeks on how this worked. So if we were to look here, right, price broke through this level, right, and then we broke lower. This is a key level that you want to watch. So price bounced back up higher, failed to stay higher, and failed to make another high, okay? And then we ended up making the next lower low. So compared to this low back here, this is a lower low. And we broke through a key level to do it. So the way that you will look at this is say, hey, even if you don't trade the strat, right? Even if you were just, you know, a basic strategy of just support and resistance, or just using key levels, all you're doing is waiting for candle closures below or above your key levels. So notice how price came up and it wicked again, but it never closed above this key level. And then when price does end up pulling back lower, right, even this didn't close lower, ends up closing lower, and then it gave you the continuation move. Now, did this happen later in the day? Yes, but it's still a good trade, right? Another key level, right? These setups here came from around this level, but we broke through another key level. So if the market is selling off, right, let's say the market gaps down, and you're looking to say, hey, you know, the market gap down, what's the first thing people are going to do when something gaps down? They're going to, you know, exit their positions, which means it's going to open up liquidity to the upside. It's going to make the move higher, right? So you can say, hey, people who swung puts overnight, the first thing they're going to do is they're going to have a payday and they're going to close out their positions. What's that's going to do is going to lead the stock to going higher. So if that was your analysis and you were looking at market structure in that manner, right, where you're saying, hey, you know, we made these lower highs and lower lows, can we make another lower high, right? Well, then what you would be doing is looking for reversals around key levels. And I only take trades around key levels. A lot of the times, a lot of my losing trades that I've taken in the past have primarily been because I don't know the level and I don't know where my entries and where my targets are at. So in this scenario, you could have looked at this and said, hey, the market's about to open. If I were to rewind this, right? So this is what it looks like at market open. So what you would say is, hey, you know, we have a key level at 233. If we break under and close under 233 on like a 5-minute time frame, then I'll look for shorts. If we break above 234.21 and we close above that, then I'll look for an entry. So then you would drop to a lower time frame. So I will go to a 5-minute, right? And then the market opens, right? And then look what happens. So you get a closure at this line, right? Let's actually rewind this again. And again, this just goes to show this can work with pretty much anything that you guys trade. So you get a closure at this line. What would I do in this scenario? I would probably wait to see if the next candle breaks above this candle if we close right here at this line. So look what happens. Next candle breaks above and closes. I take the entry. Stop loss is down below this wick, or you could just use a 50% stop loss if you're trading options, right? Or 30%, or if you're sizing for 0, whatever works best for you, right? And then you have a target, right? So this is your first target. This is your second target. And look what happens, right? First target gets hit, and then later in the day, your second target gets hit right here. And again, all these levels are just coming from higher time frames, like a daily or a 4-hour, and just marking them out. And it's important to have these because it gives you next levels of where you should be shaving off profits. So I talked about this in a recent video. I only buy contracts in thirds. What do I mean by that? I buy 3, 6, 9, 12, 120 contracts, whatever. If it's divisible by 3, obviously you're buying them in thirds. And the reason that I do this is because I can leave runners a lot easier. So, you know, if I take my entry above here, right, well, my first target, I might shave off 1/3 of my profits. But that doesn't mean I just let the rest of them go to 0. The rest of the contracts, I move the contracts to break even. So that way, worst case scenario, if I get stopped out, I get stopped out at break even and I secured my first third, right? And then let's say in this scenario, right, we're hovering around our first target, and then it makes the second move. Then I'll sell off another third, right? And then you have an extreme target, which is 240. And do we end up getting up there? I don't think so. You just basically let the runner go. And then once you start seeing some downward action or the market structure changes, then you can pretty much close that position out. But this is pretty much how you guys mark out key levels. We can, you know, do another one if this still hasn't made sense for some people. But, you know, let's pull up another ticker. Let's, you know, pull up QUBT, jump up to a daily, right? And I'm just looking for deep V's. So this is an obvious one right here, right? And then if you look left, notice how it just came down and filled a gap. So a lot of times when price fills a gap, that gap line becomes support or resistance. So if a gap gets filled to the upside, it becomes resistance. If it gets filled to the downside, it becomes support, okay? So I will mark this level off right here. This is obvious. I can mark out these highs right here because these are more recent. I can mark this off, and I'm looking for multiple taps, which you guys can see here, right? Then you can come up and you can mark out the obvious ones up here. So you have this level here. You have 1, 2, 3 taps. I can mark out this level here. 1, 2, 3 taps, 4 taps. And then you can come up here. You can mark off this. And you can even mark off this wick all the way up here. Right? And then you go in between. Where's the deep V's in between this price action? Because this is a pretty big gap, right? So I need to see, hey, where's the next price, or where's the next level that price can go to, right? I can even mark off this level. So even if they are very close, you know, it's up to you to leave it or not, but you know, you still want to mark them out. This is a level here. And all I'm doing is I'm looking left first, and then I'm looking to say, hey, we got 1 tap, 2 tap, 3 tap, and then multiple taps in between. So that's really all I'm doing to find these levels. You have this level here, right? And this is just all key support and resistance. So this is pretty much how you guys mark out key levels. Again, when you guys have whole numbers like $15, $20, $25, those are key psychological numbers, which are really, really important levels to mark off as well. But this is pretty much the basics of how you guys mark off your charts. This is how you find key levels, key support and resistance. And if you trade the strat, a lot of times you'll get actionable signals around these setups, letting you know that, hey, we're either going to break above or we're rejecting these highs and we're going to go back lower.
All right, so now you understand how to draw support and resistance lines and how to identify key levels. So we're just going to quickly walk through this once again. So resistance is the ceiling. This is where sellers are appearing at in the market, and this is where price could be getting rejected multiple times, right? This is where you're usually going to see different types of candlesticks at these levels, okay? Support is going to be the floor. So think about it. If you had a tennis ball and you threw it up at the ceiling and it came back down, that is the resistance, okay? If you threw a tennis ball at the floor, right, that is the support. So support is the floor. This is where buyers tend to step in, and this is where price usually ends up bouncing from, which you guys can see in these examples here. All right. And if you guys are liking the examples, definitely let me know down below in the comments, right? But the ceiling is where sellers are rejecting. The bottom or the floor is where buyers are looking to buy. Okay. Key rules. When you're marking out a key level, you want to see 2 or 3 more touches. This is what makes it a real level to identify. The more touches that a price has at a specific range, the stronger the level is. So if it tapped it like 8 or 9 times, it's a really, really strong level. Previous resistance becomes support when it's broken. So if, let's say, you know, you break through this price, it'll come back down and retest it and then move higher. And I'll show you guys examples when we get on the charts a little bit later. So the bottom rule, you only trade at the level, never between levels when you try to trade in here, unless you know what you're doing in between these levels, or you're looking for a certain setups or a break of a certain section and then looking to take it higher. But just trading just to trade in the middle of this, you got to be careful. All right. So market structure, okay, market structure. So this is trends versus reversals. So the market is constantly moving in 3 directions. It's either going up, down, sideways, or rejecting, which is also an example, right? So what is an uptrend? This is called a bullish momentum. An uptrend is when price is making higher highs. So notice how this high or these highs are higher than this high. This high is higher than this high. And it's making something called higher lows. This low, right, or this low, or actually we can look at this one. This low here is higher than this one. So look at it, it's higher. This low is higher than this one. You can clearly see that. So it's basically taking the staircase up, right? So you're creating a series of higher highs and higher lows. So during these times when you're in an uptrend, you want to be looking for buys. You want to be looking for, hey, price came down to a certain level. I'm going to take it all the way back up. Okay? This is called trading the trend. When you're going against the trend, right, you're trying to catch these little quick moves, but they're in this overall trend, they're a little bit more dangerous. Okay? A downtrend is the exact opposite. It is when you're making lower highs and lower lows. Right? So a lower high. So notice how this high right here is lower than this high. This high right here is lower than this high. Okay, this is lower highs. And then you have lows. This low is lower than this low. This low is lower than this low. And a lot of times if you wanted to identify if something was in a trend, you could draw a line going down from wick to wick. So from this wick to this wick to this wick, and then further down. And then you could do the same thing from here to here to here. And once you see the direction, you'll understand what type of trend it is in. Okay? So reversal signals, we'll talk about this a little bit later as well, which is identifying where price is getting to a certain level and about to reverse, right? Or if it's breaking structure and it's changing its trend. We'll talk about that too. Next is, again, choppy or consolidation, when the market is just kind of sitting around, not really doing much, okay? You want to kind of avoid trading those times. Not even kind of, you definitely want to avoid trading low volume or when the market's just really not moving. In chapter 5, I'm going to be revealing the framework that completely changed how I see every single chart. When you watch this part, this is probably the most important part. It is the most important part of this entire course. When you watch this part, you will never be able to look at the chart the same. As a person who came from only trading supply and demand and then going to support and resistance and then finding this, the strat that was created by Rob Smith, changed the freaking game, okay? So this is a systematic language for every single candlestick you read and every single candlestick that is printed, okay? It's gonna go over the 4 different types of candlesticks there is within the strat, and then something called full time frame continuity. What I'm gonna do is I'm gonna play the full video right now. One of the most watched videos I have right now on this particular strategy. I'm gonna play it for you, and it's so good that you might just leave a subscribe. You might just click the link in the description and just join TSA right after watching that. So I want you to watch all of this, okay? I'm gonna play that video, and then we're gonna do a quick run through of it all again. And hopefully you guys are liking this method of how I'm doing this. It's like playing the information, walking you through it, and then, going on to the next thing. So if so, again, leave a like, leave a subscribe. But let's go ahead and play that video right now. Yo, what's going on, y'all? My name is Tez, and in today's video, as promised, I want to break down how you guys can trade the strat. If you are struggling with like supply and demand or trend lines or support and resistance and things like that, all strategies can work, but I feel like for me, it transformed my level of comprehension of what the market is doing. So I'm going to take a stab at explaining this in the most simplest and most valuable way possible. I am not the owner or creator of any of this. I want to give credit to Rob Smith, who is the creator. May God rest his soul. I also want to give credit to the people who learned from him prior. And along with credit to my mentors who I first learned it from. Shout out to my mom for first mentioning it to me a few years ago. Also shout out to iCurlyK for teaching me it, and JR Greatness as well for further explaining it as well. So shout out to all these individuals. Feel free to check them out. They're amazing educators. But today I don't want you guys to have to put in any emails or phone numbers or anything. I just want it to be a raw, uncut video where you guys can learn a little bit about the strat and how to execute it. And hopefully one day, I can earn a follow from you, but you can also execute it at a high level. And, if you want further explanations and things like that, obviously I want you to follow me so I can just give you more game for free, because I think who wouldn't like that, right? So with that being said, let's jump into the charts. I wanted to make sure that I can explain this the best that I can. So what we're going to do is we're going to jump into TradingView, and I'm going to go ahead and delete all the lines, all the stuff. I'm going to even remove all of my indicators that I currently use, just so we can make this as simple as possible. All right, cool. So as of right now, we're just going to leave up the volume indicator and the strat assistant. So I'm going to break down what the strat is, how it works, and why it makes sense. But first, I do want to make sure that, I'll give you guys a disclaimer. I'm not, saying that you guys are going to get guaranteed results and all this stuff. I just want to make sure that you guys understand, do your own due diligence. However, I do want to make sure I give you high quality information. So I'm going to explain it the best that I can, but just want to throw out the disclaimer. I'm not guaranteeing any results or trading profits or anything like that. Okay. So first off, I want to tell you guys how I kind of got into this, right? So when I first got into the market, I was trying to learn trend lines. So back in 2020 is when I started doing long-term investing from scaling my brands and my businesses. I started to put money into the stock market around the time of COVID. And that's how I was able to scale like my net worth and things like that, right? Then in 2021, like middle of 2021, end of 2021, I decided to jump into day trading. And, I tried to binge watch all the YouTube videos. I bought the courses. I went into the Discord groups for signals and things like that, and ended up blowing over $20,000. And yet I still couldn't understand what was actually going on the charts. So I took a break from trading, came back to trading, took another break, came back. Long story short, I ended up moving over into supply and demand. And I felt like I wasn't getting as many setups, and they weren't really like making sense to me, right? So all these different strategies, granted they work, granted I might just be, you know, I don't know, whatever, right? I didn't have the highest GPA or nothing like that. I'm not the smartest person. But with that being said, I came over to the strat, and, you know, when my mom was breaking it down, then I learned from iCurlyK how it works. And, you know, then I start going down the rabbit hole of like, okay, I need to understand this to another level. So with this video, I hope to give you all of that perception of the strat in this one video. So I just wanted to explain how I came about it, and all the people that, you know, obviously helped me. Now, with all of that being said, the strat is a way of trading, right? So number one, the strat is a way of understanding price action and time. So the very first thing I want you to think about when you come over to TradingView or you look at any chart, right here on the right side, you have the prices, and then at the bottom you have time. So in trading, right, or any market where it involves, you know, assets being traded back and forth, it's always based off price and time, right? Now, when you're reading the strat, right, a lot of people will be like, oh, you don't need these numbers, you don't need all these indicators. All I know is it works, right? And at the end of the day, when you understand it, I think it'll work for you, and I think this will be something that will completely transform your trading. So the very first thing is, again, understanding what the strat is. It is a way of reading candlesticks. So the problem that I used to have was understanding and comprehending what the market was doing. Well, now I can understand what the market is doing, and if you combine key levels with what the market is doing and what price action is doing, it'll make things easier, right? So the very first thing I want to explain to you guys is the anatomy of a candlestick first, right? So first off, before I explain the strat, right, and how it works and give you the full breakdown, you first need to understand a candlestick. Now, granted, if you guys already know a lot about this, feel free to just skip ahead, but I do want to explain this because it is very important when looking at the strat and reading candlesticks. So let's say we take this candlestick right here, right? This is a bullish candlestick. We all know that these things at the top and the bottom, these are your wicks, okay? This is the highest and the lowest point that price has been in that particular time interval, okay? When you're looking at a green candlestick, right, or a bullish candlestick, right, we know this is the body, right? So this is the body and this is the body. All bullish candlesticks open at the bottom and they close at the top. Okay, so it opened here, price came up, and it closed here. Obviously, it did a lot of different stuff in between it, but we all already understand that. When you're looking at a bearish candlestick now, right, we know we already have our wicks. It's the same for both, right? Both candlesticks, whether it's bullish or bearish. But we know on a bearish candlestick, we open at the top and we close at the bottom. So we closed lower, which is why it's a red candlestick, right? Price went down. So now that you understand the anatomy of a candlestick, right, now let's go ahead and turn on the Strat Assistant. So this is the indicator that you guys can turn on in TradingView. It is free, so you guys can check it out. If you come over here, you type in Strat Assistant. It's by Ricky Z. Carroll. Shout out to JR for putting me on to this indicator. I didn't realize so many people traded it, but this is the one that I personally use, okay? So let's start explaining the strat and the candlesticks and all these numbers and colors and things like that, okay? So I think to make it the simplest, right, we'll start one by one, okay? So I'm gonna zoom in here so we can see it, okay? So the very first thing is a 1, right? So how do I wanna explain this? The best way to do this is, let's take me and you for example. My name is Dontez, but I go by Tez, right? So that's my name and my nickname. Well, when you're reading the strat and when you're talking strat talk, right, you need to understand the different nicknames and names. So that way, if someone says an inside bar or an outside bar, you know what that means. So I'm going to explain that to you right now. Okay. So this candlestick is called a 1 bar. That's its name, but its nickname is an inside bar, right? And the reason it's called inside bar is because notice how this candlestick, right here, this is the bottom of the wick. This is the top of this wick, right? It is inside the previous candle. So when you guys are reading the strat, it is always based off the previous candle. And the one key thing I love about the strat and just overall trading in general is you have to look left in order to understand how you move right. If you understand how price action was before, or if you understand certain levels before, 9 times out of 10, they'll react to these same levels later down the line when the price is moving to the right, when price is active, right? So shout out to Wall Street Trapper for, you know, that analogy. I really like this, so I want to give him credit, right? Now, this inside bar, right, is inside of this previous candle. So notice how this wick at the top and this wick at the bottom, this whole entire candle is being swallowed by this one, right? So that is the first thing you need to understand. When I say an inside bar, it is basically inside the previous candle. So every one of these candles that you see is being read based off the previous candle. Good? think that one's fairly simple, right? So this is an inside bar. What does this mean though? This just basically means consolidation. It means choppiness. It means price action isn't in a direction. It isn't moving in a specific direction. It isn't like volatile, or it's not, directional. So that's an inside bar. This is also known as an actionable signal. We'll talk about actionable signals later, but I just want to make sure I put that out there, okay? So we have ones, right? And all ones are the same. As long as it's inside the previous candle's high and low, right? It's a 1 bar. It's an inside bar. Nickname and name. Good. Next up, let's talk about twos, okay? So these are twos. So here's the thing you need to understand about a two. Name of this candlestick is 2, and its nickname is a directional bar, right? Or, if you want to flip-flop them, directional bar, a 2 is the name, right? Now, there's 2 different types of twos. There's a 2 up, and then there's a 2 down. So a 2 up, obviously, is a bullish candlestick, and then a 2 down is a bearish candlestick, and all of it is relative to the past candlestick. So when you read this candle, it is based off of this. When you read this candle, it is based off of this. So let's further explain this, right? So when you're reading these candlesticks, right, we understand that this candle opens at the bottom and it closes at the top. So the reason this is a directional candlestick is because bulls are currently in control. Buyers are in control. And when this candle opens, right, it opened and then it pushed above the previous candle's high and then it closed above it. So when this happens, it creates a 2 up. So let's take a look at the 2 down though, right? So this candle opens here, it pushed up a little bit, it came back down, and what ends up happening is it broke the low of this candlestick. So when it breaks the low of this candlestick, it now creates a 2 down, and then as long as it closes below this point, right, or below the open, right, this is a 2 down, okay? So these are directional candlesticks. This is showing you who is in control at that particular time, okay? So hopefully everything is making sense. If you need to rewind this, feel free to. But yes, this is a inside bar. Now we talked about 2 up and a 2 down. These are directional, so we know who's in control, right? And now let's move on to threes, okay? So let's actually zoom out, and a better example to show is, okay, let's take a look at this candlestick right here, okay? So this is a 3 bar, okay? So this candlestick is called an outside bar. Its name is an outside bar, right? But its nickname is a 3 bar. So whenever you hear people talking about this on the strat, or, all these different things on Twitter and things like that, this is the terminology, and this is why it's important for you to learn. So if you haven't already, take some notes. You probably want to watch this like 2 or 3 times just so everything makes sense, okay? So if we know the strat is based off of reading the past price action, the most recent candlestick, right? Well, then I know that this outside bar, the reason it's outside is because when this candle opened, it broke below the previous candle's low, and it broke above the previous candle's high. So it broke both sides, right? And this is why it's a 3 bar. Now, a 3 bar is showing volatility, right? It's showing that, hey, we broke one side and we came back to the opposite side of the previous candle, right? Showing strength, right? And we broke past it, okay? And this is a 3. So regardless of, where it closes, right? So this is a 3 up, and you can notice this by the green outline around it. So the really cool thing is if I go ahead and turn this off, this is a bullish candlestick, but the purple, right? When you turn on the strat assistant, is kind of like being highlighted by the green. So we know this is a bullish 3, right? There are bearish 3s like this one where it has a red outline around it because it closed lower than the previous candle. All right. So again, like I said, if none of this makes sense, rewind it, right? But if everything is making sense, make sure you guys leave a retweet and leave a follow, okay? So now we understand 1s, 2s, and 3s. We know a 1 is an inside bar. It is inside the previous candle's high and low. We know a 2 up is when the candle breaks the previous candle's high. We know a 2 down is when we break below the previous candle's low and we close lower, right? So all of this stuff is based off where we broke above and where we're closing. And that's why I wanted to go over the candlestick anatomy of where candles open and close so you understand that, okay? Now, here is one of my favorite candlesticks, right? So we talked about 1s, 2s, and 3s. That is like the foundation. But now let's take it to the next level, right? There are something called failed 2s, right? And I'm going to explain this the best way I possibly know how. It is basically a bull or bear trap, okay? So the way you read this, right? So notice how, I'm gonna turn off the indicator again. So this candlestick is a bearish candlestick, right? This is a bearish candlestick. So, but when you turn on the Strat Assistant, it is green, right? The reason it's green and it has a red outline around it is because at one point in time, right? So we know that a bearish candlestick opens here and it closes lower, right? But in this particular candle, right, the candle opens right here. So we'll go ahead and mark this out. So we opened here and then we pushed up. So we pushed past the recent candle's high. And at one point in time, we were a 2 up. We were just green, right? Buyers were in control until sellers took back control, right? Making the candle close down here, which means it failed to stay higher, right? So when you say, when you look at a failed 2 up, just think of it as it failed to close higher. So basically buyers were in control. They lost control. The bears kept control. That's the best way to think of a failed 2 up, right? It is when the candle opens, it breaks the previous candle's high, but it can't close above it, right? It can't maintain that atmosphere. So it falls back through because sellers took back control, or buyers started liquidating, whichever one happens, right? And then the candlestick comes back down and it closes lower than where it opened. This is what makes it a failed 2 up, okay? Hopefully that makes sense. This is basically like spotting reversals, right? So the reason I love the Strat is because it's giving you multiple different ways of reading the chart and understanding what price is really doing. Like, back in the day when I was trying to learn all these different strategies and all this stuff, I didn't really comprehend what was going on. But when you learn the Strat and you really truly like look at this and you reread it, and I'll go over some examples with you guys, it makes so much sense why things happen around certain levels. Like, if you're around previous day highs, and you get a failed 2 up, that means you're rejecting that level, right? Previous day high, previous day low, those are key levels. Those are forms of support and resistance. So if you get a failed 2 up around a key level, right? This is showing that, hey, we broke above, but we couldn't maintain it, right? So 9 times out of 10, we're gonna come back down. And this is how you're able to read, and when you're options trading or doing any other asset trading, right? This is how you can read what price is really doing. And I feel like this is one of the best ways to trade, in my personal opinion. Okay, so we talked about failed 2 up. Now let's talk about a failed 2 down. So this is now on the opposite end. It's the same exact thing. So let's see if we can find a failed 2 down. Okay, so this is a failed 2 down right here. All right, so let's take a look at this. So this is a failed 2 down. Okay, so how does this work? So we know that if we turn the Strat Assistant off, right? We'll leave that on. If we turn the Strat Assistant off, this is actually a what? Bullish candlestick, right? This is a bullish candlestick. We opened at the bottom and we closed higher. That's how we know it's bullish. But when you are reading the Strat, okay, it is red with a green outline around it, okay? Now, here's the thing. This candle, yes, it opened and closed higher, but there was more that went on. This candle opened, it broke the previous candle's low, right? Showing that sellers were once in control, right? And then the buyers stepped back in at this level around 570.40. We stepped back in and we made the candle close higher than where it opened. And this is showing you that bulls took back strength, which is why the next candlestick is also green, pushing up, because bulls are in control. They stopped it from going lower, right? So we failed to go lower. We failed to close lower, right? Buyers step back in. They have control. Next candle opens. They keep the control, right? So these are your failed 2 ups and failed 2 downs, okay? If you need me to further explain it, let me know. And if any of you watch this and you trade the Strat and there's things that I'm missing or I could better explain, feel free to leave it down below in the comments to help another trader out there. Because at the end of the day, my goal is just to help someone who is trying to, trade, okay? So now that we understand 1s, 2s, 3s, and 4s, we know that everything is based off the previous candle, right? We understand consolidation. We understand volatility, right? So we broke higher and then we went lower, which is showing us that bears are in control, right? This is an actionable signal. So let's start talking about actionable signals, okay? So an actionable signal is exactly what it sounds like. It is a something that you see and you take action on, right? So for example, a 3, right? So I'll just give you guys my favorite actionable signals is a 3 bar or failed 2s. I either want to trade volatility or I want to trade a reversal, right? And, for the most part, this has been working really well for me personally. I don't know for everyone else, but it has worked pretty well for me, right? So what does it mean when you see a 3 bar and you're saying it's an actionable signal? Well, if we were, let's go to more recent times, right? Let's just come over here. So we're on QQQ right now, right? And this is a 3 bar, right? So we opened, we pushed higher, we broke the previous candle's low, and then we closed lower. This is a bearish 3, okay? So the way you understand that this is an actionable signal, right? This is volatility. We want to trade volatility, at least I do, right? I am a momentum trader. I want to trade where the volatility is at because that's where the move can happen. So what you're gonna do is you're gonna mark the high and the low of this candlestick like this, right? This is an actionable signal, meaning that I'm looking for something to happen after this candlestick. I take action on this particular candle. So the way it works is when this candle prints, the next one opens, and if it breaks lower, right? This is called a 3-2, right? This is called a 3-2 continuation. I'm gonna give you guys like a strat cheat sheet. Shout out to Sarah Strat Sniper. There was a Twitter post that I don't know where it came from. I just know it was on Google and I really like it. And I think you can use it as well. And I think you'll find a lot of use of it, right? So basically the way it works is you mark out the high or low of an actionable signal, which is a 3 or a failed 2. A 1 is also 1, but I don't trade those as much anymore, right? Maybe in the beginning I was doing it a lot, but me personally, I like to trade 3s and failed 2s only. Just my personal preference. You'll build your own system as you go, okay? So you mark out the high, you mark out the low, right? And then when this candle breaks below, right, you take an entry, right? So let's say, QQQ, the market opens, we flush, this is a 3 bar, this is an actionable signal, right? So what I'm saying is, okay, I'm gonna mark out the high and the low. If we break above, I'll take calls or I'll take buys, or I'll go long on the market. If we break below, then I will short the market or I will buy puts, right? And this scenario would have worked out for you, okay? So this is called a 3-2. So the really cool thing about the strat is that they have these different combinations, and I get it, right? You're watching this video and you're like, bro, trading doesn't need to be this complicated, but I just think it's a level of comprehension, right? If you understand this and if someone explains this at least as easily as I am, hopefully I'm doing that, then you'll understand like, wow, this is game changing for me. And I think that I can execute this at a high level if I just practice and I get more reps in, right? So this is a 3-2 continuation. Now, a lot of times what will happen is when there is a directional candlestick like this, right? A lot of times what they'll do is they'll continue in that direction, right? So notice how you have a 3-2 and then it's followed by another 2 down and followed by another 2 down and followed by another 2 down and another 2 down. So had you taken your shorts or your puts at 569.79, right? And you just held it, well, this is probably, from 565.79 to about 558. Let's say you close, in one of these 2 candlesticks, right? Well, this is probably about 200-300% in the beginning of the day, depending on how far out of the money your contracts are, or depending where your contracts are. So from getting in here to catching this move, right? And the really cool thing is that this works on all time frames. So if we were to go up on a 1 hour time frame, look at this, right? You have a 3 down, right? And then you have a 2-2-2 continuation. So had you just been watching the chart and had you understood the strat and you understood, what happens with continuations, you would have been able to catch some of this move. Now, obviously on a higher time frame, there's less noise. So obviously there's going to be a lot of different price actions, price action going on in between, these candlesticks on lower time frames. But when I trade, I usually watch higher time frames so I don't get juked out of my trades, and I mark off key levels so I know when to get in and when to get out and when to take certain trades, okay? So let's talk about another actionable signal, right? A failed 2. Let's take a look at this. This is again on the 1 hour time frame. So an actionable signal is you take action, right? So granted, yes, a failed 2 down is an actionable signal. Had you taken calls above here, let's say the candle, you mark off the high and the low, and this, this candlestick opens here and it pushes up, and then let's say, it doesn't continue going in that direction. So here's the thing, nothing always works, right? There's things that work sometimes, and your level of execution and your risk to reward ratio is what will allow you to become successful over a period of time as you get more reps, right? So you did end up breaking higher, right? And you might have taken calls and you said, oh, well, I mean, this still paid you about $1. So you may have gotten like 30, 40%, nothing too crazy, right? However, if you notice where we're at, right? Let's go ahead and mark out the high and the low of this candlestick. Well, one thing to notice is that we're around a key level. What do I mean by that, right? We're around a psychological number, which is 575. And normally around psychological levels or key levels, like I said, previous quarter highs, previous quarter lows, things like that, a lot of times you'll get actionable signals around these levels because remember, institutions make up the market, right? These huge candlesticks are institutions, right? So these are the people buying and selling at mass levels or with a bulk amount of money, right? So with that being said, right, you mark out the high and the low. And if I understand that institutions are making up majority of the moves, right, then I want to also understand that, hey, around a key level, they're going to be making moves because they know that retail traders are also going to be just taking trades around these levels as well, right? So this is a fail to up, right? Had you taken the break below the fail to, which is an actionable signal, you would have had a 2-2 continuation. So we failed to go lower, we failed to go higher, and now who's really in control? The bears. And they proved it by taking control the rest of the day. Okay, let's go to another example. Okay, so had you been watching QQQ off the 1 hour on this day, right, you would have seen a fail to down off the 1 hour. So this is at 10 a.m. You mark out the high and the low. When the next candle opens, right, you take your calls and look what happens. And now here's the thing, it's not always this simple, it's not always going to be pretty, and I'm not saying that when you start looking at it like this, it's going to work out like this every time for you. No, I think when you understand risk to reward ratios, I think things will get a lot better for you. Okay, so this is overall the premise of the strat. This is how you read these candlesticks. You got 1s, 2s, and 3s. Now let's move over to this cheat sheet right here. So we're going to go ahead and do that and we'll open this up, right? So this is the strat combos cheat sheet. You guys can feel free to Google strat combos and you'll find it there. But this is all the different things that can happen. So a 1 bar, right? What happens with a 1 is that you can take the break of the high or the low of a 1 bar, right? So notice how, let's say we're looking at a 2-1-2 bullish reversal. See, so these are all the names of the combinations. These are all the different things that can happen with a candlestick. So a candlestick can only do 3 things. It can break above, it can break below, or it can consolidate. It's the same thing as the market. We can make higher highs and higher lows. We can make lower lows and lower highs, or we can make equal highs and equal lows. It's market structure, right? So when you're understanding the strat, you're understanding market structure as well as price action and, you know, time of when trading, right? Or time when you're seeing price action as well, right? So you have a 2-1-2 bullish continuation. So you have the recent candle, right? This is a 2 bar, this is a 2 up. And then you have a 1 bar. So the way it works is when this next candle opens after a 1 bar prints, you can take the break above it and you would target the recent candle's high, right? It will also work on the opposite end, right? So this is a 2-1-2 bullish reversal. Let's say this candlestick is bearish, right? It's a bearish candlestick. Then we consolidate and then buyers take back control. So you would enter when this candle breaks above the 1 and then your target would be this 2 over here. Okay. This is a 3-1-2 bullish reversal. So this is a 3 bar down. We consolidate and then the next candle opens. It breaks above the previous candle, which is a 1. And now you target the 3, the high of the 3. Okay. So there's a bunch of different combinations as well. So like 2-2 reversal, this is basically when a candlestick is bearish and then the next candle opens and it reverses. So the really cool thing about trading the strat as well, you can spot reversals, you can spot, you know, all these different things, you know, continuations, volatility moves, explosive moves. You can spot all of it based off these combinations. Me personally, what I would say is find like 2 or 3 of these that you really like and stick with them. So me, I've learned that I only like failed 2s and 3s. So I don't take 1-2-2s, or I don't take, you know, 2-1-2s. I don't take those, right? Because that's not a part of my trading plan. I stick with what works best for me personally. So in this cheat sheet, again, all of this works on all time frames. So let's say you go up to the 4-hour time frame, and let's say that you like to let's go ahead and remove all these drawings. let's say that you are actually, let's go to an even higher time frame. Let's say that you are a day trader or a swing trader, right? You know what I'm saying? You can use this for swing trading. You can use this for, any other case scenario, right? So this is a 2, 1, 2 reversal, right? So basically how it works is you will mark out the high and low here of this candlestick on the daily time frame, right? So you had, if we were to read this, right, you had a strong move higher. We followed up by a sell-off. We're starting to see some consolidation, right? So this is just a lower high in the grand scheme of things. So we've seen some drawdown, but this is just a lower high in the grand scheme of price action over a period of time, right, on higher time frames. And then when you mark out the candle, this candle opens, pushes up, you take calls or you take buys, and then you would target here, and then your next target would be in here, or you can use recent support of other wicks and things like that from other candlesticks. So yes, this is pretty much the strat. Another thing worth talking about as well that is very, very important is something called full time frame continuity. So when you're looking at the strat assistant, the really cool thing is it'll show the 30-minute, the hour, the 4-hour, the daily, week, month, and quarter. It'll show what color they are, right? So if I were to go to the week, that means we're bearish on the week, right? So you go to the weekly time frame and it's bearish. But if you're on lower time frames, the reason this helps you is because if you are in alignment with the higher time frames, 9 times out of 10, or I would say 8 times out of 10, price action will continue to follow suit with the higher time frames, right? So a lot of times I'll chart higher time frames, and then I will go down to the lower time frames, because if an actionable signal, right, let's just say, something that we do in my community a lot is, we'll use the 4-hour or the 6-hour or the 2-hour, right? Well, let's take a look at this. This is, this is the move that you could have caught for when Powell was speaking on Friday, right? So this is Friday. And if you looked at the 2-hour time frame, you have an actionable signal. It's a 3-bar. So we know that this candlestick right here, it opens at 10 a.m. So this is an 8 a.m. candle. This is a 10 a.m. candle. And notice how at 10 a.m., right, when the candle opens, we break above the 3. And now we have this super explosive move that paid a lot of people in my group, okay? So with that being said, these work across all time frames, whether it's the monthly, weekly, daily, 6-hour, 4-hour, 12-hour, 30-minute, 15-minute, 5-minute, it all works. It depends on, your ability to factor out the noise when you are on those lower time frames. But yeah, this is pretty much the strat. I really hope that this was able to help you. Full time frame continuity, when you guys are taking trades and all of them are green, it's like, hey, this thing is moving in my direction. It's not saying that you're not going to see some red candlesticks, but it's just basically saying you are in the right side of the trade. If they're all red, what I'm saying, you're on the right side of the trade. If you're in puts, if you're in calls, you're getting smoked. Just putting that out there. But yeah, so hopefully this explains 3s, 2s, failed 2s, and all these numbers on your chart. If you guys really like this video, make sure you guys leave a follow. One of the biggest things for me is there's no opt-ins or phone numbers or anything like that. So if you want to take this video and share it to your groups or whatever, feel free to. I'll probably throw it up on YouTube more than likely as well, just to help other traders out there. Again, disclaimer, I'm not guaranteeing you any results or anything like that. Yeah, if you like more stuff like this, you want more educational game on trading and just being in the stock market, feel free to hit the follow button and make sure you guys leave a retweet so we can help another trader out there who's struggling with being in the market, because I truly believe it is a life-changing opportunity that anybody can take advantage of, regardless of skin color, religious beliefs, and whatever else is out there that could be different from another person. And I think that is life-changing. So hopefully I was able to provide you with some value. I know that this video is 31 minutes long, and I didn't want to do you any disjustice by making it something that's super compact and just straight to the point, but you still didn't understand. I just kind of wanted to make sure that I explain things to the best of my ability, and I really put my best foot forward with this free educational video. So how did you like it? How do you feel after knowing the strat? We're going to go through multiple different examples together on the charts. So there's a section where we're like literally just going through charts and stuff like that, maybe going through different trades, so on and so forth. So again, as I'm going, I'll continue to just do my thing, but this is just going to be a quick walkthrough of everything you just learned once again. So a 1 bar is also known as an inside bar. It is when a candle is inside of the previous candle's high and low. So think of the recent candle just swallowing that inside candle. Okay. Next up is going to be the outside bar. An outside bar is when you break the high and the low of the previous candle. It's also known as a 3 bar. All right. A 2 up is when you break the previous candle's high, and this is showing you that buyers are in control. You have to break above it and close above your open. A 2 down is when sellers are in control. It's when you break the previous candle's low, okay, showing you that sellers are in control. And again, when it opens, it has to close lower than where it opened at. We also talked about full time frame continuity. I'm going to break this down again, but it's breaking down all of the different time frames and if they're in alignment or not. When you have something called full time frame continuity and they're all in alignment, the trade is a higher probability because it's all pointing in the same direction. So the larger time frame, which would be the monthly, daily, weekly, or monthly, weekly, daily, 4 hour, 1 hour, so on and so forth. So these are the time frames that you want to use. So again, these things stack. You want to watch them, and then we're going to talk about failed twos as well, which we've already talked about in that video. Okay. So again, these are the 4 different types of bars. We already went over this. The rule is every bar ever printed is one of these 4 candles. All right. So again, the Strat bar type probability table. This is a hand-drawn conceptual diagram pretty much that I made for you guys, right? So signals compression, an inside bar is just consolidation, compression. It's not really doing anything. You want to trade the breakout, not the actual candle itself. You want to trade the breakout of that candle. So the next candle either breaks above it or below it is ideally where your entry is at. 2 up, okay? A continuation is higher likely, right? Or higher likelihood of happening, right? So it breaks above the prior high of the candle. 2 down, we explained that. 3 bar, again, we explained that as well, okay? If this 3 bar closes bullish, expect the follow through up. If that 3 bar closes bearish, expect a follow through down, okay? The key is the bar types tells you the bias. So again, when I teach you CKSR, which is my framework, this is a part of that. So what does CKSR mean? It means catalyst, key levels, the strat, risk management. So you already now have the strat, you have the key levels, okay? Well, you have it now. Next thing you need to know is the catalyst, and then you need to understand the risk management portion as well, okay? So full time frame continuity is, again, if the daily is green, the 4 hour is green, the 1 hour is bullish, and the 30 minutes bullish, all 4 in agreement, is highest probability possible, okay? If only some of them are green, it's kind of like, right? Reduce the size or wait. The more time frames that are aligned, the stronger the trade can be. So full time frame continuity, again, when all time frames are cascade, right, or moving in the same direction, right, this is a maximum probability trade, okay? Next up is going to be a failed 2. We talked about failed 2 signals. I know this diagram seems like it's a lot, but I'm going to walk you through it, right? So if a downtrend is in place, right, and a bearish candle closes, right, and it failed to attempt to buy the bulls, right? So this, for example, let me explain this in a little bit better, right? This is called a 3 bar, right? So we broke the previous candles high and low. I know it says a 2 bar, but it's supposed to be a 3. When you got to this level and you actually reversed back higher off of a key level, this is when this is setting up for a potential reversal back higher, okay? Now I know that kind of sounded a little weird, but again, when you're in a downtrend, you ideally want to catch failed 2 down, which is, again, sellers were in control and it flips back and the buyers are now in control and it moves higher. And if you're in an uptrend and you're looking for reversals back lower, you're going to look for a failed 2 up. That's when the buyers were in control and they lost control, and this is an actionable signal. And again, we broke down both of these inside of there. I'm going to also add another video right now on specifically how to trade failed 2s. These are my favorite candlestick to trade. So what I'm going to do is I'm going to play that literally right now, so that way you understand exactly how to trade failed 2s, because again, they're one of the most important candlesticks in my personal opinion that a lot of people don't really talk about too much. So I'm going to play that video right now, and then we're going to get right back into our presentation. Hopefully you're liking this so far. But yeah, let's jump straight into it right now. All right, what's going on, everybody? In today's video, we're going to be talking about trading failed 2s. So if you're new to trading failed 2s, I promise you this video right here is going to completely change how you guys look at the charts and how you trade the strat. So in today's video, we're going to be talking about what a failed 2 is, how it works, why it's an actionable signal, and how to actually trade it, and then also how to find your targets. So with that all being said, sit back, enjoy, and let's jump straight into it. So the first thing that you guys need to know is the strat obviously was created by Rob Smith. If you have no idea how to trade the strat or what the numbers are on this chart, please make sure you guys go check out the video that is on my YouTube and Twitter, so that way you guys can have a better understanding of what the strat is and how it actually works. Now, essentially with a failed two, right, there's two different types of failed twos. However, before we jump into the failed twos, I think it's important for us to, talk about twos in itself, right? So, you have two up and you have a two down. This is just basically showing you who has control. So a two up, which is this green candle here, is showing you that there was strong momentum to the upside and that buyers were in control. In the opposite scenario, right, this candle right here, this is a two down. This is showing you that sellers are in control. Now, a failed two is going to be a little bit different from those. And I will show you guys the indicator that I personally use. It's called Strat Assistant by Ricky Z. Carroll. And this is what gives it the outline that you guys see right here on failed twos. So basically, what is a failed two? Okay, so if we take a look here, right, if I were to turn this indicator off, one thing that you guys will notice is that this is actually a red candle, even though it is green, but it's actually important and it indicates why it's a failed two. Okay, so let's talk about it. Essentially, what you know about the charts when you're trading the strat is that a two is basically when a candle opens and it closes lower or higher than where it opened at. So in a bearish scenario, a bearish candlestick, we opened here and we closed down here, showing that sellers were in control. In the opposite, right, a two up, you see that the candle opened here, we closed higher than our open, which is showing us that buyers are in control. However, with a failed two, it is showing us how to see and how to view price action from a different perspective, okay? And what I mean by this is, in a failed two scenario, the reason this is green with a red outline is that this candle opened and at first the buyers were in control and then they ended up losing control, which led to the candle closing lower. So this is what makes this a failed two. Essentially, it is trapping one side of the market. So in this scenario, the market opened, right, or Tesla opened, it ripped to the upside. Once we got up to about 428, you start seeing sellers take back control and we ended up closing lower. In the opposite scenario, for a failed two down, it's the same exact thing. If we were to turn this indicator back off again, one thing you will notice is that this is a green candlestick, right? But when we turn it back on, it's red with green around it. This is showing you that, hey, this candle opened, went lower and sellers were in control, and then it got reversed and buyers took back control. So it's basically showing you who took back control over the other party. And the reason these are important candles is because they are actionable signals, meaning that you want to do something when you see it. So essentially, when you're trading a failed two, the best way to trade it is marking out the high and the low. So if we come here, we mark out this high and we mark out this low, and then waiting for the actionable signal to trigger. So basically waiting for us to break to the downside, or sometimes trading to the upside. Now, when you're trading failed twos, you got to remember that you are trapping one side of the market. So you're either trapping bears or you're trapping bulls. However, what I've personally learned and what I've personally seen over my experience of just trading is that it's better to trade these types of candlesticks around a key level. So if you guys don't know too much about key levels, please make sure you guys go watch the video that is on YouTube or on Twitter. I post all this stuff for free, so that way you have a better understanding of how all of this stuff works. So a better way to identify this, right, if we were to read what price did here, right? The day before we had a little bit of consolidation in a range motion for Tesla, right? And then what ends up happening is the market ends up opening and we rip to the upside. So we end up gapping up right before the market opens. However, one of the things you want to look at is the key level. So on Tesla, 424.21 is a key level. How did I find this? If we go look at the daily time frame and you look at 424, it is a level that we've bounced from multiple times. So if you look left, you'll see we bounced here, we bounced here, we bounced again. So this is a level that we've retraced back to multiple times, and we've seen price react to this level. So obviously this is going to be a level in the future that we can react to again. Okay. So that's the first thing, right? So we identify the key level. But one of the things you got to remember about key levels are in round psychological numbers, which is like 100, 50, 200, 400, so on and so forth, is that this is usually where a lot of buyers and sellers are sitting back waiting to see what happens. So the reason I like trading failed twos around actionable signals so much is because it's showing us, hey, are we either breaking above this actionable signal and making a move higher, or are we going to reverse off of this key level? So again, a key level is essentially just support and resistance. So you can draw the these out on the daily and the 4 hour. That is where I draw all of my support and resistance coming from the daily and the 4 hour time frame. Okay. Now, when you come here, right now we're looking at the hourly. This fail too is showing us that, hey, price opened and we broke above 424, but we could not hold up in this area, right? Buyers could not hold this, and then you start seeing sellers step back in. Now, when you see this type of scenario around a key level, for me personally, you also still want to keep in mind macroeconomics and things that you're looking at and fundamentals. However, for me personally, when you're looking at this is considered an A+ setup. According to my strategy, we are at a key level, right, on a ticker that has a lot of momentum, and we have an actionable signal. For me, I love taking failed 2s or 3s. Those to me have just been the best for my particular strategy and the way that I trade options. Okay, so with this being said, let's look at how you would trade this scenario, and then we'll look at it on the flip side as well. And again, nothing works all the time, but this does work really well for me personally and for the people who are in my Discord. Okay, so right here you see this fail to at an actionable signal. Again, a lot of times around key levels, around key support resistance, you will see actionable signals. It'll be a 3-bar, it'll be a 2-1-2 setup, it'll be a 2-2 reversal. Again, if you don't know any of this stuff, please go watch the videos. Okay, so how would you trade this? Basically what you're doing is you're waiting until this candle closes. So if you're looking at the hourly time frame, you don't want to take this while the candle is still live. You want to wait until the candle prints. So basically once this candle prints, you're waiting for the next candle to open and either break above or break below. And this is how you would play an actionable signal. Does time frame continuity have a part in this or play a part? It definitely does. So keep that in mind when you guys are trading and taking certain setups and actionable signals. So now what you're gonna do is basically mark out your targets. So for me, all of my targets are just, recent key levels. You can use pre-market highs and lows as targets, support and resistance on daily and 4 hour as targets, or you can use like 1 hour, recent candles, recent wicks. You can use all these as levels, whichever one works best for you. So the way this would work is basically this next candle opens and it rips to the downside. As soon as this candle opens and it breaks, you're taking the entry immediately. You're not hesitating, you're taking it right then and there. And what this is showing you is that, hey, the market ended up gapping up right before we opened, and then sellers ended up taking back control of the buyers, which could be setting up for a move back to the downside after gapping up. And what we know about gaps is that gaps will either fill or they'll continue. And what I mean by that is when a gap is created, so from here to here, there was no selling pressure or any type of red candles in this area. So a lot of times what will happen is when a stock gaps up or it gaps down, price will come back through that gap at some point in time, or it'll continue in that direction that it gapped up in or gapped down in. All right, so this is how this will look. You're taking an actionable signal here at a key level, keeping in mind time frame continuity, so you know that the higher time frames are in agreement with you outside of the weekly. And then you just have your targets. So you would take your entry as soon as this candle opens, it rips to the downside. You have target 1 right here. You have target 2 down here, which is going to be your pre-market lows, right? And then you can even use previous day lows as another target as well. So if we were to target this out, we could just look at these wicks and just call it, 400, which is a round psychological number. So in this scenario, you already had about a 20-point drop in Tesla. So I would be very confident to see, us go back to 400 and retest this level before maybe seeing an actionable signal showing that, hey, this is a strong level of support. We get a failed 2 down, which is showing that, hey, we took back control from sellers and now we're making our move back higher as buyers are stepping in. So let's look at how this plays out. Notice how it wicks, right? Once it touches, that's your last target. So this is pretty much how I would trade it. Your entry over here, target 1, target 2, and target 3. And it's literally this simple. This is how I trade on a day-to-day basis. And personally, I love seeing failed 2s on the 1 hour time frame. It does work really well. So if you look here, even though you got a failed 2, it followed up by consolidation, an inside bar, and then the direction was chosen, which means that sellers took back control, and then we pulled back to a 400 level, which is a round psychological number. Okay, and then if you look at how this played out, again, you had a failed 2 down, and then it as an actionable signal, it triggered to the downside. So anytime you see a failed 2 or a 3, you can look at it as marking the high and the low and looking to say, hey, who has control after we bounced or after we closed higher or closed lower? So this is pretty much how you would identify and trade failed 2s. And we can go over multiple scenarios. This works really well on the hourly time frame when you guys are looking at IWM. So if we look at this actionable signal here at 237.50, this is an actual trade that me and my community took. It's not like it's rocket science or anything like that. However, when you see a failed 2, that actionable signal, especially in the beginning of the day, tends to pay pretty nicely. Again, nothing works all the time, but in this scenario, it did pay pretty nicely. So again, the candle opens. We could actually go back and rewind. So I have my key levels marked off and I'm just using them as targets. If we're looking for buys, right, or if we're looking for the upside, you know, you got target 1, target 2, target 3, so on and so forth. Back to the downside, it's the same exact targets. That's where I'm taking my TPs or my take profits. So in this scenario, right, again, same thing here, IWM ends up moving up higher, right? We see a huge rally at open. We end up pushing past 238.50 and we could not hold this level and ended up breaking past another key level to the downside. You want to wait for the candle to print. Once the candle prints, you can mark out the high, you can mark out the low, okay? Keep in mind time frame continuity, okay? Keep in mind, you know, data, if there's data that's coming out, keep in mind, you know, key news and things like that, the fundamentals, those are still important. And then when you look at this, you say, hey, this is my entry, target 1, target 2, target 3, and then this is an extreme target and an extreme target. Basically what an extreme target is hey, you know, best case scenario, this is where I'm willing to let my runners go all the way to. And another really cool thing is when you guys are taking failed 2s and you're going into full time frame continuity, those tend to be some of the best paying failed 2s that you can take. So what I mean by that is if I were to rewind this again back here, right, the time frames were a little bit green on the higher ones. Once we flipped back through these levels, this flipped the higher time frames to go also in your direction, showing you that, hey, this is a lot of selling pressure. We're even breaking key levels from in the past, and that we could potentially set up for a bigger move because you're shifting structure on higher time frames. So if you look at this, you'll see that we ended up selling off. I think this whole entire day we ended up selling off and we came all the way down to 228. So your entry was all the way up here at 237. You caught about a 10-point move on IWM, which is absolutely insane, especially if you know about IWM. This ended up paying really nicely. So let's look at another scenario where you're looking at a failed 2 down, right? So let's see here. Normally you want to see a failed 2 down when market is, you know, obviously in an uptrend, right? You end up pulling back to a key level, get a failed 2 down, basically showing you that, hey, buyers are stepping back in, and then you're taking that entry from there. So this is a perfect scenario right here. So basically here on the IWM, the market opens and we rip higher, and then it's followed up by a 3 bar. So this is considered a double top, right? You've retested this same exact level and failed to break higher. Now, what ends up happening is you get this 3-2, which is also an actionable signal. So you could have taken this as well, and then your target would have been down here. But this is the candle I want us to watch for. So remember, on a failed 2 down, it's gonna be red with a green around it. And why is it this way? It's because sellers were once in control, and then buyers took back control, which is why you have a green outline. So again, if I turn this indicator off, you will see that it is a green candle. However, it is red and green on Strat Assistant because it's showing you that this candle ended up opening here. It broke lower first, and then buyers stepped back in. We stepped back in at another key level, 243.86. Another really cool thing is if you look left, you'll see that this was the same thing that happened during pre-market. So this is a level that price has reacted to multiple times, usually showing you a good signal, especially once you get this bounce. Again, you have to wait until the candle closes, wait until it prints. You mark out the high, you mark out the low, and then basically what you're doing is you're waiting until this candle opens, and then once it triggers either side, that is where your entry is at, and all of your targets are just key levels. So you would have target 1 here, target 2 would be these highs, and then target 3 would be here, another key level. So this is pretty much how you would trade failed 2s. It works across pretty much all tickers that you can possibly think of. So again, if you're doing this on, you know,
same days, or if you're doing weeklies and things like that, you can trade it pretty much the same way, and it's very, very consistent. You know, if we scroll back over here, I'll just show you guys, you know, QQQ, same exact thing, a failed two off two key levels, which is 613 and 611, right? And then once you broke under 610, that was extra confirmation since it's a psychological number. And then we ended up breaking lower and had a lot of momentum to the downside. Again, data or any type of news or fundamentals can affect how much the stock moves or how much the ticker moves. So definitely keep that in mind. Again, this works, like I said, with pretty much everything. And this is why you want to wait until the candle prints. So in this scenario, right, you get this failed two down here on QQQ, but it never broke above or broke below. So you saved yourself from sitting in consolidation. Even though it pulled back, when you're trading same day contracts or when you're trading weeklies, you know that the theta is pretty high on your contracts. So you ideally want to be able to get into your trade, especially if you're watching on the hour and you want to have your targets mapped out and then actually taking the triggers once they trigger. So this is a failed two down, followed by an inside candle, which is an actionable signal. So you will mark out the high and the low, and then you take the entry once it triggers to the downside, target one, and you got target two down here. Didn't get all the way down there, and obviously this is the end of the day as well, so you probably would have closed out somewhere around this level here. Okay. And then one thing you'll notice is, like, when you back test this, a lot of times when you see a failed two, it'll be like this, right? Look at this. You know, and this is a part of candlestick anatomy. How a candle prints is very, very important, and it tells a story. So in this scenario, right, the market opens, we ripped lower. This next candle opens and it retests 617, but this is also an entry area of where the gap is. So from here all the way down here, there's a gap. So what this is telling me, this hammer right here, is that, hey, price came all the way back down after sellers were in control and got bought right back up, right above a gap fill, which means that we're gonna move in an opposite direction of this gap. So when you get this candle, this not only is a failed two down, but it's also a very small body closed candle, showing you that, hey, buyers stepped all the way back in and closed this very, very tight, right on the open and the close, showing you that, hey, there's a reversal incoming. Then obviously what you see is this next candle breaks above our entry. You wait for it to break above, target one, target two, and then you take it right back up. So again, the really cool thing that I've learned about failed twos is a lot of times this is why I don't take a 2-1 setup or a 3-1 setup, because a lot of times what'll happen is when you think about a three, it's volatility, right? You broke one side and then you came back to take out the other side. An inside candle is consolidation, so you ideally want to wait to see who has control. But what I've learned is when you're taking 2-1s or 3-1 setups, they can follow up by a failed two. So think of it like this, right? This is a 2-1-2 reversal, right? This is a 2 up, 1, and then a 2 back down. But a lot of times what will happen is you'll get this setup and you'll think it'll run, but what will happen is it'll open, it'll push lower, and then it'll get bought right back up and go higher. And this, you know, specifically being able to identify this type of candlestick will allow you to see where people are getting trapped and how to dodge, you know, getting stopped out so quickly, because that's essentially what it is. All of these people in the failed twos, they're basically just getting stopped out of their trades once it reverses back down, and then that's the additional liquidity, additional power to the opposite direction to help out the sellers and things like that. Especially when you're stopping out buyers, right? It's additionally helping the sellers or helping price go back in the opposite direction. So this is pretty much how you guys trade failed twos. Like I said, this works really well with, you know, price coming down to key levels. So, you know, right now we're looking at AMD and we're looking at the 1 hour time frame. So let's actually go ahead and do this. Okay. And let's take a look here. So if we scroll to the left, look at this right here, right? So the market gaps down at open. The next candle opens, right? This is at market open. It opens and it pushes lower. So at first, sellers were in control and we retested 224.77. Once you see that price bounces and it goes higher and it closes, you have to wait until this candle triggers. So you mark out the high and the low, which would be here and here. And then obviously you see the buyers take back control, followed up by this big green candle. Once it triggers, you take the trade. You got your target one, target two. Did it trigger your target one? It did. This is about a 4-point move. These can pay pretty nicely on weeklies. Now, how would it work on higher time frames? It's the same exact way. If you're looking at a 4-hour time frame, it would be the same way. So you could see this failed two down, right? Pulling back close to a key level,
right? And then you end up getting a 2 up. So you can use these on higher time frames. You can use them on weeklies. These work really well on a weekly as well. So if you guys are looking for certain actionable signals, and if you're swing trading, they are pretty much the ideal setups to pretty much take. You know, if you're taking a failed 2 or a 3, especially on those higher time frames. But yeah, this is pretty much how you guys trade failed 2s. It is basically showing you who is being trapped, and you know, price basically reversing. So it's basically a reversal type of candlestick. A lot of times what it will do as well is it'll save you from, again, being stopped out or being faked out on a lot of moves. You have to wait until a candle prints, identify how the candle prints, read the actual candle itself, and then go from there. All right, so now you understand what failed 2s are, and I know you're probably like mind blown, like, wow, no one really talks about this. It's not really a super common trading strategy, but it works for me and the people that I trade with. And I'll later down the line show you a little bit more about TSA and kind of walk you through and show you some of our wins in TSA, so you kind of know all of this stuff when put together actually does work, and it's working for other people just like you who work 9 to 5s or have families or just want to make more money outside of their job, or just got laid off and are looking for another stream of income. This is something that can help you. So we are now in chapter 6. This is the 4-step checklist I run before every single trade. Okay, it's called the CKSR. It stands for Catalyst, Key Levels, Strat Setups, and Risk Management. I'm going to break down every single one of these in depth. All 4 of these must be in a line before putting $1 in. Now, is it absolute necessity? No, but it's ideal to have them all 4 in alignment. So I'm going to break it down to you right now. And hopefully you're enjoying it so much that you share this with your grandmother, your brother, your sister, your cousin, your loved one. And if you're watching it with your person right now, shout out to both of y'all. I see y'all laying in bed. And if you put this up on the TV and I'm widescreen, like right now, when you got to this specific section, tag me on your stories. @_TheRealTez. I want you to tag me on your stories. Tag me on Instagram. Post this on your videos on TikTok. Show the love and tag me. All right. So I know I could be a character sometimes. Got to make teaching a little funner here and there, right? So the CKSR framework. Okay, this is a 4-step trade approval system. All 4 must check off before entering. So first up is catalyst. What is actually this catalyst? What is driving the move? What is bringing more traders? What's giving the market more volume? What's giving the stock more volume? I trade catalyst because it's important to understand why I'm trading something. Okay, and I'm going to break this down in depth as well. But what exactly could be considered as catalyst? So you got news. I'm going to show you the different platforms you can use for news and earnings. Fed macro events. We're going to talk about those. Index directions. And then the gaps or pre-market moves. I'm going to break down those as well. The second part of this framework is key levels. So where is price likely to react at? So these are support and resistance zones, previous day highs, previous day low zones, and major price zones. Okay. Next is the S, which is the strat setup. So what type of candlestick pattern is being triggered at that specific key level? And I'll show you guys multiple examples of this as I go through the charts later, a little bit later. So, you know, full time frame continuity. Broadening formations, we didn't talk about it today. I don't use them as much, but maybe later down the line, I'll make a YouTube video on it and you can watch that. And then we got the 30-minute orb breakout, which we use very, very often. And then last is risk management, right? Where's my entry at? Where's my stop at? Where am I breaking even? You know, where's my position size? Everything is defined. So let's talk about catalysts, and I'm going to actually walk you guys through a couple different platforms. So a catalyst is what is actually driving the move today. If there's really not a big catalyst, the trade could potentially be a little bit flatter, right? I like trading things that have momentum, that have a lot of volume, which is why I trade the way that I trade, right? It's also why a lot of our traders inside of TSA are trading and they're done within the first 2 hours or 3 hours of the day, because we're trading things that have a catalyst. Or even if we're swinging something that could potentially have a catalyst that brings more people to trade that particular ticker in a specific direction. So basically, catalyst, you got to ask yourself, why is the price moving right now? The more context you can have, again, there's 2 sections or 2 parts of trading. You have the technical analysis, right, which is the charts. And then you have the fundamental analysis, which is the knowledge itself, information from articles and data and things like that. Combining both is what I feel like is best if you're trying to take this really far. So catalyst type number 1 is going to be news and earnings. So every 3 months, a company has to report their earnings, right? An earnings is basically like a financial report card that they have to report. Because that company is now traded on the stock market, it's called a public company now, right? It IPO'd, right? It went public. This is where you can now start accepting outside investors consistently through the stock market now, right? Now, if they're reporting their earnings every single 3 months, Sometimes they're going to beat their earnings, and sometimes they're going to miss their earnings. These can cause huge moves in that particular stock. We're going to also talk about analyst upgrades and downgrades. So essentially what that is basically when analysts, who are financial analysts, people who understand the company and understand everything about the company, are upgrading and downgrading it. These are usually institutions. So you get like JP Morgan, Morgan Stanley, things like that. Breaking company news. So if a company CEO passes away, randomly walking down the street or something, that'll be crazy. You know what I mean? But it can cause a lot of movement in the price. And then mergers or acquisitions, when a company buys another company or they merge together. Okay, this is high impact, and there's a potential that the stock could gap. What a gap means is basically when it opens at one price and then it ends up closing and then it opens at a higher price and there's this open space. And I'll break that down as well. Catalyst type number 2 is the Fed, right? Or macro events. So FOMC rate decisions, CPI, PPI. I'm going to show you how to understand all of this and where you should go to find this stuff as well. These things move the market. Job reports, GDP, which is the overall growth of our economy, PMI, consumer data. Also, the third type of catalyst is index direction. So looking at our compass, what is SPY and QQQ doing? If all three of, the setups, your SPY, QQQ, and the trade you plan on taking, is in alignment, you can full size into that trade. If it's the index trending, your direction, then you want to trade it. If it's choppy, you just want to not trade it. Catalyst 4 is gaps or pre-markets. So during a gap up or gap down from prior close, which means like if the stock closed at one price yesterday and it opened $10 higher, that's a gap up, right? Overnight news catalysts, those happen very often, especially right now in Trump's market. So the rule is if you can't answer why the price is really moving in one sentence, you don't have to skip the trade. This is just kind of like a preliminary for me. But if you want to have higher probability of hitting more consistent trades, having a catalyst helps. Now, if you're just trading the ETFs like SPY, QQQ, SPX, and stuff like that, you don't necessarily need a catalyst. But it does help a lot when you do have something that can help move that stock a little bit more. Now, next up, we talked about key levels already. So again, you have catalyst number 1, what's actually moving it. And then key levels is like, hey, this is what's moving it, but where can it go? This is where key levels come in. So you're basically mapping the battlefield out, right? So before the trade actually occurs, you already know where price can go. So you understand where price is going to react at, not just in between. So how do you find key levels or what are considered key levels? So prior day highs and lows, right? So yesterday, if you go to the daily time frame, you look at the day before, you mark out the high, you mark out the low, that is key support and resistance levels. Okay, those are key levels you want to watch. A lot of times price will get to a certain level and it'll either reject or a breakthrough and it'll give you a continuation or it'll fall. Weekly highs and weekly lows, those are really, really important as well. This is why it's inside of the TSA indicator. It marks out all of these for you automatically. Whole numbers are really, really important. Key level whole numbers. We talked about this already, right? Psychological numbers ending in 00 or 50. And then gap fills. This is when a gap is created and there's that open space. You want to make sure you're keeping that in mind. The level rules, right? At the level, you're kind of like chasing air. You don't want to be chasing air, right? Multiple time frame confluence, you want to actually watch those as well. Levels cluster, right? This is high conviction, and so if there's a lot of retests on a certain level, you want to watch that. Between levels is kind of like no man's land unless you know what you're doing. Okay. The strat setups, we talked about these already. All right, so we'll go over this a little bit later. Okay, and then we got risk management. All right, every variable defined before you click buy. All right, so the 4 non-negotiables. You have to know your entry before you click the price to enter. You got to know the exact price you want to get in, right, and where you want to get out. Ideally, you want to do limit orders. We already talked about those. You want to understand where you're getting out of your trade. You have to have an invalidation point. So for me, I use the previous candle's high or low, or the previous swing high or swing low. Lower highs and lower lows, right? You're in a downtrend. My stop loss will be at the most recent high. If we break above that most recent high, we shift, or we could potentially shift into an uptrend that invalidates my trade. If I'm in an uptrend, right? Let's say we're going up and I'm taking buys or I'm taking calls. What I'm doing is I'm putting my stop loss at my recent low, because if we break back lower, we could shift back into a downtrend, or you could just use the previous candle's low. And I'll show you guys examples. I know that all sounded like, whoa, you just lost me. But yeah, I'll explain, right? Once you get above 50% in your trade, I usually move my stop loss to break even. So if I buy my contracts in thirds, right, or I buy multiple contracts at the same time. The reason that I do this is essentially I can sell 2/3 at 50%, and then I can leave runners. Runners is what's going to pay you more over time. I should probably add a video about runners inside of here somewhere for the risk management portion. What do you guys think? I mean, I can't really talk to y'all right now, but I do think adding runners is probably a game-changing video I should probably add. Let me not waste y'all time. I will consider adding runners into this. You know what? Actually, let's just do it right now. Let's do it right now. I'm gonna add the runners video right now to make sure that all of this makes sense. So as I continue to go on, you're not completely lost. So let's connect some more of those dots for you right now. If you trade options and it's really hard for you to leave runners so you can maximize your trades, it's not a discipline problem, it's a sizing problem. So in today's video, I'm gonna be walking you through why I buy my options contracts in thirds and how you can massively impact your account by just leaving runners and maximizing your risk management. So let's get straight into it. Now, if you trade options, I'm pretty sure we've all had multiple scenarios where we've taken a trade, our target gets hit, we're super excited, we exit the trade just for the trade to keep going in our direction, and we miss out on another couple 100%. I don't know about you, but it's happened to me over and over and over again, and this is why leaving runners is so important. A lot of other traders may be against it. However, I do believe if you're really trying to scale an account and really grow it efficiently, it will require you to maximize profits on winning trades, and I think a lot of people struggle with that. So buying my options contracts in thirds have completely changed the game for myself and countless other members inside of my Discord who also trade the same way that we trade as well. So I'm going to be breaking it down, everything to you right now for free. So let's jump straight into it. So again, like I said, a lot of the times when you're taking your trades, you might have designated exit points, right? And especially for those of you guys who may be trading futures or any other commodity or asset, right? One of the things is like, you may be looking at a fixated risk to reward, right? So you're looking at a 2-to-1 or a 3-to-1, and those things are all great, right? I'm not going against any of these concepts. All I'm saying is, do you have a portion in your plan or within your system that will allow you to maximize if the trade continues to work in your favor? And a lot of times, especially with options traders, we forget that there are positions or trades that we take that go multiple hundreds or thousands of %. And a lot of times what will happen is you'll sit there and you'll try to jump back into the trade. You'll feel greed, you'll feel FOMO, and it'll lead into you making more mistakes in your trades. So I actually want to break down the concept of buying my contracts in thirds. We're going to look at this on Coinbase. This is a trade that we actually sent out on Twitter, and I also sent it out in the Discord community. But first, before we get into this concept, what I will do is I will bring up the text chart. So let's talk about buying contracts in thirds. So what do I mean by buying contracts in thirds? So as you guys know, if you're buying options contracts, you can buy however many quantity or contracts that you want to buy. So one of the biggest shifts that I've made is buying them in thirds. And what I mean by that is buying the amount of contracts that is divisible by 3. So that basically means either buying 3 contracts, buying 6 contracts, buying 9 contracts, buying 150, 15, any number that is divisible by 3. And I'm going to break it down exactly why I do it this way and why it's been working really well for me. So when you're doing this, you're not changing your risk to reward, right? You're really maximizing the winning positions and allowing yourself to be able to, like I said, be able to grow an account more efficiently by leaving runners. So if you're not familiar with what a runner is, right? Basically a runner is a portion of your position that you leave inside of the trade after you take majority of your profits. And buying the contracts in thirds make it the easiest for a number standpoint, but also the easiest for just like maximizing your position and being able to really catch those bigger wins. So basically a runner is, let's say I buy 3 contracts. Let's say, when my first target gets hit, I'm selling 2 of those contracts and then I'm leaving my runner. That runner is going to go out and try to see if we can maximize the position. However, there's a couple rules that you should have on your runners. So let's break it down right now. Okay. So let's first off start with an example, right? So let's say you're trading coin, right? So the ticker is coin and you're trading same week contracts, for example, right? And let's say you buy 3 contracts. Okay. Each contract is $100, right? So you spent $300, okay? Now, a lot of people out there, right? And what I'll also do is I'll pull out a calculator so that way when we're doing the numbers, you guys can see everything as well from an easier standpoint. So you can calculate all of this on your own and you guys can see why it's such a massive advantage when you guys are using this, okay? So let's say you spent $300 on Coinbase contracts, right? And let's say your first target, let's say your target gets hit. And let's say, you know, you hit a, let's call it a 50% return, okay? And that basically means that you turned $300 into $450, right? So basically you made $150 profit. Now, a lot of people would be really happy with that. I know I would be. And if you're looking at this from a risk management standpoint, obviously this is a great, you know, a great return on a trade, especially if it's same week and it's, you know, something short. However, the biggest issue is that what if this trade ends up going 200%, 300%, 400%, which a lot of times, especially if you are trading the way that we trade, where there's a lot of volatility, a lot of volume, you might be trading IWM, you might be trading SPX. There's a lot of opportunities where these contracts go multiple thousands of percent or even hundreds of percent. And a lot of people be like, oh, well, that's just greed, right? No, the way that I trade has allowed me to maximize trades, right? It's not greed. It's just being able to have a plan for when things are going really right, or really good for you. And a lot of people plan for the worst predicament, but no one ever plans for the best and the worst. And I think by having this way of thinking, it will allow you to really be able to grow your account more efficiently, especially when you have a smaller account. So let's break down the contracts in thirds, right? So we're going to move this over here, okay? And I'm gonna just basically drop this here. I'm gonna minimize myself just a tad bit here, just so you guys can see everything pretty clean. So we understand what buying, you know, contracts in thirds is. We also understand, okay, hey, leaving runners. We understand what both of those concepts are. And I'm gonna walk you through, you know, like I said, an actual trade where we leave runners and how we maximize the position itself. So let me walk you through what it looks like when you do the opposite end, when you do the contracts in thirds and you leave runners, okay? So basically, instead of just having one main take profit, one main target, you would have ideally 2 to 3 targets. And what this allows you to do is have a, you know, hey, this is where I really want to get out. This is my first take profit. The second one is a really good, you know, take profit. If it hits that, amazing. But the third one is called an extreme target. The reason I call it an extreme target is most of the time it's not going to get hit, but when it does, you get paid. So I want to show you exactly how that works and what it looks like from this standpoint, okay? So let's say, you know, you're buying coin contracts, right? You buy 3, okay? And you spent $300. So it's the same exact scenario as on the left, right? So you spent $300, but instead you're selling your contracts in thirds, right? So what this looks like is, let's say first target, you sell at 50%. Right? But instead of exiting your entire position, you're only selling 1 or 2 contracts. For this example, let's just say we sold 2 of our 3 contracts. That means that for the 2 contracts that we paid $100 for, which means we spent $200 for these contracts, we basically are securing profits on that. That means we took $200, right? And we're now able to turn this into a 50% return, right? So 50% return means that you made $100 profit, right? So basically what you're doing is you're securing your profits, right? You are securing your profits. So now you're up $100 on selling those 2 contracts, right? So you've now taken back, you know, majority of your profits from the contracts that you spent, right? So basically you turn these 2 contracts, right? They had a 50% return, which means they made $100, right? So $100. So those 2 cons cost you $200. You add in $100 profit. That means to sell those 2 contracts, you're making basically $300. So now the trade is break even for you, right? Now for other people, like I said, they could just sell the other contract and then they could take their profits. And for them, that might be something really good. But for me personally, I like to be able to maximize the trade itself. So basically the way this works is you leave the last contract, okay? And then let's say you have your third target or second target, it's an extreme target, right? And this last contract ends up going, let's say 200%, right? So this last contract goes 200%. So you sell your last 1/3 of your contract, right? This is your last contract, basically. This is your runner, right? And that runner, right, you bought it for $100 because each one of these contracts were $100 each. However, this contract went 200%. So what is that if we looked at it from a math standpoint? Again, this is why I wanted to pull out the calculator so you guys can see it, and you can calculate all of this on your own. You can go back and look back in time on trades that you have taken, and if you would have exited or left the runner, here's what you would have made, right? So instead of just taking those initial profits and just making $150, right, me still being break even on this trade, right, and then maximizing this so it's a risk-free trade. I have no emotions in this trade now, so it really allows you to sit through the trade, see if your next targets can get hit. Let's say the last contract you sell it at 200%, so that $100 times 200%. Okay, basically you sold that last contract for $200, right? Right? So basically what this is saying is you've been able to basically make $200 on this contract, right? So the way this works is essentially instead of you making, you know, $150 and, you know, walking away with $450, you know, overall, what you're able to do is you're able to walk away with $500, right? But there is no more emotion in the trade, right? And it also allows you to just overall be able to maximize the position itself, because this trade could have went 400%, it could have went 500%, it could have went 1,000%. And again, it's giving you a higher return than your initial TP. Now, for some people, right, they might just want to do that way, and that's perfectly fine. But like I said, if you're really trying to grow an account, leaving runners is one of the best things that you can possibly do. Now, another portion of this isn't just leaving runners and just letting the runner die out, right? You have to be able to move your actual stop loss on the runners. So let's look at it from this standpoint. So we're gonna move these over, okay? And basically what I'm gonna do is I'm gonna pull up a text, right? So let's say when your runner is up 100%, right? So let's say your runner is up 100%. You don't just leave this runner with a negative stop loss. You move your stop loss to break even. So no matter what happens with the runner, you're still walking away green. And this is why it makes it risk-free, but this is also why if you have this in your plan, it allows you to maximize your overall position. So now if you leave the runner, right, and your runner is up 100%, you can move your stop loss on the runner to 50%, right? Stop loss on the runner to 50%. So now at the worst case scenario, what'll happen is if you get stopped out of your runner, you get stopped out of your runner at 50% profit, which means guess what? You're still gonna make the same amount of money you would have made here. But instead, you're now letting this runner go to see if it can go bring back another 200, 300, 400, 500x, you know, whatever amount of percent, right? And this has worked so many times, especially on days where the days are trending, where basically the price action is just in your favor, or you just, you know, you got the right entry and price is just trending the entire day. This is how I've been able to really grow my own account, but this is how we have a lot of people who are starting with $1,000, $5,000. This is how they're growing their accounts as well, is those runners are the ones that are bringing back the majority of the profits. So when you guys see us post 300% returns, 500% returns, 1,000% returns, I'm not holding my entire position. I'm literally just holding the runners, and the runners are the ones that are going to bring back sometimes a higher return than the first initial profits that I took back. There has been times where I've left the runner and it goes 700%, and the initial profits that I took was only 100%. Well, now I made 6 times the amount on that one contract, which means I made more on that one contract than all of the other contracts that I have bought. Or, you know, if I bought it in thirds, I made more on that last third than the rest of that position. So I hope the math is mathing. I do want to walk you guys through an example of how this works as well. I'll go over a few different ones, and you know, basically how we have our targets. So let's go ahead and come down here and we'll look at Coinbase, like I said, because this is a trade setup that we actually sent out, and this is a setup that we actually ended up taking. So basically on Coinbase, right, we ended up trading this specifically because it had a lot of volume the day before. So as you guys can see here, the day before we had a massive sell-off, and basically I seen a bunch of flow coming in. The next thing that I also seen is that we were rejecting this 240 level 3 times this day. So this was basically on my watch list going into the next day, which is here. And basically the reason I looked at this is because, again, the flow was just showing me that, hey, a lot of smart money is looking for coin to sell off, and with them putting their money there, with me seeing this bearish price action, with me seeing these wicks to the upside multiple times at this key level. So if you guys don't know how key levels work, I have a full video on YouTube and on Twitter as well that you can go watch for free. But basically it's just support and resistance on the daily time frame, and just looking back at how price has reacted, what type of behavior the price has had around this specific level. So in this specific setup, what we were looking for is a break below the pre-market lows. Why? Because I knew that if we could reject this 240 level once again, we could potentially sell off to previous day lows. So in hindsight, if we were to rewind this and we look at it from this standpoint right here, most people would just have their target here and maybe a stop loss above pre-market highs or something like that. And I would tell you, hey, that's a great trade. It would be a great risk to reward. This is about a $3 move, right? However, again, you have to sometimes have a plan for if things just keep going right. Why is it that we only plan for things to go wrong? Why can't we ever plan for things to go right? So with that being said, what we looked at is like, hey, this is going to be target one. So we can literally type this here. Okay, but then on the daily time frame, we notice that we have other levels that have been retested in the past, other levels that price has bounced from in the past. So this is where you have extreme targets. This is where you have multiple targets. So let's say you have target 2 right here. So we'll put this in the middle. We'll do target 2, target 3, target 4. So instead of my trade only looking like, hey, you know, this is my entry criteria, right? So we basically mark out the high and the low here, right? So basically this is your pre-market highs and lows. This was our entry criteria right here. So if we lost 240 once again, we were looking to see if we can take out 237, right? So instead of me looking at this and saying, hey, you know, this is my only target, and just exiting my entire position, now again I am using the rule of thirds, being able to execute my trade with a little bit more precision, but being able to maximize my profits as a whole. Another thing as well is when you're trading full time frame continuity, if you trade the strat, if you don't, then it just basically means all of the higher time frames or all the time frames are in alignment. Basically, if you're trading something like this, there's a high likelihood that the trade could potentially hit other targets that may be below your initial target. So you're basically okay with just leaving money on the table. So again, this is not you being greedy. This is you being able to maximize on your trades while making sure that you don't have as big of a downside, because your stop loss is still the same regardless. If you have a 30% fixated stop loss, or you have a stop loss still here at this portion right here, you know, above pre-market highs in it, and that's what invalidates your trade, then that's just the case, right? You would just exit the trade the same way. But instead, now we're playing for, hey, if this continues to go right, you know what I'm saying, then this is a potential setup that could pay us really nicely. So basically what I'll do is I'll drop to the 5-minute time frame and I'll show you exactly what it looks like. So in this particular setup, we already seen in all the bearish price action the day before. We've seen the flow, which is again smart money, seeing how much money they're putting on the contracts and so on and so forth, right? And we know that we were looking for pre-market lows to be lost, so that way we have confirmation that we lost 240 and that we could potentially take out these next targets. So here's what ends up happening, right? So Coinbase basically opens, the market opens, and the first thing that we see is a massive drop, and then look, your target gets hit. But again, another core principle that I've understood over, you know, a period of time after trading is learning how to read the body of a candlestick, learning how to read a candlestick itself. So when you see a lot of bearish price action, mind you, our entry was here. So are you green? Yes. Did your first target get hit? Yes. But this is only the first 5 minutes of the day. Right now we're on the 5-minute time frame. So, you know, you might be looking at this and saying, hey, you know, I'm getting paid. This is right out the gate. This is a 5-minute day, everything, all that good stuff. You post it on Twitter and stuff like that. But what I'll tell you is stop trying to show off for other people and show off to your plan, right? Actually execute your plan at the highest level humanly possible. And again, you have full time frame continuity. So the way that I read this candlestick is that, hey, this is a lot of bearish price action for us to come down here and hit our first target right out of the gate. And to see the body of this candle close this way, this is telling me that sellers are in control. So at this point, there is no reason for me to exit my entire position. I am saying, hey, with the candle closing like this, I'm willing to make a bet. I'm willing to move my stop loss from here, which is, let's say, call it whatever it was. I'm willing to move my stop loss from here to previous week lows. So basically, no matter what, if the runners don't work, I get stopped out green. I get stopped out in profit on my runners, right? So on target one, you sell, let's say 1/3 of your contract. So instead of selling all three, you only sell one contract. You leave your second contract to sell at target two, and then your last contract, you will leave it to see if it can hit your extreme target. So look what ends up happening, right? This is the first 5 minutes. You took profits on one of your contracts here. You have 2 other contracts ready to go, right? So you're looking for another close of a 5-minute candle under your target one for confirmation that we can hit target two. So look what ends up happening. Next candle opens, it hit target two. Perfect. So you sell your second contract, and now you have one runner left. You have one contract left. And now you're basically saying, hey, we're still full time frame continuity. We're also, rejecting these highs. We've rejected the VWAP multiple times. Every time it's tried to pop, it's sold right back off. I'm pretty confident that we can at least take out target three. And then if we get to target three, I'll see what the candlesticks look like to see if I'll leave it to hit candle four or target four. So look what ends up happening, right? Next candle opens, it hits target two again, but it also closes at this line. So this isn't necessarily confirmation just yet, but this is like, hey, this is a pretty good chance that we can take out target three. Let me just be patient. Let me set an alert. Let me set and forget. Let me walk away, and let's just see if the target ends up getting hit. And look what ends up happening. Next target gets hit to the T, and it also closes here. What I'll also do is, let's say, hey, target gets hit, right? However, I'm reading the body of the candlestick. There is very small wicks on both sides of this candle. So I am pretty sure, I'm pretty confident that we can take out this next target, which is down here. Let me go ahead and adjust that at 232.83, right? Now, at this point, you're just moving your stop loss, right? So, at this point in time, after your second target is hit on your second, on your third contract, these contracts, I think when we took this trade, these contracts from here to here, because we trade out of the money contracts, these were already up 200%. Just from this $3 move. Now, again, obviously if you trade at the money, in the money, your percentages are going to be completely different. But the way that we do high risk, high reward, right? Now, again, now you've moved your stop loss to your recent target, right? You just basically move it down, and now you're just playing with profits. You're playing with house money. So at this point in time, you don't have to worry about re-entering. You don't have to worry about chasing the trade. You don't have to worry about any of those things. Now you're just being able to say, hey, let me just keep reading the body of these candlesticks. If I get a reversal per the strat, let's say it's a 2-2 or a failed 2, and it triggers the opposite side, then I'll look to exit, right? But other than that, there's no reason for me to exit. So imagine you getting out here and then coming back 10 minutes later, and you're like, F, right? Like, dang, man, I should have just stayed in the trade. And now you got FOMO. Now you got greed. Now you're journaling about how you only hit for 50%. When your contracts, you go back and you look 3-4 times throughout the day, and your contracts went from 50% to 400%. And now you're sitting there pissed off, right? And then look at this, right? The next candle opens, it closes under target three. So when it closes like this and you read this wick, hey, we're rejecting breaking back above. So this is a break, retest, and a fail. So now when you look at the next candlestick, look at that, boom, target four ends up getting hit, right? And now you're able to take your profits going into this, right? And you're now able to maximize. This overall trade was a little under 400% on this trade in itself. So again, by having multiple runners, and look, you end up getting a 2-2 reversal. This is a sign that, hey, I should exit my puts position, because we could be setting up for a reversal. And then look what ends up happening. Right? You just saved yourself just from being able to use the strat, understanding key levels, and having multiple targets, and you just maximize your trade. So now instead of you taking profits at $450 or $150 profit here, you now walk away with an additional $300, an additional $400 in profit just by waiting for your target four to get hit. All right, we're back. You now understand how to leave runners, right? Like, that's probably one of the most important things. If you really want to be able to scale your account, you got to be able to understand risk management. You got to be able to leave runners. You got to leave portions of your trade in there to bring back bigger profits. A lot of the ways that we work in TSA is sometimes our runners are bigger than our initial trade, a lot of times actually. So if you haven't really did that before, this is something I highly recommend, and now you know it. And again, it's all because you came to this handy dandy little course. All right. So when it comes to choosing your expiration, if you're taking entries, ideally for me, I've been taking a lot more, I've been buying a little bit more time on my contracts when I'm trading options. So, I'll go a couple weeks out maybe. You just want to respect your account, right? Be careful of 0 DTEs. They work really well, but you can get cooked. position sizing when it comes to risk management, you want to risk at max. I wouldn't even say 2% because this is for like complete beginners, like 2 to 3%. But further down the line, I recommend like, hey, most I'll trade on my account is 10, and that's like if I'm very confident in the trade, I'll risk 10% of my account. Other than that, on average, I'm risking anywhere from 3 to 5% of my account. Okay, 3 to 5%. So 3% is like it's not like I'm super confident in the trading environment or the conditions in the market right now is a little different, so I'll size down. 5% is like, okay, this is a trade that I want to take. And then 10% is like, no, I feel like this thing is going to go. Everything is in alignment. This is a high probability setup. I'm taking this trade. Okay. So with that being said, these are risk management. All right. So the CKSR trade approval system, 4 checks before every trade, right? So catalyst, is there a reason that this stock is moving? Okay. Now, doesn't mean you have to trade, like not trade this at all. No, I'm not saying that, right? Even though it has it actually said right here, but I want you to think in that way, right? Because again, if there's no key levels, you got to be careful of taking the trade. So instead of just saying no trade, just say be careful. If you have no risk management though, don't trade it. Okay. Do not trade it. So all these things should be in alignment. Is price at a significant level? Does the bar type confirm the direction? Is my risk management secure already? If all 4 check, you can take the trade. Okay. So this is an example of 4 filters applied, right? So let's say the catalyst is, the Fed is releasing rates today. Okay. The QQQ, which is the tech sector, is gapping up on a relief rally. And then on top of that, you have a strong macro catalyst confirmed. So key levels, QQQ is at 570, and also is the prior day high. We're at weekly resistance, and then the key level is identified as well. On a 30-minute, as far as the strat setup, this is where you're ideally looking for a setup. The 30-minute chart shows a 2-up bar, right, or a 2-up, and it's breaking above the prior day's high. You also have full time frame continuity on the daily and the 4-hour, which are both bullish, and you have a fail 2-up signal confirmed, or fail 2 down, essentially. The risk management is, you want to have your entry at 572 on a 5-minute close. Your stop is at 569.50, which is the previous candle's low, right? You might go 1 or 2 days out on the contracts, maybe at the money, in the money, or out of the money, whatever works best for you. And then maybe grab a couple contracts depending on your risk for your account or depending on your size account. And then you execute. The 30-minute opening range, okay? So this is called the 30-minute orb. It's probably one of the most consistent setups that you can possibly take. Again, I will break down all of these as I go through as well. Some of these I'm going to keep only for TSA, but the 30-minute opening range, I'll break that down. Some of these other ones though, gotta only keep it for TSA, even though I did kind of have it in here. But gotta leave a little bit of the sauce for TSA, you know what I mean? Like, can't break down everything, you know what I mean? I really could, but you'll learn it as you go. But it is a little bit more advanced stuff, which is why I don't want to include it in here, because you need to have full context. This is really like a full-on beginners and intermediate course. I don't want to put super advanced stuff in here and then completely lose you. So some of the stuff I'll skip over. But the 30-minute opening range, okay? So key rules, you want to wait for the first 30 minutes to be done. So at 10 a.m., right? So 9:30, market opens. You want to wait until the first 30-minute candle closes. That's at 10 a.m. That's when the candle closes. You want to mark out the high and you want to mark out the low. And essentially, whenever the candle breaks above and closes on the 5-minute, that's your entry. So let's say you mark out the high and the low on the 30-minute. You drop down to the 5-minute to actually execute the trade. So if the stock, a candle breaks above and it closes above, you're looking for the continuation higher. If it breaks below and closes below, you're looking for a continuation lower. So you always want to wait for the 5-minute. For me personally, this is where I look for my entries, either on the 3-minute or the 5-minute. This is where I'm entering the trade. I'm waiting for confirmation there on that trade, right? The stop goes either below the 5-minute candle or at a key level. So whether if a key level is right, like very close by, you just use that as your stop loss or your invalidation point. And then you just choose the contracts that work best for you. So key level reactions, this is probably one of the highest probability setups you can take, which is at key resistance levels. And basically what this is so when you mark out support and resistance levels, all you're doing is waiting for actionable signals at that level. So let's say at support, you're getting a failed 2 down. This is confirmation that buyers are stepping in and we can move back higher. If you get a failed 2 up at resistance, this is mean buyers were in control and now sellers are taking back control, right? It breaks lower, your stop loss is going to be at the previous candle's wick, right? And then you just have targets below. All right, so I actually want to show you guys this because this is something that I built for TSA. and it is completely private, of course. Let's go ahead and go here. Obviously, there's a password page because it is only for TSA. And what I'll end up doing is, let's do that right there. So this right here is the TSA scanner. If I come inside of here, I just want to give you guys a sneak little peek of this and how it works. So now that you understand the strat, it's important for you to understand how to find good trade setups. So what I did is I built a scanner only for TSA. And within the scanner, it pretty much walks you through and gives you all the setups you could possibly like. So when you're trading the strat, one thing I highly recommend is find 2 to 3 particular candlestick types that you like or combinations that you like trading. And when you learn how to do that, or when you do that, you'll be able to spot high probability setups a lot sooner and a lot quicker with, you know, less time of you sitting there watching and going through every single candle or every single chart. So let's say I want to see on the daily time frame, right? So I can click on the time frame and I want to see a inside candle, right? So there's none available right now. But let's say we want to see a 3-bar. Let's say trading 3 bars is one of your favorite setups. Well, now you can see a 3-bar on the daily time frame, and then you can come over to the chart and we can actually take a look at PayPal. So now if we go to PayPal and we go to the daily time frame, you can see, hey, there's a 3-bar. And now if you love this actionable signal and you like this signal when trading, you can literally come and see it immediately. All right. Now, the next thing as well is inside of here, we also have a ton of other features. So if I want to see all the bullish setups or bearish setups, I can see those. I can see all the bullish setups. I can see the things that have full time frame continuity, right? Which means all the time frames are in alignment. So now I can take high probability trade setups all the time just by looking for these and looking for actionable signals at key levels, right? So yeah, these are some features that it has. We also have an options contract chooser. So if I wanted help choosing my options contracts, let's say I wanted to choose, you know, some Chevron, you know, because I'm trading oil. Say I want to choose Chevron contracts. I can click the type in the ticker, the date I'm looking for the contracts, and then it'll literally rate and give me all the data I need to know about the options contract. So it helps me with choosing my contracts. Now, again, these are all features that only TSA gets access to. So I just wanted to kind of give you guys a little bit of a teaser of what you can expect when joining TSA. Obviously, we have pre-market calls. If you like this free course, I know you're gonna love the paid course that's inside of there, or just the overall curriculum that we have set. It's like a library of live classes and where we have guest speaker traders and all that good stuff. So if you want to check that out, the link's down below in the description if you're interested. But yeah, we have a ton of different cool things in pre-market. It shows us all the stocks that are gapping during pre-market. There's another tool that we're adding. I don't want to give that one out just yet, but yeah. So with that being said, that is just a quick little walkthrough of our live scanner, and this is all live. It is exclusive only to TSA, and yeah, one of the little cool things you get when you join TSA. All right. So next up is going to be chapter 8. This is where you're going to learn how to really place the trades. We already talked about limit orders and market orders and all that good stuff. You know, as far as like pricing the contracts, all that good stuff, we pretty much went through all of these. This is just going to be like a quick like walkthrough again. You know, a lot of these setups, I'm going to skip over this one as well. Skip over this. I would rather actually break it down on the charts. Okay, so let's go over a trade management checklist, right? So step number 1, you want to have a pre-trade, right? So CKSR is pretty much all you need. Contract selection, size calculator. You want to understand all these things before you get into the trade. And then you want to have your stop price. You want to understand where you're getting out of the trade. And then you just want to enter, right? Now I actually see that this is written double, right? So you want to do limit orders when you're placing your trades, meaning you're, you know, looking to get filled at a certain price, and you want to do the mid. Remember what I told y'all earlier, try not to get filled at the ask unless you're really trying to get into the trade immediately. You're just going to be paying more for the trade, okay? Now, once you actually take the trade and you're in the trade at 50%, you want to go ahead and take a little bit of profits and then move your stop loss to break even. And now this is a risk-free trade. As price is getting to your next targets, you want to start cutting off some of your runners, and then you want to exit your trade and just journal, okay? So this is pretty much your edge, right? You got key levels, you know where your entry is, you know where your stop loss is. And again, all of this stuff is broken down exclusively and live traded directly within TSA, okay? Rules and routines as far as these things go, you know, cap your risk. So always understand how much you're okay with losing. You know, when it comes to never hold losers, you can hold those losers depending on your hypothesis behind the trade. You do want to stick to a plan. You want to document everything. So like even in TSA, we like have a spreadsheet that we give you to keep up with your trades and track your profits and literally see everything. So all of that is given to you automatically. But if you don't have that, or if you're not in TSA, you can just grab a notebook and use that, or you can use TradeZella, which is another great platform. You want to protect your profits, no revenge trading, focus on one edge, and stay objective, and then obviously review your trades daily. As far as pre-market routine, you want to scan the news, identify your key levels, and mentally prep for the market. Next up is going to be like what never to trade around, as far as no FOMO, right? Avoid earnings gambles, before it, just kind of be a little bit more careful trying to take something before the earnings comes out and then swinging it. Be careful. Sundays are very important. Sundays is where I do a lot of my prep. So this is where, I review my week's trades, I plan for the next week's watch list, and then I set my intentions overall. All right. You do want to have a daily loss limit. So you got to be careful. Like, this is something very, 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 very important. Okay. If you lose, your max loss on a day, you got to learn how to walk away and just come back the next day. You have to learn this. I'm telling you this right now from my own experiences. If you don't learn this, this will absolutely cook you later down the line. You got to learn how to walk away. Okay. Again, make sure you're risking proper. I do 3%, 5%, and 10% if I'm really convicted on the trade, or I really believe in the trade. Okay. The daily loss limit is not a suggestion. It is a rule. If you do not get this down, if you do not follow this rule, you will 100% mess yourself up in the long run, especially as you scale your account. Now, these are going to be 8 golden rules of trading, right? And again, never risk more than about 10% of your account, not 2%, 10%. Always define your stop before you enter the trade, so know where you're getting out. Never move your stop against yourself. So if the stop loss, let's say price goes against you and it breaks above your stop loss, don't keep moving the stop loss. Just close out the trade. Never average down. Average down basically means when the trade is working against you, you're trying to buy it back, buy more of it as it's going lower. As you're losing more money, you're trying to buy it because you're trying to get it cheaper. I do not average down. Okay. Never trade the first 5 minutes of the market open. Be very careful doing that until you're more experienced. Never hold the options contracts through the earnings. Again, if you're trying to swing something into the earnings, be careful doing stuff like that. Stop trading for the day after hitting your daily loss limit, and then the market will be open tomorrow. So there's always another day. There's always another setup. And a key thing that I always say in TSA is next, because really, what can you do? Just move on to the next. All right. So pre-market routine, let's actually go into that section as far as what platforms you should be using to kind of go and navigate your pre-market. I know I kind of bounced around just a little bit, but I wanted to get through these things. So let's kind of go through the platforms that you're going to need when it comes to your pre-market prep and getting, information for catalyst and things like that. So let's go ahead and do that right now. All right. So the first platform you want to use that I personally check every single day is going to be the forexfactory.com. So when you go here, you want to come up to the top and you want to click on calendar. When you click on calendar, you want to click this filters option and you want to uncheck all of these except for USD. And then you want to uncheck the gray folder. Now, what is the Forex Factory? Why does it sound like it's Forex related? Well, it's for data. It's for understanding what news is coming out or what important events is coming out, right? So inside of here, the really cool thing about Forex Factory is it tells you pretty much everything you need to know, right? So for example, red folder data is one of the highest impact to the market, pieces of information that could come out, right? So you got JOLTS job opening reports, ADP non-farm employment, core retail sales. If you do not know these things before going into the market, before taking a trade, you are going to absolutely cook yourself. So this is why I left this towards this portion of the video, because we are about to transition into breaking down the charts and really going through multiple different trades with you guys and just kind of making things click a little bit more. But again, if you don't understand these, you will 100% be losing out a lot more on your trades. Let's say you don't know what one of these are. So you go to the Forex Factory and you see all this stuff and you're like, okay, I see red folder and orange folder. Those are the main ones I look at. I don't really watch yellow folder data. I just keep it there just in case something else pops up and I need to know about it, right? But let's say you don't know what JOLTS job opening reports is. You want to come over here to details and you want to click this little folder. It'll tell you the history. So when was all of the most recent JOLTS job opening reports? Because again, these report at different times consistently. So JOLTS job opening reports monthly. So you can see it every single month it's reporting and you can see what data it came back or how it came out, the forecast, and then what it was previously. You can also come in here and see what it measures. So Jolt's job openings measures the number of jobs opening during the reported month, excluding the farming industry. Now, another thing down here is why traders care. All right. Job creation is an important leading indicator of consumer spending, which accounts for a majority of overall economic activity. So here's what I would recommend. This is what I personally did in the beginning because it's kind of hard to remember all of this. I just take notes on all of them. I go to every red folder data and I just take notes of them. And then when that day comes up, you're going to come back in here again and you're going to read it again and keep reminding yourself every single day. This is the best way to understand what these are and to remember what they are and to understand how they can impact the market. Okay. Now let's say you want a better understanding of this. You can always just go over to ChatGPT and say, hey, break this down to me in a way where I can understand. Break this down in a way where a 12-year-old could understand this. Okay. So this is what I would recommend. This is what the Forex Factory is for. It reports data and important news and important events. So you want to make sure you keep up with this. All right. The next platform that I like to use is Unusual Whales. And the reason I use Unusual Whales is for their earnings. Okay. unusualwhales.com/earnings. Let's see if that works. There we go. All right. So that's the link you want to click on. This is going to show you all of the earnings for that week. So all the companies that are reporting their earnings. Okay. You want to go ahead and use this and be mindful of the top companies on this list because these companies are going to have reactions. Now, I don't trade things I just never really heard of, like LW or Calm or MSM. I'm not trading those. I'm trading things like Nike. I might see Space. You know what I mean? And if you don't know what these companies are, you can just go search them. You know, you got Beyond Meat. These are things that I might end up considering to trade. Okay. Now, after that, I also use CNBC. It's one of my favorite places. I have my phone notifications on. So I pretty much just get alerts all the time of this. And then I read these actual news articles here. You can also go to latest news and you can read these like stocks futures are a little changed after market starts new quarter off strong. So you can click on this and you can literally either watch the actual video of it breakdown or you could just read everything and get a summary of everything. I do this literally every single day. This is how I keep myself informed on the market. Again, this isn't, if you join TSA, you'll see I do this every single morning with TSA. We go through to the direct articles that we read to keep us informed. And I literally break down everything and how it could potentially affect the market. If you want to keep up with things, use CNBC. Okay. All right. Another one you can use is also Yahoo Finance. You can download both of these. I have multiple different news apps on my phone. This is how I keep up with everything. If something happens with the company or Trump says something or, you know, earnings, something happens or anything, I want to be up to date. So I also have Yahoo Finance and I have the notifications on as well. So these are the platforms that I use for Catalyst. Okay, these are important because you got to be informed before going into the market. So when you go back over to this presentation, right, during 8:30, when I'm getting to the market, I'm checking all of the calendars. I'm checking the economic calendar, right, which is the Forex Factory, and I'm checking the earnings calendar, which is Unusual Whales. Then after I go through those and I understand everything that's going on and what could potentially be happening, I go check the market. I go check SPY, I check QQQ, I check IWM, and then I go through my watch list. At 9 a.m., I already have my key levels marked out, but if you don't have them, just go ahead and research them and go through them, right? I build a watch list of setups before the market opens. And then at 9:20, I pretty much just check and say, hey, how much am I willing to risk on my trades or per day or during this day? And then 9:25, I just clear my head. I'm ready to go. I review my rules. So if you're in TSA as well, you know, all of these laminated breakdowns are given to you inside of TSA. So these are all different things like trading code of ethics, you know, daily trading plans. All of these things are things that you can print out and use every single day. So if you're part of TSA, you have these. But if you don't, if you're not a part of TSA, then obviously you'll have to build your own. Okay. And then at 9:30, whenever the market presents my opportunity or my system and my plan, I take the trade. Okay. So we already walked through how to read economic calendars, right? So this is going to be the impact level. So red is high impact. It can move the entire market. So you want to treat this as a danger zone. This is where a huge catalyst where something can happen. You want to be mindful at that moment. Orange is medium impact, yellow, low impact. So examples, again, we already talked about it, Federal Reserve rate decisions, non-farm payrolls, CPI inflation. You want to check this every morning before the market opens. If there's a red folder event, okay, within 60 minutes, right, you want to wait. So if there's data at 10 a.m., you want to look for trading after that, right? So you want to trade after the data comes out, trade the reaction, okay? Now, how do you build your watch list before the open? All right, so you want to start with your compass. You want to go through SPY, you want to go through QQQ, go through IWM. Go see what the rest of the market is doing. And then you want to go look at the Mag 7, or you want to go look at your particular watch list. So Apple, Tesla, Nvidia, Amazon, Meta, Google, whatever else that you want to really trade. And is there any news? Is there any earnings nearby? Is it gapping up or gapping down? What is the reason that these will be moving? If there's none, then just look for key levels. Look for strat setups on the daily or the 4-hour, and then look for key levels. Okay? Then you want to start filtering it against the CKSR. Now, if some of them don't match, it's fine. You don't have to completely not trade it. Right? But just keep that in mind. And then you just have your final list. For me, I always stick to just having between 3 to 5 at max as far as what I'm watching that day. 3 to 5. So it really is quality over quantity. Okay? So again, danger zones, what not to trade around, right? First 5 minutes, 9:30 to 9:35, be very careful. Earnings announcements before the earnings comes out, that's a gamble. Trying to take it before the earnings comes out and just hoping that it goes up, that's a gamble. FOMC, usually the market freezes in the beginning of the day, so you want to trade the reaction of FOMC, which is basically when we hear about interest rates, and then Fed Chair Powell. Fed Chair is going to be, when you're watching this, depending on when it is, if he's not there, the new Fed Chair, where they're talking about interest rates and the state of our economy. Okay, you want to trade after that, so it's at 2:30. You normally take a trade around 3 or 4, or 3 or 3:30. CPI, NFP, GDP, these are all things, again, just abbreviations. Go learn them when you go through Forex Factory. And then options expirations on Fridays, like OPEX, right? This is when multiple contracts are expiring at the same time. You got to be careful of that. So with that being said, the Sunday prep tutorial, I pretty much go through this entire thing every single week. So I go through my earnings calendar. I go through the economic calendar as well. I just keep in mind what days are what. Then I go draw all my key levels on the weekly and the daily timeframes on all my watch list. And then I pretty much review all of my trades from the last week. I go through my trade journal. I make sure I modify. I go see what I did wrong, go see what I did right. I go back through my trades from in the past. And then pretty much I set a mental game, like intention, like, hey, this is what I'm focused on doing. And I just try to show up every single day doing just that thing that I prepped over the weekend. Okay. How do you handle drawdown? Like when you're losing trades and things are going against you, like how do you handle them, right? And what do you do when you're on losing streaks? Okay. So here's some differences, right? So you have the wrong responses and you have the right responses. So the wrong responses is increasing your size to make it back. Huge no-no. Revenge trade immediately. Like when you take a really big loss and you feel your emotions kind of getting rattled, walk away. You abandon your system because it is not working, right? Remember, your system, if you have a 70% win rate, you're still losing 30% of the time. Nothing is 100%. So you got to keep this in mind, right? You start widening your stops to give trades more room. You got to be careful with stuff like that. And what ends up resulting when doing all of these is you destroying your account. The right responses is immediately reduce your size when you are on a losing streak. So if you have 5 losses in a row, right, just reduce your size on your next trade, right? If you need to step away for a little bit, step away. You want to also make sure you're reviewing each of your trades. So this is why journaling is literally everything. You want to also ask yourself, was the system followed exactly? Now, if it's not, then you need to go see, why did I not follow the system? And then you want to also, this isn't really important, I don't really hear too many people talk about it, but you want to look for patterns in your losses. Like, what are the things that keep happening over and over? Do you keep closing your trades out early? Are you not letting your stop loss hit and you're just closing it out of, you being fearful? These are things you have to spot. You have to spot these patterns, right? So the more you preserve capital when you're on losing streaks and you just go and learn quicker, the easier it's going to be for you to overcome it. Okay, so losing streaks happen to every single trader. I've been on countless losing streaks before, and I've also been on win streaks. So you got to understand that there's risk associated when being in the market, and you just got to learn how to handle that risk. Okay, so account growth and money. So the math behind building real wealth through trading. So what you can pretty much realistically expect at different account sizes. We're going to talk about a compounding roadmap month by month. How to scale without blowing up your entire account, and trading taxes. Now, again, I'm not a tax official or CPA, so I will kind of briefly touch on those things. But again, you should speak with someone who is certified. So compounding, again, I'm not big on looking for huge, massive wins out of the gate. No, even in TSA, we only focus on making anywhere from $200 to $400 a week. And for some people, that's like, bro, that's not a lot of money. Well, again, I'm not trying to teach people how to get rich quick. I'm trying to show people how to compound an account, how to grow an account, how to stay consistent over a long period of time, and then they see a 20% increase on their account. Think about it. If you're getting between, for us in TSA, we focus on, 4 to 8% on your account per week. If you can do that on week 4, you know what I mean, or by the first month, if you're consistent and you show up and you're hitting your goals, right? You can see between 16% to 25% increase on your account. That's huge. So like, how do you really scale an account, right? It takes time, right? You have to build the system first. Like, and this is why I said this earlier. In year 1, you're not focused on making a bunch of money. You're focused on building the system that can allow you in the future to make more money. Because again, when you're compounding, it's all based off of percentages. And one thing I always say in TSA is think in percentages. So 5% per month is elite performance. 2 to 3% is very good. Even 1% consistently. Like in TSA, we're hitting this way bigger, right? But compared to other people out there, and if you were to just go talk to an average person who's a trader, 5% on the account is pretty much a lot, right? But for us, that's normal. We get 5% in a day very often. So again, the goal is not to 10x in month 1. The goal is to have small, consistent wins and build the reps. It's not about making small amounts of money. It's about getting enough reps in so that you can actually see growth in your account and also grow as a trader. So like, obviously year 2, you want to see real income or real goal, or real money, but that might not even be the case. It might be year 3, year 4, where you start seeing real money. In most cases, it's going to be after year 2, literally. So, realistic income expectations after you have consistency, after you start really building the reps, after some time goes in and you get a mentor or something like that, whatever it is, you start really refining your system and finding what works for you, right? If you get a 5% monthly return on a 10K account, you're making $500 a month. Now, obviously you can risk more and you can also make more in a day, right? But these are just kind of like bare minimum, what you ideally want to look for. Do you need this much money to trade with? No. Okay. Again, year 1 is not the goal to make income or make a high amount of money. It's just building your system. Okay. Trading is a business, right? So if you add education and a system, this is a business. And this is why you build a business alongside the trading account. You want to build yourself into a business that trades. Okay. So what nobody tells you before year 1, short-term capital gains. Right. So again, I am not a tax official. This is me briefly talking on for this. None of this inside of here is financial advice. Got to be careful with certain stuff. Right. But when you're trading options, right, and you're holding contracts under 1 year, you're taxed at your ordinary income tax rate, same as your job. Right. If you reinvested your profits, right, you owe taxes on profits even if you reinvested every dollar. So if you take profits from short-term trades, like you take a trade and it's under a year, right, and you take those profits, you have to pay capital gains taxes on it, right? The wash sell rule. If you sell at a loss and rebuy the same security within 30 days, you cannot claim that loss. Again, you should speak to a CPA regarding this. Track every trade, record everything for tax purposes. Okay, so what I would recommend is setting aside 25 to 30% of every profitable trade for taxes. Consult with a tax professional, and just be careful with future things. Do not let this happen to you guys. Right? Calculating your real stop loss or your real profit and losses. This is pretty self-explanatory. I added this in here, but if you want to just screenshot it, you can. I don't really need to walk over. It's very self-explanatory. Plus, most of the platforms I recommended don't have commission, so it's not as difficult to calculate. Okay. How do you really scale your account, right? So let's say you're more aggressive. Again, everything, you have to learn your personality when you're going through trading and just going through this space, because there's different people who have different personality types. I might be more open to risk. So out the gate, I'm coming in and I'm risking more in my account. I'm risking more money. You don't have to do these things exactly to the T. I do recommend it in the beginning, but further down the line, you just need to build consistency around your personality. Find the things that work best for you. And the only way you can do that is through repetition and through discipline and through building a system and a plan that you can consistently follow. Now, chapter 9, what you can know. You pretty much know everything and, still lose money, right? So this is really the final piece, which is psychology, right? Psychology and your behavior, right? So we're going to talk about, the four huge psychological traps. I know this might seem like, I don't really need to hear this. Trust me, this is probably one of the most important things you need to hear, right? Processes you need to overcome, building your trade journal, and the honest truth about what comes next as far as trading. So here are the 4 psychological traps that destroy traders, absolutely destroy you. Number 1 is revenge trading, right? So this is when you lost the trade and you're immediately trying to get it back immediately. And the consequence of this is you start compounding losses and you start spiraling out of control. Okay? Revenge trading happens very, very often. And another thing is, like, when you have outside things affecting your life, right, or affecting you, you bring that into trading. So when you know you're upset, or you and your girl, or you and your man, or whatever it is, right, you and somebody got into it, don't bring it into trading. Don't trade. Take the day off. Next is FOMO, right? Fear of missing out. Is when you're chasing a trade after it's already moved, right? Like, it's, oh my God, it's going. I got to get in. The consequence of this is you're buying the high and then you're selling low, and then you end up frustrating, and then you end up crashing out, and then you end up revenge trading. So this is how, like, these things kind of work together. Moving your stop loss. You're telling yourself just a little bit more room, you know, and then what's happening is you're creating bigger losses. So the consequence of this is turning small losses into devastating ones. And you're just like, oh, I'm gonna just give it a little bit more room, and if it hits this, but it didn't hit, so maybe I'll sit in it longer, then give it a little bit more room. No, stop doing that. Oversizing after wins, right? When you start getting too confident, the market has a funny way of humbling you. So this is how you end up wiping out all of your previous gains in one go. So knowing the system is not enough. Executing under pressure is the actual skill you need to learn. So this is a consistency loop, like how profitable traders are built. So you execute the trade, you follow the system exactly. Then you execute the trade plays out, you log the trade, you journal it. So in a journal, immediately after the market closes, you journal it. You record your entry, the exit, the contracts you bought, why you got into the trade, what happened, what did you feel, what was the result, and then your emotional state. Next, you review the week, right? So you identify patterns and wins and losses. So find out what's working and find out what didn't work, right? And then you adjust one of those variables that following week, right? So you want to adjust one thing every single week to make sure you're not trying to change your whole system at once. And then you just repeat this process again. And you're just building better habits, and the cycle literally just continues and continues and continues. So consistency is not about winning every trade. It's about executing the same process every trade. That I want y'all to understand that. When I say consistency, I mean you're doing the same thing over and over and over again, right? You're doing the same thing over and over and over again. Let me drag this down a little bit. There we go. So first 90 days, what the learning curve looks like. Okay, so month 1, usually you're going to be confused, information overload. You had your first couple losses, right? And you're feeling like you're going to never get it. I promise you, keep going. When you get to that point, keep pushing forward. Month 2, the concepts start clicking. You might be feeling like everything clicks right now. I don't know. Let me know down below in the comments how you're liking it so far, right? But things might start clicking. Setups start making a little bit more sense. But you're still losing, but you're understanding why you're losing. And for that part, it can take months between that, right? Between that part and, you getting to beyond that, where you're getting some streaks of consistency. The CKSR method is feeling automatic. It feels like you understand. You're getting some small profits starting to show and building confidence. Now, I'm not saying this is going to happen in exactly 90 days. No, I'm just saying this is usually a path that people go down. And then what happens when you get to month 3 is this cycle starts over again, or you start crashing out. This is why being a part of a community is so important. It's why TSA, I feel like, is so important, because we have countless other traders who are trading with you who are all 2 feet in, which is why, when you click the link down below in the description, you'll see how hard it is to actually get into TSA and why we do open and close enrollment. So most traders quit in month 1. Either between month 1 to 3, that's when most traders quit. If you want to be a part of the top 1%, don't do what the 99% are doing. So when it comes to your trading journal, what do you want to track after every trade? You can pretty much feel free to screenshot this, right? So you want to track the date and time that you took the trade, the ticker that you took the trade on, and the contract you bought. Where did you enter the price and where did you exit? And then what was your stop loss? You want to also break down like what went wrong, or what went right and then what went wrong. One lesson that you could have taken away from that trade. And then you also want to track your P&L. So like, how much money did you make? How much money did you lose? What type of setup did you take? So did you take a breakout? Did you take a pullback, a reversal, a gap and go? And did you follow your checklist? Did you follow the plan? And then also you want to track your emotional state. Okay. Again, in TSA, we give you a full journal. So if you click the link down below in the description, we'll get you one, right? And then you want to review all of this every single week. So your journal is your coach. Without it, you're pretty much going in the same hamster wheel of making the same mistakes and not knowing. You can't grow what you don't track. So you're going to keep repeating the same mistake over and over and over again if you don't learn the things that did not work. Okay? The next thing, oh my God, so important, which is the comparison trap. This is why social media will destroy your trading. So you're seeing on social media 10x trade screenshots, huge P&Ls. This person made 50,000, this person made 30,000, this person's up $10,000 today. You seeing a luxury lifestyle. You seeing people with money. You seeing people clubbing. You seeing people living all the life that you want to live. But the reality behind this is there's 20 losing trades that they never posted. They manage their psychology for months, maybe even years before they even really start seeing consistency. Are they paper trading? Are they faking? Right? Or are they cherry picking days? Right? These are all things that are occurring. And this is the trap. You compare your real losses to their filtered wins. Remember that. They're not showing their losses. They're just showing you the wins. And then you end up quitting before you even develop the skill itself. So you never want to compare your chapter 1 to someone else's chapter 10. Your only competition is just you from last week, you from last month, you from last year. That is who you are up against, not anyone else. Okay? So, top 10 beginner questions answered. So, can I trade with little capital? Yes, you can, right? Just be careful when you're trading with little capital because pretty much you can only trade with like 1 or 2 contracts, depending on what you're trading. Small account, this is another gem. Small account friendly ticker, IWM. If you want to grow a small account, that's how you do it. Next question, do I need a special account? You need a cash account. You don't need a special account, you need a cash account. What time should I trade? Between 9:30 a.m. to 11:30 a.m. Eastern. Okay. How many trades per week? Okay, 1 to 2 max. Quality? No. I would say between about 3 to 7. 3 to 7 trades per week. What if I lose everything? Okay, that is why you have to start small. If you are risking at max 7% per day on your account, there's no reason you should blow an account in a week. How long until I am profitable, right? 3 to 6 months is a big no-no, right? It could take you years before you're really profitable. Now, yeah, can you be profitable right out the gate where like how much you have in is how much you put in and what you're at right now is higher? Yes, but can you sustain that? Can you stay consistent with that? That's the question you got to ask yourself. Do I need to watch the market all day? No, you just set alerts. Remember, set alerts, set alerts, set alerts. Is this gambling? Is trading gambling? Without a complete system, without using CKSR or some other system, yes, it is a form of gambling. What is the minimum to make in real income? I mean, there's literally no minimum, or I'm sorry, there's no maximum that you can make in trading. But as far as minimum, if you just stay consistent, you can make a couple $100. Should I quit my job? Absolutely not. Until you have full consistency, you're growing an account and you have, reserve capital set aside. Let's say, 12 months of your life expenses set aside, then that's when you want to maybe think about quitting your job. Right? So we already talked about the options Greeks, right? Let's see here. What else are we missing? So we already talked about using these as a compass. I just had a couple other things that I wanted to have on here. So this is a glossary, 20 terms every beginner must know. So you can just pretty much screenshot this. This is kind of like a little cheat sheet that I put together for you guys. So what I'll do is I'll actually just move my face here and give you a second to screenshot this. So let me do that. All right, and then go ahead and just screenshot this. You can either just pause it and screenshot it or just screenshot it now. Okay, so that's your glossary. It's kind of like a little cheat sheet I put together for you to make things easier for you. All right, now in this next section, we're going to be going over, a couple different charts, breaking down a couple different things. However, I do want to bring this up right now. If you're interested in something like this that is a little bit further in depth, I want to introduce to you the TSA bridge. Now, next up, it's time for us to go ahead and connect all the dots. So what I'm going to be doing is playing a couple different trade breakdown videos of trades that we recently took, breaking down a couple other things. I'm also going to add another video on how the strat works and how to really systematically use it in a way where it allows you to really be able to surpass your own level of expectations when it comes to trading, kind of connecting a couple more dots as well. So I'm going to connect all of those videos in here right now, and then you're going to see me at the end after all of those videos. And again, if you're enjoying this at all, make sure you leave a like. Let me know down below in the comments. It really means a lot when you guys tell me how you like it, and when you leave a subscribe and when you share with other people and things like that. So with that being said, I'm going to play those other videos, and then I will be back shortly. Make sure you go ahead and watch all those. Again, on the second time around, you want to go ahead and take notes. So yeah, I'll see you guys shortly. All right, what's going on, everybody? In today's video, I'm going to be breaking down a trade that we took today on HIMS that paid over 108% in just 3 minutes. I'll be breaking down the entry, why I actually like the trade, the exit for the trade, my thought process while I was in the trade, and a couple other things as well. So sit back, watch, and I hope you enjoy. So inside of this trade breakdown video, I want to explain why I actually liked HIMS. The first things first is your resources and making sure that you're informed. There are a lot of articles and a lot of pages and profiles that you can subscribe to on Twitter that I do myself that actually put out a lot of quality information. On top of that, you can use resources like Seeking Alpha, CNBC, things like that to keep you informed as well. So HIMS was actually one of the highest probability setups that I had for the day, simply because of the issue that they're having with their weight loss products. So the really cool thing about TradingView is if you click this lightning bolt at the bottom, you can come in and read about it. I actually read about this on CNBC, so you guys can just read the summary right here. But the U.S. Department of Health has referred HIMS and Hers Health to the Justice Department for a possible investigation into violations related to its weight loss medication. So I seen this at around 8 a.m. in the morning, and this is what put this on my radar. On top of that, I also seen that the stock was still getting beat up. It's been getting beat up for weeks and months now, but I seen that it was gapping down as well. So as you guys can see, we had this massive gap down to the point where we opened right around 1780 from closing at about 23 bucks the day before. Now, another thing as well is I always keep in mind the market structure on higher time frames. So the trend is always your friend. I never trade, or I try not to trade against the trend unless I'm going into a specific key level. Now, in this scenario, HIMS, I've been watching this since it was about 50 bucks, and it's just been getting absolutely torched, just creating a series of lower highs and lower lows, which means that it's in a downtrend. Now, for me personally, going into this setup, especially with a gap down, I was looking for a continuation, and that's exactly what we ended up getting today. So I actually want to walk you through the entry criteria itself and why I actually took this setup. So number one, gappers are one of my favorite setups to take, simply because they do have a lot of volatility, and if they have a good catalyst like this one does, with them being in trouble with their weight loss product, which is one of their main products, this is a huge catalyst for the company. Okay. The next thing is we had just broke under 20 bucks as well, which was another key level or a psychological level to watch out for. So I was also watching for this just to see, hey, do we break back above 1995, which is our pre-market highs, right? Or do we get the continuation that I was looking for where we continue to sell off? So basically, if we rewind this was the exact entry criteria that I had for the day. And I'll show you guys where I sent this out in the Discord as well inside of my group TSA. So this was our entry criteria. It was our pre-market highs and pre-market lows. If we were breaking back above 1995, we were looking for us to retest previous day lows here at this level at 2110, and then maybe fill the gap at 2271. And that's if people wanted to come back and start buying this company that's being investigated. So obviously with this type of catalyst, it is a bearish catalyst. And with that being said, I was already anticipating more sellers, more traders to be in this particular stock at open, obviously, especially with it gapping down. So again, these are just my guesses of what I thought would happen. We were also sitting under the VWAP. We had full time frame continuity to the downside, which made this a very, very high probability trade for me. If you don't know what this means or you don't trade the strat, this just means all of the higher time frames and all of the higher time frame traders are in alignment as far as what they're thinking that the market is going to do and the direction that it's going in. So the quarterly is red, the month is red, the week is red, and then if we broke under this 1761, it would flip the rest of these red as well, showing us that sellers are truly in control on all time frames. So in this scenario, my target was down here at 1693. Okay, my second target was 16 bucks. The only reason I had 16 bucks between here is because of the stock's ATR, which is something else I want to explain. So I usually turn this off during the day while I'm trading. But one of the things that I do is I watch the ATR. So the ATR stands for average true range. So this is basically how much the stock usually runs on a day-to-day basis on average. So, you know, HIMS usually moves about $2.15 on average. And today it moved about $2.50, which was 116% of its ATR. So how did I choose my strike price on this? So I did trade weeklies on this because that's just the system that we trade. We trade weeklies, you know, a little bit higher risk, higher reward, but we size correctly and size for zero. Now in this scenario, you know, I went about $2 out of the money. So if you look at where the entry was, I went to $15 puts. The reason I went to $15 puts is this is also a key level that I was looking at, but most importantly, the contracts had a lot of open interest and a lot of volume at open. So I was confident that I could get filled in this when it's time for me to get in, and I can get out easily as well. So if you're not watching for open interest and volume when you're actually getting into these trades, you should be doing that to save yourself in the long run. So what ends up happening is I dropped down to a 5-minute time frame, and I pretty much was able to watch how this ended up playing out when the market opened. So what you'll notice is in the first 5 minutes, it literally just dropped right under, and I took this entry right at around 1750 is where I got filled at. So a little bit lower than this blue line. I got filled and it just dropped like right out of the gate. You know, I got filled at around like, I can't remember exact number I got filled at, but I know as soon as the contracts open, I was already up about 20 to 30%. And sometimes, you know, especially with stocks that have spreads, sometimes you just get good spreads. This could have also been bad. I've had scenarios where I had a really bad spread and I got filled and I was down instantly. So in this scenario, I just got a really good spread. The contracts open, I was already up over 20% on the contracts. So it just made it easier for me to be able to sit in the trade and be a little less like nervous about the trade in a sense or anything like that, right? There was just really no emotions with it. I was just able to be confident in it. I seen that all the time frames were in alignment. In the first 5 minutes, it ends up hitting my first target. It gave a little bit more. I ended up closing out on this candle. And the simple reason was because I seen IWM that was moving, and that was another trade that I was trying to take. So I closed this one out looking to go check that trade, and I never ended up taking it. I did leave runners in this trade that eventually got stopped out. So what you'll see is this candle right here ended up stopping out all of my runners. So this trade got cut. And what I want to do is show you guys the actual gains from this trade as well. So this is inside of TSA, which is my Discord group. And you guys will see a lot of the wins from today. So SPX 270%, QQQ 112%, 350% on SPX, a ton of other wins as well. If we keep going, where is my screenshot at? Sorry guys, $1,000 in a day here. Got some paper trades in there as well. People getting started. Where am I? Okay, right here. So this was the trade that I ended up taking, and as you guys can see, the time that I ended up sending this out was about 9:40 a.m. So again, I was done within the first 10 minutes of the day just from this trade right here. And again, to kind of go back over it, it was already a gapper, so it gapped down from the day before about $4. So this is again what put it on my radar. It had a really negative catalyst as well, which made it an even easier idea to sell and to look for on a sell side. On top of that, we had all time frames in alignment, and we broke under our pre-market lows, and we ended up hitting our target here at about 1693. It gave a little bit more. Runners got stopped out, and you know, I pretty much followed my plan to the T. The one thing I will say as well is the contract selection was pretty much on point, because again, I use the ATR to kind of give me a gauge at how far price could go before it gets exhausted. So I was already looking at this and thinking like, hey, if we get to $15, it'll probably start consolidating around here. But for me personally, with the way that I trade, you know, I'll take a portion of my profits at 50% or 75%, depending on what the market looks like. And, you know, I'll take a portion there and I'll just leave runners. So in this scenario, the runners just got stopped out. And then the rest of the day, I think we ended up reversing on this later throughout the day, started consolidating a little bit. And yeah, ended up getting reversed back up to about 19.15, which was another key level. And then I think off of this level, we ended up reversing back lower. So again, this is why I, you know, genuinely enjoy trading key levels, because it's one of the easiest ways to understand where your target should be at. And when you use ATR, you can understand what options contracts to choose. When you use the strat, you understand actual price action and what the time frames are telling you, what the market is telling you, what traders are currently present in that particular moment. So yeah, this was a plus trade setup for me personally. Like I said, it took all of a few minutes. Like you can see that first 5-minute candle. As soon as the market opened, I took the entry. It dropped, it hit my target, gave a little bit more, left runners got stopped out. So within the first 10 minutes of the day, I was already done. And this is also why you see that the screenshot that I sent is also at 9:40 a.m. This is when I closed out my initial position. I left the runners and they ended up getting stopped out on that next 5-minute candle. So I hope that you guys learned a little bit about how I trade from this particular breakdown video. A lot of it is a little bit higher risk, higher reward scenarios. But we have particular setups that we look for that, they do pretty well. This trade right here might push me more into the swing trading side of things, but I just got to break it down to you because it's probably one of the most textbook trades out there. So let's actually jump straight into the charts. So this trade that I want to break down is actually going to be on Chevron. So if you guys don't know too much about me, my name is Dontez Akram. I've been options trading since early 2022. I've been long-term investing since 2020. And one of the most important things that I've learned over a period of time is to be aware of catalyst. So if you don't really know too much about catalyst, you need to look at things like data, right? So is there an FOMC? Is there CPI? Is there PPI? What are things that are going to move the market, right? So in this particular scenario, we had a geopolitical situation going on with obviously the US and Iran, and we start seeing a lot more money rotate into the energy sector and oil in particular. So this was actually a setup that I had seen yesterday, and I ended up taking it yesterday after a breakout above 190. So my entry criteria was exactly at 190. This was the risk to reward on the exact setup right here. I recently just closed this trade out right here. So our stop loss was right below here at around 188, what was this level? 188.50. This was the stop loss, and then we had our take profit here. Our main target was 200, but we start seeing some fatigue here. I really didn't want to leave too much of my position left over, even though I just was playing with runners. But I actually want to break down the setup, how I found the setup, my overall thought process, and how you guys could also do the same thing. I'm not here to sell you anything as well. This is just really some free game that I feel like will help a lot of people who are trading as well. So yeah, let's just jump straight into it. So number one of the first things that I like to look at is higher time frame confluence. And what I mean by this is before I take an entry, I need to make sure that there's an exact reason for me to take the entry. So with the way that I trade something called the strat, which are the numbers and the colors of these candlesticks, which is why it looks so different. And the reason that I actually trade the strat is because it gives me real data on when I should be entering based off of time and price action, which are the two most important things to watch as a trader and as an investor. So the first thing that I had noticed yesterday, because I took my entry yesterday about 2 hours before the market closed, is that we had a reversal on the daily time frame, and we were also creating this lower high, or a higher low, I'm sorry, right here. So when we seen this reversal, this is called a 2-2 reversal. This is confirmation that buyers are in control. But towards the middle of the day, I seen how bullish this candle was. So usually, when you see a candle like this is called a Maribozu candle, where there's little to no wick on either side of the candle, which is showing that one party is in control, right? So in this particular scenario, we had bulls were really strong, buyers were really strong, and we were actually coming into a all-time high level here at around 192.41. So this was the level that I was watching for, and basically when I seen this breakout above 190, I was just anticipating us getting back to 194, which is why this was my first target. Or 192.41. My second target was here at 194.60. My third target was up here at 200. I did have another premature one at around 198, which is why I closed the position a little early. But even now, looking at this, I might just re-enter the trade and play with profits on this setup. So again, I found this setup based off of the daily time frame. So when I seen this reversal setup here where we broke above the previous candle's high and we actually flipped into a 2-up, this was where my entry criteria had came from and where my bias had came from. The second thing as well is if you watch the news, if you're not too much of a catalyst trader, I would highly recommend, subscribing to things like CNBC, Seeking Alpha, all these different news articles and things like that. There's certain Twitter pages you guys can follow as well that keep you informed. But as I started to see different bombings of oil tankers and oil refineries, one of the things that I had noticed is that the US basically reached out and said that they were going to start unloading some reserves of oil. And that is not a good thing, because the thing is number one, it takes time for infrastructure to be rebuilt. So with the more bombings of these refineries, the more oil is going to go up because, yeah, let's say we sign a peace treaty. Yeah, oil will cool off a little bit, but it still takes time to get back to the same distribution level that we were once at. So this was one of the biggest things that I was thinking is like, hey, us doing that doesn't necessarily mean it's going to solve the problem, number one. Number two, the second thing that I was really thinking is like, hey, 200 is a really important level and we're at all-time highs. So another thing that I did is I like to use the rest of the market like a compass, or like second indicators in a sense, because I really just use support and resistance in the strat. But the other thing I was looking at is XLE, which is the energy sector as a whole. The first thing that I had noticed is, number one, if you're looking at oil stocks or energy stocks, they move as a unit a lot of the times. And what you can do is you can look at the sector's ETF to see how the companies within that sector are going to move. So if that sounded really weird, this is the perfect way to say it, right? XLE is the energy sector, right? CVX, which is Chevron, is within XLE. So if XLE is breaking out and Chevron is breaking out, it gives me more confluence. It gives me more confidence to take a particular setup. So this was also a trade that I sent out to my Discord because the contracts were a lot cheaper here, and we literally just bought time on it. And I'll actually break down a scanner that I built out as well that showed me basically which contracts I should be buying, and it really did a lot of the legwork for me. So I'll break that down shortly here. But even in this scenario, right, we had our all-time highs back here at about 57.88. When we got this breakout above this gap fill level at 56.50, I was very confident that we could at least retract back or get back to 57 and maybe even retest 58. But we ended up getting a stronger move overnight and coming into today due to a lot of the geopolitical events that are going on. A lot of the ways that I trade is really focused on catalyst, because I like to trade things that are going to move. I don't like to sit at my chart all day and things like that. I do a lot of short dated or short expiration contracts, so same weeks. But even on my CVX contract, I'll actually break down the, I'll actually go over and show you guys the actual profit screenshot here. So if I come over here and I come into the Discord, as you guys can see, so this was about 115% on this trade in particular. Yes, this is me. This is a live account as well. This is led me to about 10% on my account just from leaving runners. But the thing that I like to keep in mind with these types of setups is sometimes with setups like this, it may take a little bit longer, sometimes it'll lag. But the thing I was looking at is, hey, let me buy a little bit of time. 200 wasn't one of the main targets that I was looking for. So me going about a little over a month out, about 37 days out on the contracts, just made a lot more sense to me personally from a risk to reward standpoint. I was very confident that we can get to 200. I just didn't know, how long it would actually take. So I actually want to walk you through my contract selection process. So I actually built out this scanner right here, as you guys can see. And essentially what I ended up doing here is building a scanner for the members of my Discord. So this is only available to TSA. Again, I'm not here to sell you on TSA or anything like that. We only do open and closed enrollment. So by the time you're watching this, it's more than likely closed. But I'll leave a link down below that way you can actually learn a little bit more about TSA, and in the future you can actually see if it's something that you'd actually be interested in the first place. But what I basically did is I came over to my handy dandy options contract chooser. So basically the way that this works is I basically come onto here and I basically look at, all right, what options contracts going to work the best. So ideally, I already knew I wanted to be a month out, right? So yesterday was the 12th. So basically I went 4 weeks out. So 1, 2, 3, and then 4, which was the 10th, right? So you come down April 10th, and I was looking for calls, right? And then you basically type in the ticker that you were looking for, which was Chevron. So I clicked search. And the one thing that I had noticed as I did this, right, is the scores were a lot lower. So basically the way that we have it is it's basically scored on the Greeks and the open interest, the volume, and where the contract premiums are at, and the likelihood that it could actually end up profitable. And for me personally, I just didn't like the scores. They were really low, similar to how they are right now. So what I ended up doing, because I went through these and I realized, okay, the volume and the open interest on these contracts are really, really low. And usually what happens when there's low volume and low interest, it's very hard to get out of the contracts or get into the trade, but also get out of the trade as well. So this is something else, if you didn't really know too much about, that is really important. You need to have a lot of volume in order to get in and out of a trade. A lot of times as well, if you notice that there's a really low volume and open interest, then you'll have a really big spread, which is why the bid is at 555 and the ask is at 610. So this is also something when it comes to a contract selection that I always look at. I want to make sure that there's other people looking at the trade or already in the trade, so it's liquid. Basically, it's easier for me, or easy for me, to get in and out of the trade. So what I did is I said, okay, obviously the 10th is not the best. Let me go out another week, right? So I went to the 17th. And what you'll end up noticing is, boom, the score has changed. This was an 11 out of 11. But the number one thing I was watching is the open interest and the volume. So we had, at the time, this was yesterday, we had about 1,800 on the volume. On the open interest, I think it was around 14,000 or something like that, which was really good at the time. And I just basically took the trade. I sized properly. I sized the trade for 0. I had an invalidation point, which if I go back to the chart as well, so that was my selection process of the contracts. But if I go back to the chart and I drop down to a 30-minute time frame, so basically the way it worked is I waited for a 30-minute candle close above this blue line right here, which is at 190.07. That was my entry. Why did I wait for a 30-minute candle close? Because this is a swing trade that I was taking, so I needed higher time frame confirmation before I just took a trade, as opposed to looking for like a 5-minute candle close. So if you're day trading, or if I was doing short-term expiration contracts, then yeah, I would have looked for a lower time frame close. But for me, I was patient. I was okay with waiting. We already had really strong a really strong move here. We had equal lows back here, right? So it's basically like a double bottom where we came back and we ended up bouncing and moving higher. And then the catalyst just got stronger. And this is why I love trading catalysts, because a lot of times you could just be in the right place at the right time. And in a particular scenario like this, we also flipped into full time frame continuity, which is another reason I actually took this trade. So if you go up to the weekly time frame, right above 190, here it is right here, 192, this is where all time frames would flip green. And the reason this is important is because this means that all the participants who are trading, the people who are trading leaps, the people who are trading swings, the people who are day trading, the people who are trading scalps, all of those players and all of those individuals and traders are in alignment, or all of the time frames are in alignment. All of them are green, from the 3-month to the month to the week to the day. They're all green. So you don't want to bet against time frame continuity. You don't want to bet against the grain in a scenario like this, where all of the time frames are one particular color and there's very strong bias and very strong catalyst for a particular type of move. So this is another thing that I always watch out for. Again, we broke above our key level here at 192.41. We had a very strong move. We flipped full time frame continuity. So me getting in at about 190 was just an earlier entry from a daily time frame perspective. It was just a really clean entry, but this trade ended up paying out about 115%. We had quite a few members. I'll actually show you guys within the Discord. We actually had quite a few members who took this trade. So I'll actually show you guys that I alerted it yesterday, because obviously proof is everything. Proof is everything. So if I scroll back, okay, so here it is right here. CVX swing 417, $200 calls, size for 0. Invalidation point is a break back under 187. If you have a small account, this probably isn't a good trade for you, so you can watch for XLE or closer dated contracts. Bought time on this to see if the cons can get in the money before expiration, right? And then obviously we ended up having some winners. We took a little bit of profits at 50%. And then, obviously our last one ended up hitting for about 115% on the runners. So yeah, it was just a very clean trade. This took us literally 24 hours. You didn't have to sit at the charts all day. You didn't have to be super technical. You didn't have to look for a bunch of stuff. That was literally the only trade I had to take today. These are a couple of the wins from the other members. So about 93% here, 104% on XLE. I know a couple other members are still in the trade right now. We got a couple of people who switched to futures and are trading different things on the future side. So yeah, I wanted to break this video down because I think that it's pretty important to understand that number one, you can use the sectors as like a guide before taking a trade. If you're looking at trading, for example, tech, right? Or if you're looking at an example on Microsoft or a trade on Microsoft. during the time of this video, there's a massive gap down from 400 to 393. You know, if I see SPX and QQQ, let's say SPX is breaking under 6,700, QQQ is losing 600. And I'm looking at Microsoft and there's some bearish bias, right? Then those two things aligning helps me be more confident with actually taking the trade and either sizing up on it or doing my regular size. So I wanted to give you guys a little bit of insights on this trade, how I found the trade. Shout out to my scanner. It really just helped with the entire options contract selection process. It allowed me to be confident because the scoring is based off of actual Greeks and how the price of this contract moves, or the premiums of the contracts, and also the price of the stock itself and how it moves around certain levels. So that's a pretty cool tool that we have only for TSA members. This is a real system that we trade, and just a very simple process, and it works specifically for 9-to-5ers. So if you're a 9-to-5er or you have children and you want to learn how to make an extra $200 to $300 a week, I can show you that. So today we traded IWM, and this trade went well over 600%. I want to break down the trade live, how we came up with the trade itself, where our entry, where our exit, where our stop loss was, how you can actually use this on your own later, especially if you trade the strat. So let's get into it. So today we ended up looking at IWM, and the main reason was because we had a red folder day. Now, if you don't know too much about red folder days, they tend to bring a lot of volatility into the market. So if you trade things like IWM, QQQ, or SPY, those are amazing days to catch really volatile moves, or moves that can pay a ton in a very short period of time. So this was our focus of today, coming into this day and already anticipating that, hey, there's going to be a lot of volatility on our main tickers, which was IWM, QQQ, and SPY. And they all pretty much had the same setup, but I actually want to break down the psychology behind it so you understand why it was such a high probability setup, and yeah, you guys can have just an overall better idea of how it works. So the first and foremost thing is we always do top-down analysis. So for us, since we day trade, obviously we'll start either on the weekly or on the daily. So in this circumstance, we ended up starting on the daily time frame. Now for us, when we first looked at this candle had not opened, and we were gapped up just slightly here at open. So at open, this candle ends up opening around 264.18, and as you notice that we opened at around 260, or we closed yesterday at around 263. So there was a very, very small gap, but it was still something important to recognize. Now, the other thing I want you to also recognize is this key level, which is also in alignment with previous day highs. So one of the first things that I noticed when we came to the daily time frame is that we have rejected this same exact or this same exact line or key level 3 times, which is 265. So you have the first rejection here, the second rejection here, the third rejection was yesterday. So what we were anticipating today is, although the market structure looks to be continuing in this uptrend, during the more recent time frame right now, it doesn't look as strong to the upside. Now, if it broke above 265, which is also our previous week highs, then yeah, we would definitely want to go for it. But this is another reason that key levels are so important. When you want to watch, you really want to watch for those weekly and monthly levels, along with yearly, of course. But the weekly and daily and monthly levels are really important if you're going to be day trading. So this was the first thing that we seen, the rejections multiple times. So we were already coming in with like, okay, we need a little bit further analysis of what could happen. And this is when we dropped to the 12-hour time frame. Now, the reason the 12-hour time frame was such an important thing is because one of the things that we noticed is price had, like I said, gapped up above this previous 12-hour candle. Now, our anticipation was, hey, we would be a bearish day and we would confirm, right? We would confirm a rejection here if we broke the previous low. So the way this works, and I want you to really think about it, is yesterday we rejected these highs that we've already rejected 3 times. If we cannot today get through this key level, through this high of yesterday, then the likelihood of us selling off is very, very high. Now, yesterday we already had a very, very volatile day. If you traded yesterday, obviously, you know, but you can tell from this 12-hour candle, we had a very, very volatile day yesterday when the market just completely dumped and then got bought right back up. So we were already anticipating that, hey, we either get a lot of consolidation today or we get another really crazy day, especially with us having red folder. So one of the things that we had marked out was this candle right here, which was us anticipating that this thing goes 3. So remember, price opened here and we started pushing up right out of the gate. So at first, this was a 2 up. It wasn't until it started coming back through where the price opened at here until we realized that, hey, this is a failed 2 and we are anticipating this going 3. Going outside of the range. So what we ended up noticing is, okay, we see that the 12 hour is also in alignment, but the 4-hour time frame. So the 4-hour time frame before the market opened had already been inside. It had not triggered, or I think it just triggered, right at the end. So this candle here, although it's sold off now, at first when we were looking at this, it had already pushed above this previous high. So we were looking to say, hey, this is a true move higher if we hold and break above this next key level. But as you can see, we never did that, and we ended up failing. So sellers were more in control here at this level. Now, it's in a very similar space as these. Obviously, it's not rejecting off of the exact key level, but it is very close. So with this being said, once we notice price go back through the 4-hour candle, again, you could have taken the 50% of this 4-hour candle, anticipating this switching into a 3-bar, or you could have just waited for it to flip into a 3-bar. So remember, the only time you have a 3-bar is when price breaks above the previous candle. So let's say we break above here, which had already happened at open, and then it fails and comes back to take out the opposite side of this candle, which is here. This is what makes it an outside bar, when the candle that you're looking at breaks the high and the low of the previous candle. Okay, so I just want to make sure you guys understand that. This is why it flipped into a 3. Now, one of the things I want you to notice is that, remember, this is our 12-hour 3-bar, which is a 3 reversal, right? Now, one of the things I want you to again look at is how in alignment this is. If price breaks through this 4-hour, it's showing us that we're bearish. If we break through this level, it shows that we're also bearish on a higher time frame. Now, one of the things that we were targeting is our previous day lows. So I actually want to show you this on, let's go ahead and we can actually leave this here. But I actually want to show you this because this is pretty important here. One of the things that we were looking at is the 1-hour as well, right? So what I'm doing is, again, top-down analysis. Now, mind you, obviously none of these candles had opened at that time, right? As far as how they played out, but I will show you the risk management and actual trade setup. So again, we were anticipating data at 10 a.m., but the next most important thing is we had volatility combined with another very volatile candle. So this is showing we broke the previous high and low, and then this candle broke the previous high and low of this candle, showing us that, hey, there is a lot of volatility and it's loading up. That's basically what we're looking at. This candle, once it printed, we were very, very confident that either A, we break through this opposite side, or we continue the sell-off. And you'll notice that this kind of looks very similar to what happened yesterday, okay? Now, what we ended up doing, how did we find our entry, right? So number one, we had some members enter off of this 12-hour candle here. So as soon as it broke these lows, ended up selling off slightly, okay? Now, for the rest of us, we waited for the 30-minute orb, okay? We waited for the 30-minute orb. So we wait for the first 30-minute candle to print, and we mark out the high and the low of this 30-minute candle, and you're waiting to see, do we break above or do we break below, and you're taking that entry, okay? Now, in this situation, right, this is why we size our trades for 0. When we took this entry, which was right here, price ends up reversing and going right against us. And at the time, this trade was down about 30% or so. But again, we sized for 0. We entered the trade with an amount of money that we're okay with losing, and then we just set and forget. Set and forget is just basically you set alerts at your target. So our first target was down here at 260.70. Second target was 260. Third target was previous day lows at 258.55. Now, if I rewind this, I want to actually show you what was going through our mind, okay? So we ended up getting this hammer right here that formed off of the lows of the 30-minute. So the first thought process I had was, this might have just been a fake out, and this trade might just be red, and it is what it is. I'll let it die, right? But it wasn't until we got up to the VWAP until I realized that, hey, price is actually rejecting not only these lows from the first 30 minutes of the day, but it's also rejecting the VWAP here. And this is where I said, okay, maybe we're not completely dead yet. Again, this is why we size for 0. I set and forget. I lock my phone. I walk away. I go to the gym and work out. I have my alert set at 260.70 as my first target. Second target at 260. Third target at 258.55. So if you haven't watched the video where I break down, how to position your trades, basically we buy our trades in thirds. So if you're trading options, what we'll do is we'll buy 3 contracts. I'll sell 1 contract here, second contract here, third contract here, and I'll just adjust my stop loss on the winning contracts. So here's what this actually looks like. We end up taking the entry here it fakes out against us. People are like, oh my gosh, you can probably see it in the discourse, like, oh my gosh, this trade might not work, the whole market is reversing, blah blah blah. I say, hey, set and forget. It either works or it doesn't. This allows you to be able to walk away, work your 9 to 5, go live your life, and trade on autopilot. Okay, what ends up happening is price confirms this downside move, and it confirms that this here is just a lower high. So when you compare this high to this high, it is a lower high. When we broke this structure on the low of the day, I was very confident that we were going to take out my first target, which, as you guys can see, ended up taking out this first target. Now, since this is a gap fill, a lot of times what will happen is when a gap gets filled, you'll start seeing buyers step in. But what I did also know is that this was recent as far as this sell-off. So I was very confident that this right here would continue going lower. And as you guys can see, this failed too, ended up breaking higher, retesting the VWAP, but look what happens afterwards. Ends up giving you a fail too, and it reverses right back lower. So a lot of times when price is sitting under this VWAP, it'll come back and retract to it. And especially if you're in a downtrend, which is why market structure is important, right? This looks very similar to what happened yesterday, right? But when you're in this downtrend, a lot of times price will come back, retest it, and as long as it doesn't close above the VWAP and start pushing higher and break this structure, then you're pretty good, okay? So the way our stop loss looked on this, right? And again, we're sizing for 0, so you can pretty much, you don't really necessarily need a stop loss, but this is how it would look. Your entry is here. You'll put your stop loss right here. And then your target would be, again, like I said, 260.70. Now for us, since we trade options, obviously risk to reward isn't something that really matters as much because we have Greeks that affect our contracts, but it allows you to be able to, at least for me personally, it helps me sit in trades longer because it's like, hey, did my target get hit? Yes or no? So this is our main target of the day. We just had some other ones as well for partial profits. And ideally for me, I will tell you, I do take partials at my first target and then I leave it for my main target down here. And this is usually called an extreme target. Like I said, if you haven't watched the leaving runners video on my Twitter or on YouTube, feel free to check it out. It is free, so obviously you can check that out. But yeah, as you guys can see, once another thing that I also do, just so you guys understand, is like I watch most of the chart on the 1 hour time frame, just because a lot of times on the 5 minute it's too much noise, right? Like I don't need my emotions to be heightened, at least for me personally. Other traders might, look at things differently. I'm just showing you what has worked for me. I'll watch it on the 1 hour because it's less noise and it allows me to stay confident in the fact that, hey, if we continue breaking the lows of the recent 1 hour candle, then the trend is still intact. It has not broken, okay? So what ends up happening is price comes down, right? And then as you guys can see, we ended up retesting not only the previous day low and broke lower, but we also tested the weekly lows here, which was previous week lows, which is why we had this marked out. And then, yeah, that was the trade. I actually show you guys some of the profits from the Discord. So this is inside of TSA. But as you guys can see, most of us ended up taking this trade. I called it out in the beginning of the day at around 9:40. But Drip, he made about almost $700 off of this trade. He traded SPX as well. So another thing is I'll use SPX and SPY and QQQ as compasses. So if I see IWM is breaking under SPX is breaking under 6,900, and then also IWM has a lot of bearish momentum, we're also breaking 12-hour daily levels or 12-hour and the 4-hour levels, I'll be more inclined to take that trade and size for 0. Again, one of the cool things as well is we have people with all different account sizes, all different race groups, all different belief systems, all trading in a family setting. As you guys can see, last run on IWM, this trade went 226% on that last runner. Someone took the same exact trade. Again, it just goes to show you don't need a ton of money to get started. To turn $10 into $70 on these contracts. And then on these ones, he turned $15 into $105, which is a 700% return. If we keep going up, obviously we have people who paper trade, but we also have other individuals, again, like I said, trading the same exact system. If we keep going up, Gabe, he's actually been a part of the group for I think a little over 2 weeks now. This is his third $1,000 day in a row since joining, so I think he's compounding pretty nicely. I can't complain. $184 here on IWM. Shout out to Chris. His account is up 520% in a month, which is insane. Past week it's up 82%. 19% on the account in a day. $1,800 a week is green. Past 2 combines. So this strategy does work. It does work on futures as well. So again, this is something you can try out. Juju, he actually had his first $1,000 day trading IWM. Again, goes to show, as long as you have a something that you can show up and execute on, then it works for you. Good enough. 1 runner left on IWM. I ain't gonna lie, this is my first day over $100. Love to see it. You got to start somewhere. And then as you guys can see, a ton of other wins as well. Locked day past 2 funded accounts. So that's the same person, $400 on the day. And then of course I took the trade myself as well. Closed out a little early, which is all good, but it ended up working out perfectly. Have you ever heard somebody say, yeah, just trade the trend? And then you thought to yourself, like, what exactly does that mean? In today's video, I'm going to give you an accurate description and breakdown of what exactly that means, how I trade the trend when using the strat, things that I look at to make sure that I am on the proper side of the trend itself, and overall efficiency processes that I look for when trading this trend or just focusing on a trend in general. So the first example we're going to talk about is going to be Chevron. Okay. Now, it's actually going to be one example combined into two. And the way that I want to break this down is the oil sector. I have been making a couple tweets about it, and it's been literally one of the only sectors that I've been needing to trade ever since the Iran, Israel, and US geopolitical issues. So the first thing that I want you to understand is that I trade something called CKSR. It's just an abbreviation for catalyst, key levels, strat, and risk management. Now, I do break all of these down in depth inside of TSA, so if it's something you're interested in, there's going to be a link down below in the next post or in the description where you can check out TSA and see a little bit more about how it works and if it's something that fits you. Now, the first thing that I want you to understand is a lot of times when you're trading the trend, sometimes you could be trading false trends. So for me personally, I only trade things that have true momentum, things that will actually move. And a lot of the times people may ask, hey, how do I know that? You have to be informed. And what I mean by being informed is you have to be searching for the information. You have to chase your curiosity. You got to see the CNBC articles. You got to see if Trump is tweeting. You got to know what data is coming out. You also have to understand sector rotation. What is sector rotation in depth, and maybe a little bit of a simpler way to say it because it might seem intimidating? Sector rotation just means when money is flowing from one sector of the market, it's going to flow to another. So a lot of times when you hear people say it's risk off in this sector, that means that money is kind of flowing out of that sector, maybe into another one, or investors or smart money might just be going and staying cash for a little bit of time, which is definitely very possible. So the first thing I want to break down again is Chevron. Now, the first thing that I want to, accurately describe here is catalyst. So we talked about that, headlines, news, data, things that are going to actually bring more traders or just people in general to trading this particular stock or sector. So the oil sector was just the main one we've been trading. We've literally been taking trades all the way back here. So for the last month or so, we've just been killing Chevron and XLE. Okay. The second thing is the key levels. Now, this is something very, very important. When we started seeing this whole Iran and Israel situation pop off, you've seen an immediate increase here in this week right here in oil, right? And Chevron in particular. The first thing that I want to identify is where was our most recent all-time highs, right? So a lot of times we may either take, especially if you're trading the trend, you want to be taking the break of the next high, right? Now, what do I mean about that? Every sense or every level here, right? So this is a higher low. This is a higher low. These up here are higher lows. And again, you have higher highs. Higher highs, higher highs, higher highs. Basically what these means is every single high has been higher than the most recent one. This is the trend. This is how you identify it. Now most people may say, yeah, that's pretty simple. It's right there in your face. Absolutely, but most people don't know how to trade it. You have to use key levels, at least for the way that we trade and the way that we use the strat. So a lot of times, especially in scenarios like this, okay, when you have a strong pullback and then a move like this, one of the most important things that the strat teaches you is how to properly analyze a candlestick. Now, a lot of people don't talk too much about it, but it's been a true game changer for me personally, so I can only speak for myself. What I mean by this is being able to identify the type of candles that are being printed. So if you look at this candle and you were to read this, somebody would just say, hey, the buyers are in control. The way that I read this and the way that I teach it within TSA is that this is a strong bullish candle. And what I mean by that is there's very small wicks on each side, but the most important side is the upside. When there is a very, very small wick to the upside when a candle closes, this means that the buyers are very strong and they have control of the situation. So when it comes to being in a scenario like this and you're closing just like this, a very strong candle close, you had a strong move up this day, and you're coming into this key level, which was also your all-time highs, you have to be okay with trusting your system enough to size into trades like this and even size up a little bit more than you normally would, which is what I did in this particular trade. I took the entry on 192.41, okay? We ended up gapping up slightly. Now, another thing as well is when you're trading the trend, a lot of times what will happen is you'll see a stock continue to gap up, or continue to gap down, continue to gap down. And these are opportunities for you to realize that, hey, this thing is continuously being sold off or it's continuously being bought up, and it's getting bought up overnight. It has a lot of momentum. It has a lot of strength. And a lot of times that's why we trade the catalyst with it. So when it's breaking through key levels, we know it has the volume to continue running, if that makes sense. The next thing from there is just the strat setups, right? So you have a 2-2 continuation here. This is just showing you that, hey, you have a strong move by buyers and then a strong continuation by buyers. We ended up having some consolidation. Then we kind of lost a little bit of steam. You did get a break back above another key level and we broke 200, which is a round psychological number. The question you might be asking yourself is like, hey, Tez, like, how are you getting all of these lines? So I'm just using the daily support and resistance levels, right? Like the way that I trade, I use the strat to know when to get in and when to get out. And then I use key levels to give me a better idea of what is my ceiling and what is my floor and how are we holding up against these levels. A lot of times at these particular levels, you'll get actionable signals, meaning it's a candlestick that prints a certain way that tells a story, and whether or not you listen to that story and you take action is completely up to you. And what I mean by that is if it's an actionable signal, you want to do something. Now, whether you do it or not, again, is up to you. So in trading, right, a lot of times when you're identifying the trend, you have to consider the fact that A, you want to only trade the trend, and then B, there are going to be sell-offs. There's going to be times where it pulls back. And during situations like this where it has very, very strong momentum, I am not looking to take shorts in this scenario. I'm okay with just letting it drop if it wants to, or looking for bounces off of levels similar to this situation right here where you had the shooter candle or an inverted hammer, right? And then this next candle ends up opening gap down. And then what happens is we move back to 197 and then we explode off of this support level. But you will notice back here, okay, this was also recent resistance. We have rejected this once, rejected it twice, even rejected it here, and we opened at this same exact level on this day. So us coming back to here, somebody might be like, well, you know, I wouldn't have known that that would happen. Well, if you had your levels marked off, you probably would have been a little bit closer to knowing that it would happen than others, okay? Now, nothing works all the time, but it gives you a good idea of what to potentially look for. The other thing as well is when I'm trading something like Chevron or any other stock, I'm looking at what sector it's in. So we know that Chevron is in the same sector as what? The energy sector, which is going to be XLE. So the thing I'm going to do is I'm going to come over to XLE and we're going to look at the daily time frame. And when I'm trading these, this is how it looks. I am using the sector itself, okay, which will have more volume than just the one ticker. I am going to use the sector as a compass. I'm going to use the sector as another additional indication or indicator, right? That you would, you know, normally a lot of people have a bunch of indicators. Even me, I might have far more indicators than you probably have, but I'll use this as a guideline, okay? So if I see XLE, right, it pulls back, retest the VWAP, gets very close to it, and then we have a strong move higher. When we break the next high, I am looking to take this break. Now, if you notice though, this break at 60.26, which is the all-time high, was also this break here, which was our most recent all-time high on XLE or on Chevron, right? So if you look at this candle, it's literally the same way. And once we had this close, you can just look for the close above here and take the move higher. This is also another trade that I ended up taking. When I seen that this candle was closing like this on the daily, I took calls going into this at the end of this day. Just so happened to gap up and move higher. It was an easy, quick trade. So when something is in a trend, I want to continue looking for the upside moves. I want to look for opportunities to actually take this trade. So even if you look at, you know, the lower time frames, right? Let's look at today. there's no way, this is actually a setup that we sent out in the Discord. There's no way I'm looking to take shorts on something that has been this strong on higher time frames. So remember, the lower time frames a lot of times are liars. I only use the 5 minute for execution. Like when I'm ready to get into a trade, I'll wait for a break and close, or a break and retest above my entry or below my entry. And in this scenario right here, okay, this is Chevron, and this is literally today. We sent out this this trade because we were doing a 2-2 reversal on the daily. So what does that mean? You had sellers during the daily. We gap down, okay, or we gap down. We tried to move higher. Sellers were in control, and it closes. The next day we gap up, and this is today, where we ended up breaking the previous day's high. Now, what do we know about previous day highs or previous day lows? These act as key support or resistance levels, right? So what ends up happening is when you have a candle that breaks above the previous candle's high, and it's also going into a reversal actionable signal, that's per the strat, okay, then you drop to a lower time frame and you look for the entry, okay? So you would come into today and you would say, hey, if we break above 207.24, I'm looking for calls, and then you would just have targets to the upside. Now my main target is 209. I am actually still in this trade, even though we got a little bit of a pullback here. We bought a couple weeks out because it's a swing. Now, if we drop to the 5 minute time frame, where am I looking to execute the trade? Where am I looking to get into the trade? So if I know that 207.24 is my entry level, okay, what I'm looking for is a close, okay? So look, we have a break, a retest, even though this candle closed, we have a break, a retest, and then a move higher. This confirms that this has now become support, and now price is bouncing off of this level. So I'm just using the 5 minute as confirmation for my entry. For me personally, I took the break of 207.58. The reason being is because this is a gap fill. Usually gaps turn into support or resistance once that price is hit. So I just wanted to confirm that, hey, we don't just run straight into a ceiling and then sell off. I said, hey, I'll wait until we break above this level. And if we close above this level and even get a retest, that's even better. So that's what we got, a break, retest, and then a move higher. Once we broke here, I just took the entry. We're floating in profits right now. As you guys can see, we ended up pulling back end of day, retested this level, and then just, you know, we'll see the rest of this week how it turns out. I think 210 can be hit. So I hope this gives you guys a little bit of an idea of how the trend works. Again, what I will be doing here, if I'm trading the trend, I want to also see that the sector itself is also moving the same way. So if I come in, look at XLE over here on the 5 minute, okay, it's the same exact thing. The sector itself is breaking out into new all-time highs here, right, above 61.20. This is also an entry that we sent out, right, in the Discord. I'll actually show you guys in a second here, but this is also an entry that we sent out, and then you just had a break, continuation. Did we ever hit our main target? No, right? But this is where, you know, if you bought, you know, contracts that are swings, you're probably still in them, or if you just took profits at somewhere in this range, then by all means, you know, you had a green trade. So just for proof purposes, right, I'll actually show you guys the Discord where I actually sent this out. So we do pre-market calls every single day, Monday through Friday with me. I don't just outsource it to somebody else or anything like that. I do them myself for the time being. And then if we come over to the day trading signals channel, in the pre-market calls, I don't believe in just sending you signals and just hoping you pray and hit the trade and do all that good stuff. No, you know, I would like for you to have analysis and context before you take a trade, so you know how to do it on your own. You should never be waiting for someone's signals or anything like that. So during this pre-market call, as you guys can see, we sent this out. I sent this out at 9:14 a.m. Trade idea, Chevron sold off a bit yesterday, but gapping up in the pre-market hours, only looking for calls as we flip back into full time frame continuity. This means when all time frames are in alignment, the hourly, the daily, the 4 hour, the weekly, the month, the quarter, when all of them are in alignment, there's no way I'm looking to go the opposite direction. Okay, so I'm looking to trade the trend. That's another reason I love the strat, is because it teaches you how to focus on the trend itself. So as you guys can see, we have a full time frame continuity reversal date on the daily at 207.30. Look for calls above the gap fill at 207.60. I sent this out. If we look at XLE, trade idea 326, XLE looking for a trend continuation. Look for calls above 61.20. As you guys can see, it was the same exact thing, and I sent this out at 9:17 a.m. This did pay pretty nicely. I am still holding this trade right now, but I did want you guys to kind of understand how this worked. You know, we seen the same exact thing with gold some time ago when commodities was just kind of just hammering and just going crazy, which was sometime back here. And now what you're seeing as well is a extreme trend to the downside. And even now, look at this, gold is sitting at 400. So I would just set an alert here and say, hey, if gold breaks below 399.50, there's a high likelihood we can see this other key level back here at 399.69, right? So now, or 393.69. So now what I'm looking for is an actionable signal on either the daily or the 4 hour or something like that, to confirm that this is going to continue moving lower. So again, when you are looking at things like a trend and things like that, in the situations like right now, when it comes to trading Chevron and trading XLE, this has literally been the only trades that we've been needing to take. And the reason that we've been trading is because it has a catalyst, right? It has a geopolitical event going on. There's also money rotating into the energy sector, rotating into the oil sector. And it's because, you know, a lot of people have a lot of uncertainty in one area, and this one is having a supply issue. The more oil that was created in Iran and in the Middle East is being bombed, there's just a lot more uncertainty. And usually what happens with uncertainty when it comes to supply, the demand goes up. So this is where money is rotating to, which is why it's called a sector rotation. It's also why, if you look at XLE, it's been the inverse. Okay, what do I mean by inverse? QQQ, it's been the inverse of the tech sector. So if I pull up QQQ, what will you notice? Money is rotating. Now, do I know if it's rotating directly from, let me put this on a 30-minute, directly from the tech sector straight into oil or energy? No, right? But what I can do is take a guess that, hey, this has been this way for some time, for the last few weeks, where XLE has been doing the exact opposite as QQQ. So if you're not really good taking shorts and you want to look for upside moves, then guess what? You would come over to the sector where money is flowing into. So as of right now, what you guys are seeing is, hey, QQQ sold off this entire day. This is about from 584 to 573. This is about an 11-point move, which is pretty huge. Now, did XLE have that big of a move? No, it didn't. And this is where you can, based off your personality and based off how you trade and your strategy, you can look for certain setups. We did send out puts on QQQ under 580. It's a round psychological number. And once we broke under, you had a gap fill to 576.88. It took all of about 2 hours or so for you to hit your target. It gave a little bit more towards the end of the day, so you would have gotten paid if you would have got 0 DTE or 2 or 3 day out contracts. But yeah, hopefully this gives you guys a little bit of context. I wanted to post this because a lot of people have been asking me, like, why am I trading oil? Especially when I trade options, you know, it's kind of a little bit different from what most people would be talking about. But it's because that's where the money is. You know, I'm not any smarter than you. I'm not a genius, and I'm not even the best trader. Honestly, I'm not the most profitable trader. I do pretty well for myself, but I pride myself on helping people who work 9 to 5s and have children who have short periods of time to just learn how to make $200 to $300 a week. Granted, yes, we do have people who make far more money than that, but you know, for the most part, I think that it's something achievable, and I think that $200 to $300 a week over the course of a month, that's about $800 to about $1,200 a month. I think that can change some people's lives, especially if you work a 9 to 5 or you have children. So what's going on, everybody? And in today's video, I'm going to be breaking down how you guys can sit in your trades longer, especially for options traders. I know this can be somewhat difficult. It was very difficult for me. So right now, I'm not saying that I'm perfect or anything, but if you're the type of person who is struggling with catching 100% plus trades, because I was doing the same things, making the same mistakes over and over and over, getting out too early, maybe sometimes holding too late, so on and so forth. This is specifically for you, and or you're just not letting your profits get hit as far as your take profits. So this video is specifically for those of you guys who are having those troubles. So let's just jump straight into things. So I'm gonna do this example on QQQ, and we're gonna probably pull up notes as well and kind of plot some notes and maybe even type it out on the screen here just so it's a little bit easier for you guys to see as well. So just pay attention and let's lock in. So the very first thing I want to talk about is obviously, when you guys are taking a trade, the very first thing that you should always do before getting into the trade is know where you're getting out of the trade. And, especially for a lot of people when they first start off, even for me, the easiest thing is taking on the trade. The hardest thing is knowing when to get out and being able to deal with the emotions that come when it comes to closing out profits or closing out in red. And that sometimes can be very difficult for a lot of individuals. So right now on QQQ, right, this is actually yesterday. So the market is currently open. I can show examples on today as well, but I want to start with yesterday and kind of work my way backwards just so you guys can see how often this does work. So the very first thing is, again, you have to know when to get out. So if I go up to a higher time frame, right, and I have these levels marked off, all these levels are just key levels, right? So these are just support and resistance on either a daily or a 4-hour time frame. And so I just mark them out. And basically the way I do it is I mark out my most recent highs, so previous day highs and lows. Then I'll go previous week highs and lows. I'll go to all-time highs. I'll go to deep retracements. So back here, this is where price bounced from. We bounced from this level here. So these are two very significant and key levels, 600 and 596. So same thing to the upside, right? A key level will be 612, 610. And this is how I find these levels. So this is where the levels are coming from. So as price breaks through certain levels, I know where price can go because I already have targets set. So we'll talk further about that as well right now, okay? So we talked about having levels. You always want to know when you're getting out of the trade. Now, when you're doing options trading, it's kind of difficult for you to, if this, target gets hit right here, I should be up 60% or this much money. It's a little bit more difficult because there's so many Greeks and there's so many different things that are affecting the contracts themselves. So let's kind of talk about this now. So let's say, for this entry yesterday, right? We can even look at this on the 1-hour time frame because it'll be a little bit cleaner, right? Actually, a 30-minute is fine. We can just stick with this. So here on QQQ, right? You ended up first off marking out that the fact that, hey, price has been kind of sitting in this pre-market high and low range in the beginning of the day, right? And then we broke the downside. So, this 3 bar is an actionable signal per the strat, right? So let's just say you don't even know the strat, right? Let's just keep it simple. Let's say, price broke previous day lows, which is right here. Right, this is the level that you want to have marked off. And when we broke these lows, we had a bit of a retracement before we broke lower. So most people, when they take this trade, right, whatever your entry is, whether it was this level or this actionable signal here, whatever strategy you trade, right, most people don't really have a lot of targets set out. So when I enter the trade, let's say I do take, the break of this, previous day lows. Let's say I take this entry, right? The first thing is, let's say I take it on this candle here, right, just for example purposes. You got to have your targets laid out. So I have target 1 right here, which is a gap fill. And then target 2 down here at 604. And then target 3. And then you can have an extreme target. So I usually keep 4 targets. My last target is like an extreme target. The reason I call it an extreme target is because the likelihood of it getting there might be lower. But it's still possible. As you guys can see, this happened yesterday, right? So the very first thing is, like, when you enter the trade, knowing where to get out, right? So, obviously you have your first TP. So the first tip that I would give you guys for sitting in your trades longer is buy more contracts. Not saying raise how much money you're spending. I'm saying buy more contracts so you can leave runners. So what do I mean by that, right? Let's say, you have a $5,000 account. And this trade, let's say, one contract is $50. You know what I'm saying? You might be trading with maybe 10% or 5% of your capital. So $250 or $500. Well, I'll buy, maybe 6 contracts of this, right? And the reason I buy in thirds, whether it's 3, 6, 9, 12, is because I can sell off my position as I am closing out on take profits. So you're basically able to shave off profits as it goes. So what do I mean by that? Let's look at a better example. So let's say you take this entry here for puts, right? And your first take profit is here, second take profit here, third take profit is here. So here's what a lot of people are doing. They take the entry, it comes down to the level, right? And then they exit the entire position, right? Or they exit the position on this pullback. And a lot of times what will happen is, if you're not being patient enough, or if you're not, just being cognizant of levels and how price will react to levels, a lot of times you'll leave a lot of money on the table, just like this scenario here, right? So, let's say you take this entry. What you do is at your first take profit, you sell 2/3 of your contract. So let's say for this example, I bought 3 contracts of QQQ puts, right? I would sell 2/3 of my contracts at my first take profit. And then I would let my last third run. But what do you do after that? This has helped me significantly. This isn't, investment advice or anything like that, but I've had trouble with sitting in trades for a long period of time, or just until my full take profits. And this has been drastically, a game changer for me personally, right? So the first option is when you first, hit your first take profit, you sell 2/3. Okay. So you're now taking off profits, and now you're leaving a runner. You're leaving the last trade or the last contract to go to see if it runs to your next take profits, right? And the way you want to do this is usually you want to let the trade die, right? Or you let that contract die, or you can move your stop loss, right? So let's say, for example, you took the entry, you hit your take profit. Let's say this is 100%, right? So you bought 3 contracts here, you're selling 2 of them at 100% here, and now you have 1 more contract, right? So now you can care less about the trade, right? So the thing is a lot of times people are trying to sit in their entire position trying to hit all their take profits, and that's where a lot of times it can be difficult for you to control your emotions. So one of the things that I would say that has helped me personally is closing out some of my positions, letting some contracts stay, but taking off majority of the profits. Because now if I do let the last one die, there's less emotions attached to the trade itself when there's less capital attached, and I know for a fact I'm green. So whether it works or it doesn't, I'm going to be green on the day regardless. And this is kind of helps you just say, hey, you know, forget it, whatever happens just happens. And this tends to be the way that, you know, you catch those bigger trades. So the next thing that you want to do is you want to just go ahead and set alerts. So you sell your first two thirds here, right? So you sell 2 out of 3 contracts here, and then your next take profit is here. So all you have to do is set an alert, right? You set an alert on TradingView or whatever, you know, brokerage you're using, whatever platform you're using. You set an alert, and if price comes down here, you know, you get alerted, right? You set another alert at your next take profit, right? So now you can either sell your next contract here, or you can, you know, if you want to let the last one run and see if, you know, if it ends up keep going, right? Or if it just keeps going, right? You can just set another alert here. So this one alerts you, right? And then this one alerts you as well. So let's kind of revise how this goes over or how this works out once again, right? So you take the entry of this level of previous day lows, right? You buy 3 contracts. You sell 2 out of your 3 contracts at this level. This is about a 2-point move on QQQ, same day contracts. This can pay really nicely. You guys can do this with weekly contracts. If you're swing trading, you can have targets. You can do this across, you know, all industries. This works across all of them, right? So you sell your first 2 thirds here, right? You let the last contract run. It snaps back, but you don't close it out. You let it go because at the end of the day, you don't care what happens with this last trade, right? So then you just set alerts at your next take profits. Well, look what happens, right? We come up. So we break through, we retest, and then we close lower. The next contract opens, or the next candle opens, and we push lower to your next take profit. So now you get alerted. So now you can either say, hey, I'm going to take profits, I'm done with the position, or I'm going to let the last contract run and see if I can take out this next target. It's completely up to you, right? So then you just say, hey, all right, I'm going to sit. You know, you end up getting a failed 2 down again, got an inside bar, and then it triggers to the downside, and it breaks your next profit target. And then you have an extreme target. So what do you do in these case scenarios, right? So you took profits here in your first 2 thirds, you got 1 contract left, and you're like, man, this thing is going. I think it keep going. I think it keep going. Well, what you can do is you can sell the last contract here, and then based off your profits, let's say you make $600 on this move, right? Or let's say you make, you know, $400 on this entire move, right? Profit. Let's say you closed out the last one. In total, you're up $400 on the day. Well, what you can do is you can always go back in with another $50 or $100 of your profits and see if it can, you know, take out this target and this target. So now at your second target or at your third target, you can re-enter with a portion of your profits. Shout out to JR for teaching me this in particular. This has been something that has been very transformational for my own trading personally. Just being able to sit in the trades and let them run has been very helpful. So those are the ways that you kind of scale out of the trade. You have your targets, right? You sell off, you know, 2 thirds or a third at your first take profit. You can sell off the next third here. You know, the biggest thing to take out is just how you manage your position will be completely up to you, especially how much money you're trading with or how big your account size is. But, you know, ideally you sell your first 2 thirds here at your first target, you know, your next one here, or you let it run and, you know, see if it ends up hitting all of your targets. That's completely up to you. Now, another thing you can do is to not give back so much profits, right? So you basically set a stop loss order. So, you know, basically the way this looks on Webull, right? You have your next target get hit. Let's say this target is hit as well. But let's say at this point you're up, you know, let's say you're up 300%. Well, how much do you want to give up, right, to let it run to the next, you know, target, right? So you don't want a 200% trade or contract to pull all the way back. So what you can do is you can set a stop loss on your order. So let's say you, let's pull up the text box over here. And let's actually just come over here real quick. Where is it? 1 second, guys. Let me see if I can. Okay, there it is right here. So let's use this, right? So let's say, you know, let's say you get filled on your contracts at 0.50, right? So let's say you get filled on your contracts at 0.50. So it's $50 for that trade, right? Or $50 per contract for that trade, right? And let's say, you want to see if the trade keeps running. So let's say, the contract is running, the trade is working out in your favor, boom, this trade goes from, you paying $50 for it to now your premiums is at, let's say $200, right? So the way this works is, $50 and $200. This is the way it looks, right? Now I know this looks a little confusing, but if you trade options, you know what premiums are, right? So it's the same thing just for people who don't understand premiums. You just move these decimal points over twice, and this is how you get this number. Move it over twice, this is how you get this number. So you bought a contract at $50, and that same contract went to $200. Well, guess what you do, right? This is, almost a 300-400% trade, right? So what you can do is you set a stop loss. So basically the way this works is if you want to let the trade run, right, you don't want to get back all your profits from the contracts or from the swings or from the not from the swings, but from the runners, right? What you can end up doing is you can just set a stop loss at, let's say 1.50, right? So now you still are going to be green if the last contract, comes back and stops you out. But now what you can also do is you can let the rest of this contract run. So now if this contract doesn't stop you out at $150, which you're still okay with because you're green, what ends up happening now is this contract can maybe go to $300, right? So now you're able to catch a 600% return now, as opposed to only catching maybe a 200 or 300. It's the same thing with 100% return. So hopefully this is making a little bit more sense, right? What you're able to do is you set a stop loss here at this number, right? So you took the trade at 0.50, which was $50, right? The trade is working out in your favor. It's up, let's say it goes up $200. So for every contract you bought at $50, they're now worth $200. Well, now you can say, okay, I still want to let the contracts run. I don't want to just close out my position right now. So what I'll do is I'm okay with closing out, I don't want the trade to go less than $150 per contract. So what I'll do is I'll just set a stop loss, right? Let's move this over here real quick. So what I'll do is I'll just set the stop loss at 150. I'm only okay with losing another $50 per contract, whatever your scenario is, right? And then what happens is if it never stops you out, this is a manual order that you put in Webull. Just to put that out there as well, right? This is a manual limit order. Let me just put this here. Okay. So this is basically a manual limit order. So basically, essentially what's happening now is you set a stop loss on here where it stops you out the trade at $1.50, right? Or $150 per contract. And now you let the rest of the trade run. So the next thing that's really important is having your alert set, like I said. So when you have these alert sets, all you have to do is either you're going to get a notification that you're stopped out of the trade, which you're okay with because you're still green, or you get a notification of your next target being hit, which is also good because now you're maximizing your profits and now you're able to sit in it longer. This helps you with not having to watch the charts all day. It helps you kind of trade on autopilot. It allows you to kind of step away from the charts and not really have to look at things much. But it just overall allows you to sit in trades for a longer period of time and maximize your profits. Because, in this scenario, let's say you bought 5 contracts, or no, let's use 6. You bought 6 contracts at $50 each, which means you paid $300, right? So you paid $300 for these 6 contracts. You sold 2/3 of it, which is, let's see here. Whoops, not that. Let's see. My bad, y'all. I couldn't type that, right? So you sold 4. Right? So you sold 4 contracts out of 6 at $100. Right? So this trade went 100%. You basically sold 2/3 of your trade, right? So now you make $400, right? So you have $400. You turn $300 to $400. So your profit, right? So you're up $100 in profit, right? Just for this example, right? But you also have 2 more contracts that are running still. So now these 2 contracts, you can let them go, right? So let's say the contracts move to $200 per contract now, and then you set a stop loss at $150. So now you're gonna either close out at $150 or you can let the trade run, right? But now what ends up happening is, let's say these last 2 contracts, let's say they go 500% or 600%, right? And they get to the point where now each contract is $300, right? So you got 2 contracts at $300. This is $600 that's sitting in just these 2 contracts. And now you can close these out. So now instead of only taking $100 or, maybe, $400 on the day, right? Now in total, you make $700 in profit. And it's because of your runners. Your runners made up a big portion of what was left over in your profits, or of your total profits. And this is basically how you would use this. So hopefully this wasn't too confusing. I just kind of want to break the math down as well. So basically you're buying 6 contracts at $50, right? Let's say you're paying $300 total, right? You sold 4 of your contracts out of the 6 at $100, right? So the trade went 100%, right? So now you're at $400, right? And your profit is $100, right? So you sold 4 contracts at 100, which means you took off $400, okay? Which means you have $100 in profit because you had your initial investment and now you have your profit. And now you also have 2 contracts left. So now let's say it moves another, 100%, right? Or another 200%, right? You put your stop loss at $1.50. So at worst, the worst case scenario is your runners will get stopped out at $150 each. That's the worst case scenario, right? Which isn't bad because you bought them for $50, right? But now what happens is those contracts run to $300 each, and that's where you want to close out. That's where your last take profit is, let's say, okay? You got 2 contracts left that are now $300 each. You sell those last 2, right? And now you have $600 in profit. You add your 600 plus the 100 that you had from earlier, and now you have $700 in profit while only risking $300. So in hindsight, this is how you're able to grow and let your trade sit for a longer period of time. And this is what's been personally helping me. It allows me to step away from the trades. It allows me to trade on autopilot in a sense. Sometimes will the trade get stopped out and still keep running? Yes, but this is a part of me following my plan. So you're basically moving your stop loss up, and if you wanted to, you can move it up again. Let's say it gets to $300, and it might be able to get to $500 per contract. You move your stop loss again if that's something you want to do. But this is the basic premise of it. So how would this look, right? So this example, we're just going to go ahead and delete that for right now, right? It's the same thing. So you enter the trade here. Target 1, target 2, target 3, extreme target number 4. You set alerts on all of them. When price gets down to these levels, you either get stopped out of your trade, right? Or you can let the last contract run if you want to, however way you want to do it, right? I'm just giving you different scenarios. And you just set alerts. So you're either getting an alert that you get stopped out of your last runners, or you get an alert that your runners are hitting a even higher take profit. So how would this work back here then, right? You can look at other examples. So let's say you have this actionable signal, right? The market breaks down. So this is QQQ. It breaks the low of the previous candle, and then it swings back higher, and it breaks pre-market high. So let's say that's a strategy you trade. You take your calls above this entry here, right? And then you have take profit 1, take profit 2, take profit 3, take profit 4. And all you're doing is shaving off 2/3. You either shave off the last third and then re-enter with profits, or you can just move your stop loss up and then let the last contract run, however way you want to do it, right? Same thing on this end, right? Let's say it's to the downside. Let's say you're taking a 2-2 reversal, right? This is a strat setup. So this is a 3-2-2 reversal. So let's say you take the entry here. Your first target is here, second target here, and then you can have an extreme target maybe down here, or this previous day low back here at 595. And then you let the contracts run. And then the numbers still play out the same, even though the percentages might just be different. So same thing here, right? You have your levels marked off. You're getting an actionable signal around a key level, right? So you have a 2-2 reversal. This is also, I think, when Trump was speaking. The market sells off. You could use this as a target, right? Or you could just use this as extra confirmation that the trade is working out, especially if it breaks the lows of the day, right? And then what you do is you take the entry, right? Let's say you took the entry here, or you can even just use 605 as a level because that's a round number, right? Let's say you take the entry at under 605, you take the puts, it starts pulling back, right? Cool, you either have a 50% stop loss or you size the trade for 0, meaning that you enter the trade with the amount of money you're okay with losing, right? Or you get stopped out at 50%, and that's fine, right? Whatever, like this is a part of your trading. Being profitable doesn't mean you're winning 100% of the time. Being profitable means you are winning more than you're losing, and your wins are making more than your losses. That's what profitable means. So you're gonna have trades where it doesn't work out. You're gonna have trades where you get stopped out really early and then keeps going your way. Or if you're sizing for 0, you're gonna have trades where you thought the buy side was the move for the day, and it ends up getting liquidated and completely crushed, right? You're gonna have trades that you lose. what this video is specifically about is how to sit in your trades just longer in general and letting your trades run so you can maximize your profits and really grow your account, which has been something that has been personally helping me. Again, I'm not perfect in any of this, but I just hope this scenario kind of helps you guys with understanding how to enter these trades, right? So you have a 2-2 reversal. Let's say you take the break of the 605 level, target 1, target 2, target 3. Notice how price is coming back to a recent level, right? All these levels are just being marked off on higher time frames. Price has memory. So majority of the time I'm taking my trades off of, the 30-minute or the 15-minute, right? And I'll watch them on these time frames because a lot of times you'll have too much noise on the lower time frames. So you enter the trade here, you have your first take profit, right? Let's say you bought 12 contracts, right? Well, you'll sell, if you want to sell 6 of your 12 contracts, you can do that. If you want to sell 8 of your 12 contracts, you can do that, right? Ideally, you would want to sell 8 of the contracts. So now, let's say this is only a 70% return. Well, guess what? You still take off 2/3 because this is your target. And then you let the last runners run to the next targets, right? And then all you have to do is move your stop loss, right? You can even move it to break even if you want to, right? So let's say the last, 4 contracts you have, let's say you don't want to lose money on those 4 contracts, right? Well, guess what? You just move it to break even. So at least you either take the profits and you go about your day, or you have more profits coming. And now it just allows you to sit in the trades, like I said, longer and kind of be able to just step away from the charts. You set your alerts at your next target. So, take profit 1. Your second take profit is down here. So you just set an alert. Well, this happens about an hour later. So now you might be out at work, you might be with your family, you might be doing whatever, right? But your second target gets hit. And now you can say, hey, let me set another target back here, right? And that target might get hit. And now you're just having money just kind of notifying you. And then you exit on these positions. And that's another key thing about following your plan is if you say you're going to get out somewhere, get out, and you can always play with profits. So I really hope that this video helps. Again, this works with swing trading as well. This works with the strat in particular. This is what I trade. Let's look at this on a 30-minute. This is a fail 2 up in the beginning of the day, right? This isn't really around any particular levels. Maybe if I turn on Lux Algo, you never know, you might have a level right here or something like that. But you get this fail 2 down. You can even look at this on a 1 hour, right? On the 1 hour time frame, let me see where that candle actually just went. Okay, so on the 1 hour time frame, you actually have a fail 2 up, right? So now on the 1 hour, you have a failed 2 up. This is an actionable signal. You basically mark out the high, you mark out the low of this candle. This is your entry. When the next candle opens and it breaks lower, you take the trade. You have your take profit 1. You can look back left and you can mark this out as your second take profit, which is the previous day lows, right? So this is this day, the day before it, this is their lows. This is your next target. You can have another target down here at this gap fill. Notice how the price comes all the way back down and fills this gap from pre-market from the day before. Price has memory, and a lot of times these gaps will get filled. So this is how you would have it, right? You have your entry, take profit 1, take profit 2, take profit 3, and then your 4th take profit. And again, you can do this across all industries, whether it's Forex, futures, wherever you can buy multiple contracts or multiple of a particular asset. And you can shave off profits. This is the way that has personally helped me. So I really hope that this video was helpful. If I need to make another video of this and kind of explain it better, please let me know. I know I probably maybe have went a little fast here, but I really just hope that this video was informative, and I hope that it helps you guys sit in your trades longer. Even if you look at today on QQQ, we had a strong push up. This candle right here tells a story, right? So let me turn off Lux Algo. This candle tells a story, right? We wicked to the upside. We failed to go lower. You got previous quarter highs right here. This is a pretty major level. And then this candle right here, right, is showing you that bears were once in control and the buyers stepped back in. And we broke back above 605. So you can use this as an entry at open. Is it a riskier trade? Yes. Where would your first take profit be, right? Target 1 would be up here, right? And the reason this is your target is because this is pre-market highs, right? And then target 2, and then you have your 3rd target here. And now you're just playing with profits. And this is how we're able to get results like this in my Discord, where you're able to come in and you're able to see people, even with small accounts, do 83%, 183%, 116% on multiple contracts. This is how people doing 100%, you know, so on and so forth. It's the same stuff over and over again. If I keep scrolling up, you guys will see a lot more of the wins. If we even just go to the trading profits channel, you know, some people are taking their very first trade and using the same exact way of trading. It just allows you, again, to sit in your trades for a longer period of time and really maximize the trade itself. You finally made it to the end of the free, I don't even know how long this is, but you made it to the end, right? That's a huge accomplishment. I want to say congratulations to you. A lot of people, really only 3% of people usually complete anything in their life. So for you to be a part of that 3%, I want to just say congratulations. You're freaking awesome. And I truly believe that, you know, with this information, it's going to be something that will allow you to really surpass your own goals and your expectations. If you did like this at all, please make sure you leave a like, leave a subscribe, and let me know down below in the comments if you made it to this part. Comment the word final inside of your comment as well, whatever you put, like as far as your review and how you like it and everything, and if it connected the dots for you and whatnot. I want you to put the word final if you made it to this part of the video. Now, what I will tell you as well is I want to open up an opportunity for only those of you who've actually completed it. So if you're watching this 9 times out of 10, you've already completed it. If you kind of skipped around and got what you needed out of it, perfectly fine as well. But I want to kind of show you a bridge to getting to where you ideally would like to get to in the trading space. And this is the TSA bridge, you know, essentially what is inside of, you know, all of TSA and what things we can really just help you with. So here's a full breakdown. All right. So after this course, you know, after you've already went through this for free, you know, you understand options, contracts, you know, the 4 different types of candlesticks, and you know how to trade the strat. You can identify CKSR and you really feel confident about it. You understand full time frame continuity, you know, your risk management rules, and, you know, you understand a few different types of setups that you can take based off of the breakdowns that I've given you. Inside of TSA, here's what's going to change the gap, right? Here's what's going to change the game for you as well, right? And that is this. It's executing under real market pressure. Okay, like right now, you know, you went through this whole thing and it's amazing, right? However, going about this alone, you know, if you really want to get to where you want to get to, you need a village. And for us in TSA, it's open and close enrollment. So I'll be honest with you, right? And if you want to check it out, the link is down below in the description. So during this time that I'm talking, it's down below in the description, right? However, one of the most important things is you want to be around other people who can speak the same language. So right now you're trading by yourself, and when you're having hard days or you have questions or stuff like that, you have to go to YouTube, and then you end up, you know, analysis paralysis and getting a lot of information that may be right or may be wrong, but it's so off from the way that you trade that it's kind of hard for you to really get the assistance that you're really looking for. So in TSA, we trade live 2 times a week. So once to twice a week, I basically get on with all of TSA and I trade live with you guys. So if you want to see real live breakdowns with the market, like actually being live, breaking down CKSR, walkthroughs and the pre-market calls, Q&A calls, and just being able to have access to a group of individuals who are just like you, who either work a 9 to 5 or are looking to make additional income on the side. You may have children. 99% of TSA are people who work these, you know, are in these 2 pockets, I guess, or rows, I guess, right? So that is 99% of TSA, right? What TSA also will give you is a scanner that will be able to allow you to save hours. I'm talking like maybe 5 to 10 hours per week on scanning the market for your best setups and favorite setups. You can literally get them within minutes when you join TSA by clicking the link down below in the description. Again, the most important part of TSA is the family, right? Is the community aspect of it, being around other people who are doing the same thing, talking about the same stuff, going through the same lessons. It allows you to grow faster and exponentially. So if that's something that's important to you, and if your growth and long-term growth is something that's important to you, I highly recommend that you check out TSA. You know, in the link down below in the description, there's going to be a further breakdown into everything. You get direct trade breakdowns and feedbacks from me. So if you have a question, you can always let us know. And then you get accountability and like real reps and real help from people who are actually successful at this. You know, this course gives you the knowledge. TSA gives you the real execution and the help and the community behind you to really see this level of success that you really want to see. So if you want to, you know, check out TSA, you can book a free call down below in the description. We'll chop it up with you. You might even jump on a call with me. Who knows? Right? So check it out down below in the description and see if it's a good fit for you. And if not, I'm just happy that you watched all of this. All I ask is that you subscribe, leave a like, and go ahead and share this with a friend who may be into trading or would like to get into trading, or just mention me somewhere on your social media or something like that if you liked it at all. And if you didn't, that's unfortunate. That's unfortunate. So with that being said, I greatly appreciate you for watching all of this. As promised, I delivered. And if my delivery was good, let me know. If there was things that I missed out on and that you would like me to go more in depth on, let me know down below in the comments. And yeah, I will be seeing you guys later. I love you guys dearly. And if there's anything further I can do, let me know in the comments.